till 29th. So I would like to first of all say thanks to our own Secretary General and the team. I request him to now speak on behalf of ISCC and give vote of thanks.
Uh, thank you, Raja. Good morning, distinguished guests, ladies and gentlemen. I am Kamal Vora. I am currently the Secretary General of the Indo-American Chamber of Commerce. Previously, I worked as a commercial specialist in the US Commercial Service in Mumbai. I may say I have done a little bit to assist trade and investment promotion between our two countries, India and the US. We have listened to the powerful and thought-provoking ideas from our eminent guests this morning. I consider it as a great privilege to propose a word of thanks to all the dignitaries who have spared time and made it convenient to attend this inaugural session. As you heard earlier, this session marks the beginning of ISCC's 6th annual session. We have about 7 events scheduled from now till the AGM, which is on September 30th. We are deeply grateful to, I'll begin one by one, Mr. Suneet Maheshwari, the convener for this 2-day event. Mr. Maheshwari, your guidance to us in all our activities ensured that we do the right thing in the right way. You did all the heavy lifting, right from concept to identifying the subjects for each sub-session, identifying the experts and inviting them. Thank you again, Mr. Maheshwari. Our thanks to the expert speakers for their enlightening address. Minister Counselor for Commercial Affairs at the American Embassy, Eileen Nandi, you have been a pillar of support, as always. Your presence today in this event has immensely enhanced its importance. Ms. Kaku Nakhate, for listing the favorable factors and the roadmap for India to be the 3rd largest economy. Mr. Ashu Khullar, your perspective of the current conditions and positive views on the mid-term Indo-US relationships are encouraging. We are extremely grateful to all 3 of you for your insightful address. We value your input and express our profound thanks for sharing your views with us on a topic of such contemporary relevance. Thanks to ISCC's President Rajalakshmi Rao for presiding over this session. Ms. Rao is the first woman president of ISCC. Over the year, you have led the team gently and professionally. Thank you again, Ms. Rao. Our grateful thanks to Canara Bank for providing generous support that uplifted the spirit of the team in no uncertain manner. I also express my sincere thanks to all the participants who have taken keen interest in the program and have taken time out of their busy schedule to attend this session. Finally, my sincere thanks to all my colleagues in all 10 offices of ISCC, and specifically Ms. Trupti Pawar, Mr. Satyanarayan Rath, Mr. Sagar Kadam, and Mr. Satish Sharma, who have worked with great dedication to make this program a success. Thank you again. Thank you very much.
Thank you, Kamal. Can we now move on to our next session? Mr. Suneet, will you take over?
Yes, I will. Thank you. May I request Sunil Mehta-ji and R.K. Bansal-ji to come online and active. And so the next session we have is really on stressed assets. As we all know, India is currently battling stressed assets in the banking system. And we can't ignore that issue as long as it is there. We need to tackle it so that banks can go ahead and focus on credit delivery. For this discussion, we have 2 very eminent people presenting perspectives on it from slightly different sides. We have Mr. Sunil Mehta, who is the Chief Executive of Indian Banks Association. And then we have Mr. R.K. Bansal from Edelweiss ARC. Mr. Sunil Mehta could have, just a word about him, he could have as well written motorcycle diaries. He started off as a banker in Allahabad Bank, going around in agricultural area on his motorcycle. And after that, so he has not only a lot of experience of agricultural, but now corporate banking, and then at PNB his inputs to sort of bring to bank and battle the sort of stressed assets there, bring the back into active business has been remarkable. And now that he is actually uh, looking at the IBA, he's at the forefront of all. I mean, and he interacts with all the bankers, both Indian as well as foreign bankers, and I think has is very live to the issue. So the topic we have for the day, as well as from stressed assets, as we call about it, I think is he is one of the best speakers to talk about this. R.K. Bansal, again, interestingly, a chartered accountant who's got into banking and then was with IDBI, and then he has seen through a lot of stressed asset management at IDBI. He was the head of the CDR cell, and now he is the MD and CEO of Edelweiss ARC. So managing stressed asset is his business. So I think we have two different points of view. And the topic for today is, of course, whenever you are doing any banking, there will be some stressed assets, but probably we have had more than our share. And I'm talking about pre-COVID. I'm sure post-COVID, this adds a new dimension. So without much ado, I may request Sunil Mehta ji to put in his perspectives. I think the key issues, Sunil Mehta ji, we would definitely like to understand is, okay, there was a pre-COVID stress. Now there is COVID. And also the impact of IBC. I think some of our viewers would like to know how you see and how do banks see it benefiting the resolution process as we go along. Without much ado, Sunil Mehta ji, may I request you to take over.
Thank you, Sunil ji, for a very elaborate introduction. And let me share with you my perspective about how the stress has piled up and what is the way forward, what the government has done, and what as an individual we can do or as an institution we can do to resolve this issue in India. I think the stress in Indian financial sector, it can be attributed to various segments. One can be relating to the corporates, another can be relating to the bankers themselves, another can be relating to the policy and changes and the judicial processes that all have contributed, and the overall global environmental changes. So I think the piling of the stress is related to a variety of factors. Maybe if we granularly work it out on, if you see the data, what you will find that if the corporate book analysis is there, the first 6-7 sectors by numbers is like power sector. Power sector is occupies 12.8% of the total outstanding credit of the banks sector-wise. Then another sector is construction, which is 8.22%, and the another sector is iron and steel, that is 4.68%, and real estate that constitutes 3.73%, then wholesale trade 3.7%, textile 3.23%, and chemicals 3.09%, and remaining all are below 2%. So I'll talk about how the stress has piled up in our entire banking system and the corporates, and where we have missed out. I think one of the few factors which I did back is, if you see, the biggest is in power sector. Power sector, all pretty well know that say before 2008, literally the power sector was the monopoly of the government. So maybe right from generation to transmission to distribution, the entire thing was into the public space. Then the government started opening up, giving the licenses for power sector, and everybody, because so long as it was into the government space, there was always a demands for more and the supplies were shortage, and everybody thought that this status will continue for a pretty long time. So everybody as a herd mentally started entering into this space. So 2008 onward, the massive investment in generation of the power sector started coming in. And you will understand, and without naming the people, I can very well tell, those who never had any exposure of working into the power sector or the manufacturing sector, maybe they were into financial sectors, they ventured into the power sector. They were into a textile sector, they went into. So everybody thought that this is the sunshine sector. So there was a mushrooming growth into that sector. Another thing that really mattered in this power sector and that impacted is the sudden changes from the regulatory side also and from the government perspective. So there was a coal block allocation which was going on, and the companies were operating for a pretty long time. Suddenly, this scheme came up, and the coal blocks were entirely cancelled by the Supreme Court of the country, and all the existing plant, they got a shock because they were having a very assured and the dependable supply of the coal at a very price which they have factored into their operations. And based on those factored costs, they have entered into a large term PPAs also with the various institutions. The live examples are like Tata, Adani, and Essar, when they entered into a long-term power purchase agreement without any pass-through arrangement for increase in the coal prices. So the mushrooming growth into the generation sector that has led to the creation of the capacities, which was then the shock came when the supply side got disrupted because of the coal block cancellation. People started depending more on the imported coal, so the prices of imported coal also started going up, and in the process, the viabilities got impacted. A lot of the PPA became irrelevant because they were not able to have any pass-through arrangements, and the PPA which they entered into also got this change. Suddenly, then there was a spurt into the non-renewable sources and the wind power as well as the solar power there, that also started coming into the operation. So that has created a glut into the market, and the prices and the costings became a difficult challenge. So power sector is coupled with a lot of regulatory issues because power tariffs are decided in each state, and there is a regulatory commissions which decides the tariff. They sometimes, because of the political reasons, the prices are capped at a particular level, and for a domestic consumer and for agriculture consumption, but that is not compensated through a budgetary mechanism. So that created a structural deficiency into the revenue generation because the discoms are not able to generate as much revenue because to certain segments they have to supply at much lower than their cost at which they buy the power. So that was not compensated. So these are few of the factors which has culminated into stress into the power sector, which constitute the largest sector in our banking space. Then similarly, problems started coming into the construction sector. Construction, even 20 years back, you all know, construction of road was into the domain of public works department. So PWD will construct the road, or CPWD will construct the road, or maybe irrigation dams will be constructed by the irrigation department. So the entire funding was coming from the government exchequer. Then the PPP model came into operation. The bankers aggressively started lending to this sector. Maybe government also facilitated them, persuaded them to fund to the infrastructure sector. People also aggressively took the risks, believing that whenever they are going for a PPP model, everything will be smooth. They will be getting everything what has been assured, and everything will be delivered in time. Another problem that came, again, there was a mushrooming into the infrastructure sector because players were low. They were not in a position to mobilize the required long-term capital for funding those infrastructure projects. So somewhere that capital requirement they have met out with the double financing, maybe taking loans under term loan also, as well as into the financing from EPC contract. So the same company, the group companies are doing that. Raising a term loan for a project, and the sister concern is raising for a working capital. So there was overlapping financing, and in the process, the margins requirement were not met out, and in the process, the capital, which is a cushion for absorbing any loss, missed out. Secondly, there was certainly sometimes the lands were not acquired. So everybody has learned a lesson in a different, because very of the promises, like in gas-based plant, the government was not in a position to provide the gas to those sectors. Maybe in some of the road projects, the land could not be acquired. And some of the places, the litigations and the other factors have derailed the process. So, but anyway, 70 to 80% of the projects still succeeded, and they are generating revenue. That's why the NPAs are below 20% only, in 18%, 12%, depending upon the various segments. But 80% projects succeeded, for which the entire country is taking the benefit. The citizens are availing the better infrastructure. You go to the airports, Indian airports are still better than the most of the airports in the world. So the infrastructure in the country was created, but somehow entrepreneur and the banking system missed it out because some banking system has missed it out in way of providing a more convenient funding without looking to the inherent risks involved into these type of fundings. So somewhere everybody has missed out on certain things, which has helped, and everybody has learned these lessons into a harder way. Now, some of the corporates, which just because of their aggression for growth, has started diverting funds from their main business operations to these segments, maybe power, maybe real estate sector, maybe construction sector. Then, since they were not having a backing of the margins in the terms of capital, they were not having backing in the terms of risk management. So risk mitigants were not taken care of, and in the process, we have started piling up the NPLs. I don't blame any one sector. We all have collectively contributed, right from government, right from judicial system, right for entrepreneurs, and right from banking system. We have contributed in piling up of this. Important thing which was that prior to the introduction of IBC, there was one myth which was in the minds of everybody, that if a large account goes bad, then it becomes a problem of a banker only, and they are only responsible for bringing the solution. So banker will either restructure it or provide additional funding to protect that account from slipping to the NPA. Yes, in many of the cases, bankers have done it also. They have provided that incremental funding, but that has reduced the proportion of debt without increasing the proportionate EBITDA. So without increasing the EBITDA, if you keep on increasing the debt, the chances of default goes up. And that is what has happened in many of the cases. The cases were restructured, they were given additional funding without any increase in production capacities, without any incremental increase in the EBITDA, and that has created the stress into the system. So similarly in wholesale sector, wholesale trade, the story is like people has gone for unhedged portions without understanding the risk involved, the currency fluctuation risk involved, and that unhedged portion, when the prices moved up, the margins were lost out, and many of the people in the wholesale trade made heavy losses, or they started working on derivatives without understanding the concepts of it. So all these sectors, all these things are cumulative added to the piling of the NP into the financial sector. Having said so, now what the government has done. So maybe after having pushed that, the government has come out with a landmark legislation, which is one of the best legislation I can say has come to bring the financial discipline among all stakeholders. That was IBC. So with the advent of IBC and introduction of Section 29A, where they said that, okay, if you person default and default beyond a reasonable time limit, then the same promoter may not have come back as a resolution applicant. So that has become a game changer. A few very large assets got resolved under that resolution framework, and that has given a strong message to the entire ecosystem that financial indiscipline or growth in uncharted territories without proper risk mitigant can end up into losing the entire holding, losing to your reputation, losing to your moving. So that has given a good lesson to the corporate. The bankers are also have lost heavily because of the sacrifices and the haircuts they had to take on these stress assets. So they have also learned it in a harder way. And now the level playing field has been created where now everybody understands the risk involved in going for a unbridled growth without having proper risk mitigants in the form of equity, in the form of various components. Now, this IBC legislation, what important thing it has brought on the table? The most important thing which the IBC has brought into the table is there is a transparent mechanism in which an existing promoter, if they are not able to take over, some new promoter can take over. So the entity, the value of the entity which provides in bread and butter and the support to the very large ecosystem that can be taken care of. And so a lot of the unit which went into stress, instead of going into liquidation, now they have come for a resolution. So the basic spirit of IBC is not liquidation. The spirit of IBC is resolution. And resolution brought forward can definitely become a very important thing for all these stakeholders, may it be operational creditor, maybe financial creditor, may it be the employees of that, may it be the shareholders. So everybody gets concerns get addressed when a resolution comes through the IBC mechanism, and that gives a real advantage to her. I think the next stage, the bankruptcy board is working on the pre-pack arrangement also, where even arrangements before going to IBC can also be worked on, and the companies can be prevented from defaulting and going for liquidation by bringing them to again to the business space. Now, all these stress which were continuing even at a pre-COVID stage got really compounded, especially during this COVID time. But thanks to our regulator and thanks to the government, at this time the government and the regulator has acted very proactively. A lot of steps were taken by them. Maybe to name a few, because ultimately the COVID has impacted. So the government has come out with a direct benefit transfer, and a substantial portion, that is 1,70,000 crore, was pumped into the system to various life funding to the people who are on the last mile, and they received in the form of a direct benefit transfer. The farmers received 6,000 rupees per month. Maybe people in a Jandan, they received 500. So that enabled them to retain their life, to livelihood. The MNREGA also provided them employment or sustenance during this COVID and difficult time, and to provide the relief to the people who really got impacted only because of the COVID. And there were no pre-COVID issues were there. The regulator came out also with a framework that 6 months moratorium was made available to everyone in 2 stages, so that the people have a breathing space. Their assets do not downgrade, and they can find time to come back to the terms of maybe after 6 months when the economy start opening up. And now the RBI has come out with a circular where the restructuring is also permitted, and that too with certain restrictions. Certain restrictions, because whatsoever bad experiences we have earned and learned out of this past restructuring, unbridled restructuring without supporting it. Now that is there is an entry level barrier also, and there is exit level barrier also. Entry level, like the account has to be standard and not less than 30 days overdue on 1st March, and the outer level is like not more than 2/3 restructuring is permitted. So that gives a scope that genuine stress that has been caused just because of the COVID can be headed by the regulatory framework provided by the RBI. Similarly, the government has also come out with the emergency line of credit, for that is a guaranteed line of credit. So 20% of the funded exposures is being funded by the bank. 3 lakh crore was the outlet, and out of which 1,70,000 crore has already been sanctioned and disbursed by the bank. So that was another thing that came out to support, to prevent the accounts falling into the stress capacity. The MSME was providing all time full freedom, and maybe even 30 days overdue criteria was not made applicable to them, and the restructuring window was made wide open, so that the larger segment of the ecosystem is able to sustain, and they are able to work during this point. So a lot of enablers have come, but still it is not sufficient to take care of all these sectors. And there is a greater need on the part of the entire ecosystem to bounce back to the normalcy, and a lot of changes are needed on the part of the all individuals. One thing on the part of individual segment, individual people, is like wherever there are stress under, wherever they feel the stress, they can approach the banking system for availing, because now banks have decided at the IBA level also, we have taken a decision recently that every bank will put it on their website that what are the resolution frameworks which are available, how well people can directly approach them through their website. They can log in, they can put in their request, a transparent way, a time-bound resolution can work out. And maybe to speed out the process, we have decided to classify them into the 3 category. One is mild, moderate, and the severe. So mild and moderate can be addressed very fast with very few formalities instead of going through the detailed restructuring, because ultimately all these accounts were standardized on 1st March and may continue as a standard assets, because downgradations were not allowed for the 6 months. And if the restructuring is implemented, then the downgrade of these accounts, spoiling of their credit history, and their future prospects can be taken care of. Very important aspect of the entire stress framework and the resolution framework is inviting the fresh capital. Inviting the fresh capital right now, we have got a large roughly 29 ARCs which are operating into the market, and Mr. Bansal is there. I think he will share, because they have exposure as a Edelweiss actually. What are the challenges which the domestic ARCs now face? And there is a need for a greater capital, maybe from institutional investors can be invited. I think the ecosystem is working and marketing this concept to the entire world, because everywhere this one theory is definitely in the minds of the international investor, that India is a place to invest. This is a place where the largest younger generation is living. This is a place where the largest younger generation, which will produce as well as the consume. So this generation is there, which is a very flip side of our country, that will provide us escape for inviting the international investment, because they don't find a better investment. Despite reduction in our GDP, we are still doing better than most of the world economies. So still we can have a bright spot. So how to convert all this stress into an opportunity? I think the country has already started doing into it. Maybe if you see the IBC framework, even after the IBC framework has came into existence, the gross NPS and the net NPS of the entire bank. This COVID has brought another challenge, but till then, if you see sequentially, the gross NPS and the net NPS were going down. That was showing a increasing the health of the Indian financial sector, reducing of the stress in the entire sector, and the capabilities of its growth in future. Now, this pandemic, the challenges it has brought, since the regulator and the bank and the government has come forward, and banks have also geared themselves to meet out these challenges. They are coming out with a 10% emergency line of credit and a 20% additional funding, which they are providing under the guaranteed line of credit. So that can facilitate in a containment of the spread. As the topic itself says, that the stress is now spreading outside the existing structures. So yes, because all these sectors, like banking sector was one, then there is a NBFC sector, which also is funding to the lot of corporates and funding to the lot of ecosystem. This NBFC sector had a liquidity crisis, post trust deficit in one or two cases, and the ALM mismatches that has rendered them vulnerable in this particular point of time. So how these can be addressed? So the government has also, and RBI has also come out with a special LTRO windows to support them and provide them liquidities. And so they are also getting impacted. And unless and until their health is good, they may not be able to extend the same support to the stress sector the way the entire ecosystem is expected to play. And then beside this, all these NBFCs, when I say there was a asset liability mismatch, their entire short-term money market instruments were funded by the mutual funds. So lots of mutual funds also came redemption pressures, because their maximum exposure went to the NBFC sector, and so the chances of their attracting fresh funds and redemption pressures put a pressure. So the spread of this entire stress into this one sector has now spread into the NBFC sector. It has spread into the mutual fund sector, and it is definitely going to impact the external commercial borrowing also, because now LIBOR transition is also happening. That is also going to impact. So the entire ecosystem is going to get impacted, and it requires a major challenges and a coordinated working. And I hope the present framework, which has been proposed by RBI, is really a very positive and a proactive move. I think the other regulators, if they also fall in line, and they also think that, okay, whatsoever the stress, if even if it is a mutual fund or it is a insurance company which has invested into these sectors, if they get aligned and the entire ecosystem takes a collective call on an entity level basis, the benefits I can call it, or sustainability to the corporates under these stress times can be provided. I think India has a great story to go. We can bounce back in the very short possible time. And from IBA point of view, we are already started sensitizing people, discussing in our management committee, discussing with our members that how best we can support the entire ecosystem. We all have learned the lessons in a very harder way, and going forward, how well we can change our strategies, learn better risk mitigation capabilities, how we can grow our equity market and get a substantial cushion, which provides us a capacity to face the adverse situation. So if these things are worked on, I think India can again become the bright spot for the entire world economy for inviting investment, because we have a large domestic consumption because of the large population as the younger generation. With this, I stop myself here, and because of the time constraint as well. And maybe I'm open to all question answers whenever the members want to ask it. And thank you for this opportunity to share my perspective about it.
And I
Thanks
just
a lot.
mentioned, Sunil Mehta, you gave such a fantastic, comprehensive overall scenario to us. And what I'm very impressed is about holding a small man's hand, MSME sector, You know, a lot of things you've said, I mean, some of it we know, but hearing from you, it is so nice because large corporations, everybody quickly gets together to help them out. But the small man gets ignored and forgotten, and they're going through terrible times, you know, MSME sector. So you have, you know, explained the whole thing so well. Really, I'll hand over to Suniji, but enjoyed your session. Thank you so much for giving this clarity.
Sunilji, I think it was a great pleasure to sort of look at the entire canvas that you painted. I thought I might just highlight that in different parts of our two-day event, we are also covering NBFCs today, later in the evening. We are covering mutual funds tomorrow afternoon, and we are also covering MSME. And hopefully some of the issues that you talked about would get highlighted. Now, before we begin, may I request Mr. Anil Gupta to unmute. We had a sector, a quick perspective, maybe 7 to 10 minutes of a quick perspective of hard data or numbers coming from.
Hear me, and can you see the screen?
Yeah, I can.
Okay. So good afternoon, everyone. Thank you, Sunilji, for a very enlightening session which you had, and I could relate myself maybe to 10-15 years back about the power sector when I used to be a power sector analyst, and I used to go to plant visits where these power plants were being erected, and one of the key uh, uh, parameter for any project appraisal is the raw material availability. And I remember that every time we used to believe that coal is not a shortage because we always read in our school and colleges that has the second largest reserves of the coal, and so we never thought that coal will become a shortage and it will lead to all these problems for a country which has the second largest reserves of the coal. So those certain basics, I think they get challenged only when you face the reality. So that is something which I have learned from my experience in the corporate ratings, that certain basic assumptions themselves may not hold true when you're looking at the projects which are maybe 20-30 years period, where you're looking at a return for over 2-3 decades. So with that context, I'll just start with some overview on the NPAs in our financial sector. So the total NPA, like if you look out the headline numbers do reflect that over the last 2 years, we have seen a decline in the gross NPAs of the banking system, declining from a peak level of around 12% to somewhere around 8.3% now in March 20. However, one thing which I would like to maybe emphasize upon is that this decline is not driven by anything related to maybe the improvement of the overall asset quality of the banking system, or maybe in terms of very great recoveries which are happening, though there have been improvement in recoveries after the resolutions which we have witnessed in IBC. But if we have to just look at some of the write-offs which the banks do, which also lead to the reduction in the headline reported NPAs, the numbers will look different. So we just look at the write-off pool of the banks, and the write-off pool of the banks that stands at around 6.5 trillion as on March 2020. So in addition to the 8 trillion sort of a stressed NPA or the NPAs which the banks have, so if I were to add this around 6 lakh crores of the write-off pool, then it will show a different number and will possibly put the overall stressed assets of the banking system at around 15% as compared to a reported number of 8%. So that is just a context that unlike a broader belief that the NPAs are coming down pre-COVID, they were coming down, that situation may not be true in terms of the actual ground reality. We saw that one-off event have become actually a recurring feature during the last few years in the banking system. So in financial year 2016, we had an asset quality review from RBI where we could see that the NPAs started shooting up from the banking system in financial year 16. Financial year 17 was one of year where we saw one of event like a demonetization, which also had an impact on the asset quality of both the MSME, retail, as well as a large corporate. Financial year 18, we saw another one-off event, which was the Feb 18 circular, which we famously called, whereby all the schemes of resolution of stressed assets like SDR, S4A, 525, they were all taken off by the regulator, and all these NPAs or the accounts which were under standstill under various schemes, they got recognized as an NPA, though they were part of the overall stress pool of the assets. Now, financial 19, again, another one-off event which happened was the NBFC liquidity event and increased refinancing risk on the corporate side. So liquidity became tighter across the system, and we see some corporate loans and the ILFS debacle, which also led to an increase in the NPAs in the banking system. And financial year 20, again, one-off event where we had few NBFCs, large NBFCs falling off and adding to the NPAs of the banking system. So roughly like last 4 or 5 years have been one-off, and we thought financial year 21, okay, we are entering into a good year with cleaning up of all the stressed loans, which we can see in the yellow chart, which are the restructured assets. And we thought possibly now we are at the end of the stressed asset recognition cycle, and the good years in terms of improved or lesser provisioning and improved profitability are ahead. And that is when the COVID struck us, and the COVID is now likely to add to the stress of the banking system. Our internal estimates are that from an 8.5% level, the NPAs will rise to around 11.5% after the write-offs of close to 1%, which banks do. So net of write-offs and upgrades, we expect it is going to be touching around 11.5%, and including write-offs, a number will be closer to around 12%, which will be the highest in terms of the banking system which we have witnessed during last couple of decades. So in that context, the restructuring scheme which has been given by the RBI, so we expect that some NPAs possibly, or the accounts which could have turned NPA, those will possibly get some relief in terms of restructuring, at least those borrowers who are genuinely impacted. So we expect that around 3 to 8% of the banking system advances could possibly, 5 to 8% could possibly get restructured. In the previous cycle, the peak level of restructuring, which is shown in this chart in yellow lines, the peak level of loan restructuring which happened for the banking system stood at somewhere around close to around 6% across public and private banks. So from that level, we are expecting a similar sort of a restructuring to happen in this cycle also, that around 5 to 8% can get added as a restructured loan book. If we look at the overall segmental mix of the NPAs, we could see it is largely the industrial segment which contributed to the NPAs in the previous cycle. And after the financial year 17, when we had a farm loan waiver announcement across various state elections, we saw a rise in the agriculture NPAs also in this segment. So apart from that, few failures of the NBFCs led to the increase in the NPAs in the services segment during financial year 20. So if we were to come and look at this asset quality numbers or the segments across the various segments, so if you look at the retail has relatively performed very stable in terms of the NPA numbers. Largely, the number has hovered around 2%, which is the lowest among all the segments, which is retail, the industrial segment, MSME, services, or the agriculture segment. And largely, if you look at the last 4 or 5 years, there has been a significant growth in the unsecured credit, which has happened to the retail segment. And despite significant growth in the unsecured piece, we could see the asset quality holding up in the retail segment. If we come to the industrial segment, if we come to the other other segments like farm loan waiver, if you look at, was the key driver of increase in the NPAs after financial year 17, whereby what we understand from some banks that the amount which has to be received from the state governments, they've still not received, and accordingly the NPA levels continue to remain high in the agriculture segment. Services, as I told, that financial year 20 saw an uptick because of failure of some housing finance companies, and in industrial segment, there has been some downturn, which has been is because of the write-offs which the banks have done, plus some NCLT recoveries also. If we look at the industrial segment, the asset quality numbers are not different. If we have to look at the MSME, or the large corporates, though it is relatively lower in the MSME at 10%, 12% level, but in the large corporates, it is at around 17 or 18%. But the number is still high, though it is lower within the MSME space. If we look at the NPA issue of the HFCs and the non-banking finance companies, there has been some uptick in the NPAs for the housing finance companies in financial year 20, and largely because there was a few slippages from the wholesale portfolio of these housing finance companies, largely to the developers, and NBFCs because they transitioned to 90 DPD in financial year 16 and 17. So because of that, also there was uptick in the NPA levels of these NBFCs. Now, what we also look at, because of the COVID, though the asset quality numbers still don't reflect the actual stress in Q1, but the loan book under moratorium across various NBFCs is very high, and it ranges any. And after August, when the moratorium is lifted, how will be the key driver of how we will see the stress building up into the NBFCs, HFCs, as well as the banking space. So this stress was already building up because we were having a slowing economy even in financial year 20, and because of this slowing economy, there was a build up in the stress even in the retail and the retail segment also. But this COVID is likely to possibly increase the stress on the retail segment also, and the asset quality in retail, which was relatively considered to be much better, possibly will get challenged in the current environment. So we have talked about the NPAs. We will just touch upon the recovery piece, how the insolvency and bankruptcy code has helped the banks and the NBFCs in terms of recoveries. So one major difference which IBC has created is that the behavior of the promoters in terms of that it is the problem of the banks when I have grown too large. So there is one famous quote which people discuss about, that if you have borrowed 100 rupees from a bank, it is your problem. But if you have borrowed 100 crores from the bank, it is bank's problem. So that thought process now that has got changed, and because now the threat of the change in the ownership of the company is for real. We have seen large companies seeing a change in the ownership under IBC, and this has changed the behavior of the promoters, that if tomorrow there is some problem, I will get a hand holding from the bank and my ownership of the company will continue to stay, and it is the banks which are going to take a hit, and I will continue to enjoy the ownership of the company. So that is the change which we have seen, and that has also changed the behavior or the risk appetite of the promoters in terms of not leveraging or leveraging conservatively, and they have started resolving the distress even before the insolvency process begins. So they are just cautious that they don't get into some sort of a stress, because even today, like the NCLT framework or the stress asset resolution framework, which the RBI has published in June. So we know that June 7 circular 2019, it talks about that if there is a stress in terms of the account getting classified as SMA1 or more, banks have to implement a resolution plan, and that resolution plan needs to correct the SMA status of the borrower. So if the resolution plan fails, then the provisioning is very high on the banks, and they have to refer the account to the NCLT to reverse those provisions. So what the companies and the promoters are doing, they're trying to resolve the stress even before it starts creeping in, either by way of maybe fresh fundraising or divestment of non-core assets, so as to avoid the insolvency process. If we look at the resolution plans, how the resolutions have happened in NCLT, like out of around 3,900 cases which have got referred to NCLT under IBC, we saw that around 250 companies have got resolution till June of 2020. And if we look at these 250 resolutions, the claim of these all as possibly the liquidation value was somewhere close to around 1 trillion. So roughly around 20% of the total liabilities of the creditors. If we look at the what the creditors recovered as a part of the resolution, because the IBC has a objective of maximizing the realizable value and protect the going concern nature of the unit, the recovery or in terms of realizable value was somewhere close to around 1.9 trillion, much higher than the liquidation value of these entities, and the overall recovery for the financial creditors was 45%. Now, this number, though it looks low at 45%, but it is historically much better than possibly the 20-25% levels at which we have seen many promoters coming and settling through OTS schemes. So recovery has improved, but definitely there is a much higher scope for further improvement in the recoveries, and that will happen through a timely initiation of the resolution process. The company or the lenders should start the resolution process much earlier in the stage of the stress, because as the stress builds up, the value of the firm keeps eroding. Average time for the recovery for the cases which we saw getting resolved is somewhere around 380 days. Not bad, but still it is higher than what the act originally envisaged. So there is a time to compress, and this time does not include the various extensions which were given because of the legal issue. So 380 days is still a longer time and is higher countries. Also, we saw that around 53% of the cases basically ended up in liquidation, which will be somewhere close to around 1900 odd cases, as compared to only 14% ending up with the resolution plan. But that not be this taken as the were also at around 5%. I think, as I touched upon, that it is more of a.
Hello, I think we are. Hello, we probably lost Anil Mehta, looks like.
Yeah, looks like
Yeah, I think we
network problem, I think. It's trying again, I think. Okay, started. Yeah.
Okay, Anil, I think he's making. Yeah.
Sorry, I got disconnected. Where did I got lost?
Yeah, go ahead. Start with the thing again. I think there seems to be a problem. Anil, I think we are losing your presentation.
Yeah, Sunit, can you hear me now?
We can hear you, but your presentation is not coming.
Yeah. Where you exactly lost my presentation?
IBC.
Okay. Sure.
That was the last slide you were on.
Yeah. So I was talking about the recoveries. The recoveries in the IBC, we saw that creditors got was much higher than the value of the assets. So the asset preservation was done in the cases which got resolved. And though the liquidation cases appear to be very high at around 73% cases referred to IBC getting under liquidation, but we should see that these most of these cases were already under BIFR or defunct companies, and their assets were much lower than in relation to their debt. So overall, what we believe is that the IBC is first of all is a very strong deterrent tool for not over leverage, because you can't predict the economic conditions and the demand outlook. The possibility of losing the control in case the things go wrong is real. So that is one, and also that if the resolution is implemented at the early stages of the stress, the recoveries could be possibly much better than we have seen in the past. So with that, I'll end my presentation, and we can definitely take questions in case the participants have.
Yeah, thanks a lot, Anil. I think the last piece on IBC was interesting in terms of giving information about what is, how much difference it has made. And I think that's something that a lot of our viewers today also were probably wanting to know. I think, I mean, my only thing is, yeah, I mean, there are a lot of facts there. Some of these we are probably aware. Some of these we get a perspective, and these are thoughts for us to chew on. So thanks for that presentation, Bansal Saab. Without much ado, can I request you to come on? I mean, Mr. Bansal, as I mentioned, can somebody unmute him? And he restructuring or recoveries and restructuring and recovery is his bread and butter business, and he is looking after ARC and is at the forefront of all the policy discussions, etc., that happen around that. So I may want to. Satya, is it possible to call up Mr. Bansal and check what has happened, whether there is any? There he comes on. Bansal Saab, we are waiting for you. Is he become unmute?
Oh, yes, sir.
Yes, sir. Yes, sir.
Good afternoon to everyone.
Over to you, Bansal Saab. I think we are looking to hear from you, somebody whose main business is stressed assets.
Yeah, thank you. Thank you, Sunil ji, and thank you, Anil and Sunil ji, for inviting me. So I think my job is somewhat easier now after Mehta ji spoke about the entire spectrum of the stress assets, and Anil explained what is the situation today. So I will focus more on maybe resolution. Okay, what should we do?
Yeah.
So just to, before I go there, I hope you are able to hear me.
Yes.
Yeah?
Yeah, we can.
So why it happened actually? I mean, if I just look at this overall scenario, I think restructuring or the NPA is not a new phenomena in the banking system, and any lending finally results into some NPAs. So if we have seen the stress in 2008 after a global financial crisis, but the government and RBI at that time infused a lot of liquidity, and the economy came back actually, and quite fast. And I would say to some extent that coming back very fast itself created a problem. So the too much liquidity was there in the system, and the country needed a lot of infrastructure. So we had a lot of projects coming around. Now, the NPA, as Anil explained, I think it went, if I add restructured asset, which is typically analyst way, it has reached almost 16%. And now slowly it came down to about 8% before COVID. So what actually happened? If I look at from the industry perspective, the major issue with our country has always been lack of equity actually. Now, unlike other countries where management and promoter are different, in our country, basically management and promoter is same. And because of that, the promoters don't want to dilute equity. And that becomes a big challenge actually, because then you can't raise equity. And if you can't raise equity, then your debt becomes high. So that is one typical problem I have seen last 30 years in banking. And then during this period, we try to create equity by taking debt. So we took the debt in the either operating company itself, or most of the time we took debt in the holding company. And that became multi-leverage. And especially it happened in EPC segment, much more everyone is aware. So you take loan in the holding company and then show it as equity in the SPV or subsidiary company. And sometimes initially bankers were also perhaps not understanding this entire thing. So we are also to be blamed for that. And later on we understood, but we were late. So that was one problem which happened because of lack of equity, because they will not divest in that sense, and IPO didn't give that much money. So the debt equity ratio, especially the debt burden, kept on increasing. I think that was the one basic problem, if I look at it. The other issue which happened was that, as Sunilji explained, like say everyone went into some sectors, which is the herd mentality which happens, like EPC came in once, road sector, power sector, steel. So if I put it this way, the commodities super cycle, what we call it, led to overcapacity. And some of one or two power plants or steel plant doing very well and earning abnormal profit motivated a lot of promoters actually to put power plant or steel plant. The third issue which led to is the basically over optimistic growth. So accordingly, when economy was growing at about 10%, everyone thought every year it will grow 10%, and the traffic will grow every year 15%, but it didn't happen. Now, if I really look at restructuring the earlier round of CDR, because I have seen all the rounds, so we had a round in 99-2000 also, but it succeeded very well because the economy did well as per the projections made. After all, every lending or every restructuring is projection. Today, in fact, many times we blame CDR or we blame the entire restructuring as evergreening by banks. So banks itself had 2-3 challenges. One, they did a restructuring based on projection, but economy didn't actually perform that well. The second reason why the most of these restructuring packages were based on some additional assistance, which didn't happen. And during that period, the banking consortium has become too large. It was almost 30-40 banks in many cases. So making them agreeable and releasing some money or agreeing to something, it became very difficult. So I think that these challenges created an issue that CDR didn't actually succeed. Restructuring didn't succeed. The first round of restructuring has succeeded, and even companies like big companies like JSW had also gone through this restructuring, but they all came out of that. Here it didn't happen. Then slowly a trust deficit also developed between actually banks and borrower, and even between regulator and the borrowers actually. Now our overall stress got now slowly it has become more because of the COVID. So if I look into the history of overall actually resolution, now let me come back to resolution. So recovery mechanism in our country actually has been there, but in different varieties. Initially, we had civil courts. Then when Companies Act came 56, then you had winding up provisions. Then we had SICA, that is BIFR, in 1985. Then we have SURFACI Act in 2002. And it was hoped that because banks can take over the asset, so that should be the panacea for everything. And under SURFACI, only ARCs came into picture. Then we had CDR in 2004. JLF system, then SDR came, S4A came, and then finally IBC came in 2016. Now, IBC has, as Mehtaji explained, I think has been a game changer. It has been a very well drafted act. On top of it, it has been implemented very fast. The initial round of IBC has done wonders actually. So most of the cases which got resolved quite well, though initially we also faced a lot of legal challenges, people challenged the provisions up to Supreme Court level. But the advantage of IBC, if I really look at before IBC, even in at our ARC level or in the banking system, the only way to recover the loan was either SURFACE, which itself had a challenge because you need a CMM or DM approval to take over the asset. And many times they don't give the plant is operating. The other way out was either settlement. Settlement needs money, but many bigger projects, promoters or borrowers don't have that type of money. Then the way out was only restructure. So you do a restructuring with the borrower. But there was no way that you can, if borrower is not cooperating, that you can do anything. Because if you go to winding up thing, in any case, winding up is not the final solution because then you end up liquidating the company. So India used to take almost 5 to 6 years to recover any NPA, while in other countries it used to take like say 1 year, 2 years maximum. And similarly, the cost of recovering money in our country was quite high. India's almost ranges were 9 to 10%, while in some other countries it ranges between 2.5 to 3.5%. Similarly, the recovery percentage before IBC, in our country, the experience shows that it was ranging between 15 to 20% because the time taken was quite high, 8 to 10 years under winding up. Even many cases of winding up, even today I am dealing with, last 25 year, 30 year cases are still not wound up. So it used to take huge time. Now, so that is why when we introduced IBC, actually the idea was that we should be able to restructure the loans, revive these companies. And just to give one small figure, when US introduced bankruptcy law actually in 1978, the GDP of US was actually 2.4 trillion. And after about, let's say 10 years, it became 5 trillion in somewhere in 87, 88. So when India has introduced in 2016, we are almost at the same level of 78 of US, where GDP is 2.3 trillion. And we expect that in 2025, we should also be at $5 trillion. So if I compare these two countries from 78 in US and then today in 2016 India, figures look to me almost similar. Now, the idea of IBC was that we should be able to have an act which should be very fast, time bound. So, and it should define the waterfall mechanism very clearly, timeline, which was initially 180, 270 days, later on it became 330 days. We should have a creditor in control model, possession model, unlike all the earlier where it was a debtor in possession model. It has done well, though now we are seeing some delays here and there. But a lot of issues were raised about IBC going up to Supreme Court. But after SR Steel judgment, I think most of these issues have been resolved by the Supreme Court. And a few decisions which were very, I think, path-breaking. One, committee of creditor is supreme in the ultimate discretion. Operational creditors and courts cannot interfere in COC decision. Third was the secured creditors are the main, the primacy, they have this primacy in all the security. So all these issues actually they clarified and now things are improving a lot. However, some delays are still happening. There are still 5,000 to 6,000 cases not yet admitted in IBC. And after COVID, it has impacted more. The many cases, many times people say that many cases are going into liquidation, but that is because all these cases which are going into liquidation, 75% of that was old BFR cases. So these were NPAs of more than 15, 20 years. So those are going into liquidation. That is also a good thing because otherwise they are just continuing and surviving the system and clogging the system. So already we have resolved cases and we have recovered more than liquidation value in all these cases. The recovery percentage is about 45-46% for the cases which are not resolved. 3 or 4 actually have given recovery of almost 100% or more than 100%, like SR Steel or Binani Cement or even Bhushan Steel to a large extent. So the recovery rate has improved. The timelines have shortened now. We can expect at least 2 to 3 years maximum, even if I take all sorts of delays into account. But it gives a good this thing. And as Anil mentioned, there is a huge change in the credit culture. So today promoters are worried. Of course, this section 29A was not there initially in IBC, which was introduced later. So to give a clear message that if you are responsible for making the units, which can be, of course, a controversial point that who is responsible and all that, but I'm not going there. As of now, the idea is that existing promoters will not be able to give a plan, resolution plan for these assets, except MSME. So this has been now relaxed for MSME things. Now, overall, coming to basically what are the investment opportunities in these assets? We are talking of Indo-American this thing. One is that you can buy out all this debt from the banks. And today RBI has put a draft paper for circulation whereby FIIs and FIIs or the funds can invest directly. As of today, you have to invest through NBFC or ARC. But now there is a provision that you can invest directly in these assets. So you have huge, almost like 10 lakh crore worth gross NPA, even if I exclude retail, etc. So you still have about 6 to 7 to lakh corporate assets which are available for large funds and large investors to look at that. So the opportunity for priority funding in such cases, you can do a priority funding and become super senior. So that itself, and especially that applies more in real estate cases, whereby the project is, let's say, stuck up, incomplete, you can provide a priority funding, as government is also doing through Swami Fund. So these opportunities are there, then you can buy the debt, you can take a private equity type situation and take the controlling position in these companies. So, I mean, a lot of opportunities are available from either from stress asset fund or private equity funds. You can basically this thing. Now, as Mehtaji mentioned that ARCs are there in the country, then stress asset funds are there. We are running one of the ARCs and we also run one of the largest stress asset funds. But the problem, if I see the size of the market is quite huge. If I look at this 10 lakh crore or 7 lakh crore also, and even if we take value of, let's say 40%, you still need about 3 lakh crore. While the entire ARC industry today, the net worth is, total net worth of all these companies is hardly 20,000 crore, less than that. And normally ARCs find very difficult to borrow from the banking system because banks treat this as again some sort of evergreening. So they don't lend to ARCs. And then if you have to borrow whatever from the market, etc., still if I add 20,000 crore, so you still have only 40,000 crore available pool here. And this part of it is already invested. And all the stress asset funds which have come into our country, and there is a huge opportunity for them. Today they are at about 6 to 7, 8 billion, let's say. But the problem is almost, as I mentioned, 3 lakh crore. So which is a huge opportunity. We need a lot of other funds, a lot of stress asset fund, a lot of private equity fund, a lot of more ARCs to come into the picture to resolve this asset. But more than that, I feel only sale by the banks is not going to resolve all the cases. We have to work together, I think, with the regulator, with the banking system. So only sale to ARC or only, and that too bank wants to sell in cash while ARCs don't have that type of cash available. And many of these assets don't have a value in terms of cash today. It may have a value in future. Let's say power plant, as we discussed, Mehtaji explained. So if I look at power plants today, if you want to sell, we are getting offers of about 2 crore per megawatt. But this country needs power. So after 3-4 years, and all these power plants have been set up almost at 6 crore per megawatt, 5 to 6 crore. So after 3 years, certainly I hope we can command 4 to 5 crore. But we need time for that, for resolution. So to get that time, either we can use ARC system or we can use that bad bank concept which government is talking, or ARC for power sector. Because there's only selling is not a solution. And you don't have many buyers in power sector. Let's say we have only 3 entities in India, 3 groups, but how many power plant they can buy? So I think we need a combination of all these for resolution. One, AR sale to ARC, especially when you need a warehousing, sale to stress asset fund. Three, you need restructuring by the banks. Fourth, IBC, and fifth, an OTS settlement with the companies. Now, IBC is good where you can find a strategic investor. Otherwise, IBC can become a issue because then you end up having a liquidation of the company in many cases. So we have to be very careful while referring the cases to IBC. But sometimes the trend is to refer it to IBC just to not to do anything else and not to decide. So that tendency, I think we have to stop. My feeling is, if I look at all the three measures taken by a regulator, first moratorium, then secondly restructuring, now a new circular, and by Government of India to suspend IBC, all three have to be seen in together. So this is like you end up moratorium, you can't take these cases, but this applies only to the new cases which have stress because of COVID, not to the old cases. And now you do the restructuring. So bankers have to be more confident of restructuring, unlike maybe last 2-3 years where restructuring has not happened because it was banned after 15, banned, but it was no benefit, no regulatory forbearance was available after 2015, 1st April. So I think now, because RBI is allowing, I feel as bankers, we should make use of this opportunity, give time to these corporates and restructure at least these cases so that they don't become NPA and unnecessarily create more stress. So the resolution for old cases certainly requires, because this is like, I would say this is a stroke actually. You have stroke, you have inflow. Now this old problem of 8 to 10 lakh crore, we have to resolve by doing cleaning, and this cleaning wave has been going on after AQR of RBI. And bankers also became confident to some extent because government gave them equity. Now, sometimes we are saying why we didn't do anything before 2015. I would say there were 3-4 reasons. Neither government was giving equity at that point of time. Banks didn't want to show such a high percentage of NPA, and corporates were there, and we were hoping that economy will do well. So today we are comfortable as lenders because provisioning coverage is almost 70 to 80%. Government has given equity to the banks, and there is a focus, there is a clear focus from government, RBI, that you clean up. So we can take that hit. So total recovery, if we see through IBC, I feel if I exclude these 4-5 bigger cases, it will be about 20-25 cents, which is okay in the old NPA cases. The new cases, of course, will have much higher recovery. But we should use combination of all the, I think, mechanism available. IBC is also looking now, IBBI is also looking at cross-border insolvency, group insolvency, personal insolvency, and even pre-packs. So I think pre-pack will be used much more in future. So I have been always saying, and even IBBI has been saying, the success of IBC would be that people don't refer cases to IBC. So it should work as a threat only, and we restructure or we do pre-pack before reference to IBC. I think that has happened. Last 3-4 years, banks have seen a lot of settlements actually, instead of going to IBC. So I think IBC has done well. So bankers now should use this opportunity, you would say, for all the facets, including restructuring, including settlements, and including IBC. Thank you.
That was a very comprehensive perspective and very candid perspective, Bansal Saab, which gave what the reality of the issues are. I have, interestingly, one or two questions. One of them is for Sunil Mehta Saab. I'm not sure whether he's there. If he's there, he can answer. Otherwise, maybe you can also.
There, he's there.
He's there.
Okay, so here it is from Natasha Sinha. She's representing steel and mining sector. And she's been talking about this sector, of course, being reeling under the thing, under stress. Now, pre-COVID, there were some stress assets that were taken under M&A over and brought over by some promoters by bringing in fresh equity. However, the merger of banks has started. And this is a very interesting problem that maybe these banks committed to some things in their discrete entities before the merger happened, and now the merger has happened. And what she's saying is, therefore, such companies who had some kind of benefit coming from any of the merging banks, I think they are kind of falling within the cracks, and for no fault of theirs. Is there, and they may have to now sort of go again through IBC process. So, is there a solution on this? Is there some light at the end of the tunnel on this aspect?
So the question has got three parts, and I'll reply each and every part. The first part is regarding mergers. So post-merger, none of the bank is under PCA. So the question which was raised that because of the PCA, they are not able to disburse. So that question do not stand because PCA impact is not there. I think government has taken care of the capital. Last September, they have provided adequate capital to all the banks before merger, so that the combined capital adequacy ratios are sufficient, and all of them are out of PCA as on date. So that issue should not be there. Is there any particular specific issue? They can definitely deal, because there is a grievance redressal mechanism everywhere. They can seek to the higher authorities of that bank and can approach us. As regards steel sector, I think the steel sector was really in a bad shape before the government intervened. But government has intervened at three stages. First, they introduced 5% import duty, then they increased it to 7.5, then they introduced the minimum import price. After the minimum import price, at least now the domestic production has got parity over the import. So the China, which was finding India as a dumping ground, now the import from China has gone down substantially, because domestic production and minimum import price provide the cushion to the domestic producer to be price competitive in the market. So I think, and the way I get interacting with a lot of the steel companies, most of them say that post-COVID also, we have started coming back to almost normalcy. We are bouncing back in our operation, and we are going to definitely getting better EBITDA than what we were having earlier. Ultimately, to push the economy, government is bound to push the infrastructure and the affordable housing, and these are the sector which will consume steel in a large quantities, and the steel will have a adequate demand. That is one sector which I'm sure will definitely get a good attention from all sector, because it is a major sector of the economy, as well as the government is going to push the economy through these sectors only. Third thing which she asked about is that is about restructuring. So I can tell one thing. Maybe I don't know about which firm you are talking about. You can talk to your lenders. But now a lot of resolution options are available under June 7 circular also of RBI. And if the stress is recent, then under the COVID restructuring. So you can definitely approach your lender. And we from IBA level have already discussed this among all the MDs of the bank. We are going to put in a place where you can approach, there will be a grievance redressal mechanism also, where they can log in their request for restructuring, and it will have to be resolved in a rightful way by the lenders. So I think the banking system is also gearing up, as rightly said by Bansalji, that restructuring, since there was no incentive, was not happening for the last 3-4 years. So I think those proposals were not looked at. But now the time has come where the corporates can take benefit of these things. So I hope if they approach their lenders with the right proposal, with the right turnaround plan, the lenders will be willing to listen. So that is my limited answer.
Oh, that's a great perspective, and I think you also mentioned somewhere that if they are kind of a total loss, they can even talk to you all, and you can point in the right direction. So I think that's a big benefit to people in the industry. I had a red herring question. Okay, this is my own, and if, I'm not sure whether any one of you would like to answer this, but because it's a somewhat, shall I say, politically tricky question. So one of the things that I have always wondered, because public sector bankers are one of the best informed bankers, they're capable, but somehow they're the system, the whole perspective of vigilance. This is it probably hampers them. Why is it necessary for the government to have an effective say by keeping their percentage holding to 31%? If they bring it bill to 49%, they will have the same say. Maybe the 2% they can place it with the employees, and the government controls, etc., that hamper them and probably make the decision a little slower, maybe they could be a little more responsive. I don't know whether anyone wants to take the question, but here is a point that I think both of you uh, have have the reach in the government. Somewhere we need to highlight that. I mean, I remember good old days. Tata Steel was controlled by Tatas with a very small amount of percentage holding. So 49% is a significant share. Why do we need to have 51% or more to have a say?
So now maybe I'll take that question because I think we keep deliberating on these issues. One thing, the equity holding is no criteria. It's the efficiency of the system that is most important. As regard to privatization and private versus public sector, so every sector can commit mistakes, and that was evident in the most developed economies of the world is US. In 2008, when the entire market crashed, they were not having even a single bank which was in the public sector. Most of the banks which collapsed were all in the private sector. And who bailed them out? It was the government of America and the Treasury who issued the bonds and the recapitalization bonds, and the entire private sector was bailed out by the government by infusion of the equity, and now they have bounced back to the economy. So just reducing the equity does not bring value in an institution. What brings value is creating corporate governance, creating efficiencies in the system. And in a country like India, which has got a wide geographic spread, and as Rajalakshmi very rightly said, that it's not that only our corporate wishes to exist in the country. You need the people to grow down the line, maybe from agriculture, the small traders, the rural. This is remarkable. You will be surprised. Nowhere in the world this happens so fast, that such a big dole which the government has gave during the pandemic reached to the people within a day or two. Everything was transferred in the single day transaction because the system, because of the direct benefit transfer schemes already lined up, the Aadhaar enablement happened. So nobody realized when the money has gone. Otherwise, it's the same amount to flow from the central government to the last mile. It can take months together, but it has flown in 2 days just because the systems were equipped for it. So I think reducing equity, may or may not equity, that is a decision the government can take. But my personal perspective is, it's not the percentage of equity which the government hold, like just they reduced from 59 to 48 or 51 to 49. That won't make any major change unless and until the governance, the management structure, the operating processes that get improved. So I think now even public sector banks are looking for efficiencies. Most of the banks which are under PCA has now come out, started showing profits. And there's social responsibilities and accountability in a country, a diverse country like ours, with so much of the unawareness level at the downline. I think the private sector and the public sector need to coexist. And the only thing is, because you need to take care of all the segments of the economy. Limited point is, you have to bring efficiency in all the sectors, and maybe all the NBFCs, or maybe which you recently mentioned by Bansalji, which collapsed. They were all in private sector. None of them was owned by government, but then the system collapsed. So it's not that just by converting the equity to minority one, the efficiency or the corporate governance can be brought in. It can be brought in within the broader framework, even without the equities. And I strongly believe that in our country is a mixed economy, and both have to coexist.
No, I think. Yeah.
Can I just,
Go ahead.
in fact, all three of you have given, wonderful discussion about what's happening in the country and what government is doing. To be very honest, except that we read about it and we also get all the information from Invest India, and we keep telling our members. But somehow that government has transferred so many accounts, funds were transferred immediately, and all these beneficial arrangement that has been done by the government. I mean, I must applaud the government for this quick action. This is the first time social sector has been looked at very seriously by the government at all levels. But I somehow feel this information is not trickling down. I mean, like, it's nice to hear. I know, and where our members are hearing, but generally, it's sort of the sentiment is not showing that. So somewhere there's a communication gap. I hope you understand what I'm trying to say, because we hear what is the pulse of what is happening in the country, and they keep saying, "Oh, they just say like that," but no, I went and nothing happened. This is the way people talk. So I think you should also think of communicating correctly in whichever media you really go to. Government, you must give this suggestion to the government between you all. I think you can do that. I mean, you have really enlightened us, but I still feel this is where people are not connecting. So much good is happening. It is happening, but they're not connecting. Some people are not taking the benefit of this. I'm just
Yeah, I think that's a very important point that people I mean, there's lots of things happening, but people probably are getting too negative in their sentiments, thinking everything is bad and nothing good is happening. And so the communication needs to be clear. And unfortunately, what is happening is media also is sometimes not completely transparent, particularly the audio visual media may be conveying some particular thought or the other. So I think the tasks of chambers and associations such as IBA probably increases to the extent that we need to find a way to disseminate this to people so that they come to know and they don't get into shall we say, a reverse spiral in thinking. Having said that, I think we are coming to an end. There were one or two questions, but that Anil has answered through the IBC impact that is there, and then Mr. Bansal addressed it well. But one or two clear takeaways I have is that yes, IBC has made difference. I think all of you are echoing the same thing, that now people know they can't completely run away. Okay? And I think that 100 rupee versus 100 crore, example kind of exemplified that you can't do it. And I think that's very interesting. The news about pre-pack IVC, which Sunil Mehta talked about, I think that was very important and interesting. We haven't discussed the post-COVID, the restructuring plan that has been there too much in detail. It's still fresh, but hopefully that should also address the post-COVID problem. We need to figure out the pre-COVID problem, and as Anil did point out, some of the larger corporate assets, which may comprise larger shares, may not be in numbers, but in larger shares. Hopefully that gets resolved now that things are sort of going ahead. I like the other issue, and I think both of you talked about it, but Bansalji also talked about none of these steps are going to be adequate by themselves. They have to be all acted in concert. And I don't know somebody has to look at this holistic system thing coming in. And therefore, I come back to you on this, Bansalji. I think the fact that you correlated the problem of banks, NBFCs, mutual funds, it was a full financial sector stress that kind of percolated. But if somebody actually works on the advocacy on this aspect, so that all these people, including the other regulators such as insurance and pension fund and kind of and SEBI kind of act in concert on this. We have a committee in the government of regulators which are supposed to talk about financial stability. But somewhere I think we need to talk about looking at these steps in concert so that it makes a huge difference or faster presence to this. With this, I think I might like to draw a closure to the event. And we have, as Raja Lakshmi ji had talked about earlier, we like to plant a tree and maybe make India greener from ISCC's perspective. So there is a tree that will be planted in your name, and a certificate of that would come to you sometime soon. But this is just to show our gratitude. And I must thank both of you that you made the session so more useful. We had a lot of people logging into this, and in fact have given a lot of comments saying they wish they had some other commitments and they could listen into it. Hopefully this session is getting recorded and will be there on the YouTube and others. So those who want to listen later on had missed this, I'm sure they will get an opportunity to listen. So with this, may I thank Sunil Mehta ji and Bansal ji and Anil Gupta, all of you, to have taken the trouble and present their perspectives, and hopefully we will have more such sessions going forward. I think stressed assets, as far as my own personal experience goes, there's a lot of interest from overseas investors. So hopefully they can. We should look at doing something on that aspect. So with this, can we get into the next session? Thank all.
Thank you.
And
Thank you,
Thank you
Sunil
very
ji.
much,
Thank
Ji.
you, Mehta ji.
Indo-American Chamber is grateful to have all of you, Mr. Sunil Mehta, Mr. Bansal, and Anil Gupta ji. Our members are extremely grateful for all the information you have given to us. Thanks a lot for joining our
Thank you.
session.
Thank you.
Thank you. Thank you, Sunil ji, for moderating the whole show.
Excellent.
Yeah, do we have the next session? Next session is Jaspal Ji. Yes, he's logged in.
It's going on YouTube, right?
Yeah, now it would be available.
Yes, it is. Yes.
Okay, I think we can request Jaspal Ji to.
Yeah, Mr. Bindra.
Mr. Bindra has joined actually.
Yeah, so Jaspal Ji, we have a very. I just wanted to see whether he's joined in. He's logged in, but he's not yet.
I can hear you.
Okay, great, Jaspal.
Can't see you.
Hello.
We
Hello.
can't see you.
Can
Mr.
you?
Bindra? We
Yes.
see you.
Yeah.
Yeah. So I'm just putting on the video now.
Yeah. Okay.
Is that fine?
Okay. It'll take. There's always a lag, so it will come. Yeah. Now it has come. Yeah. I think without much ado, I must welcome Jaspal and on this session. I sent him a mail requesting, and he kind of readily agreed. I had requested him to come for this session, of course, but then I was cheeky enough to ask him to come for another session, which is in NBFC at 5 o'clock, and he has agreed to come for that too. So we will discuss NBFC issues at that point in time. But, just a few words. Of course, he's an eminent banker, was heading Standard Chartered in Asia, and it's a lot of global experience. He has a very good long years of experience in India. But 2 points, Jaspal, I'm sure you would have heard. Almost all those who have worked for you swear by you. I mean, Jaspal is a people's person, and everybody liked him as a boss and still reminisce it. And I think that's the most important aspect. I think you can go home and have an extra drink today on that score, because, when more than one person who reported to you said, well, I wish, I cherish those moments. I think that's an important thing. The fact that you stood out for people way beyond the call of duty. I think that's something that most of them kind of remember. The other issue, of course, is because of Jaspal's overview of the different sectors of the banking system and the financial services, and also various geographies, and not only India but elsewhere. I think the luncheon speech idea of Jaspal is, we want to hear your worldview of the world of banking and industry as you see it in India, and then compare it with the region, because we are all kind of connected world now. And so this is a complete your vision, your perspective, your analysis, and then your vision of the way forward. It is reputed that Jaspal has always anticipated many of the changes happening in the past and has stayed in step ahead. So I hope we can all benefit from your perspectives, Jaspal.
Good afternoon, everyone. And Suneet, thank you for that far too generous introduction. But I also would like to thank the Indo-American Chamber of Commerce to invite me to their annual convention. And Suneet, thank you for extending that on their behalf. So let me sort of, this is always, I find, extremely challenging to speak to an audience I cannot even cite. And then to have to speak for a period of time when I have no idea whether the reaction is good, bad, or ugly.
We will show you the reactions. Don't worry. And represent them.
Yeah, but I think what we will do is we'll keep the session simple. I will speak for a bit, and then we'll try to make it interactive for some part as well, so that for a good part, so that we can talk about things that are on your mind rather than whatever I want to say. And I wanted to talk about today at this session only about banking and what are a few topical issues today around banking, and of course in relevance to the Indian scene. Banking, as you know, only scandals in banking and scandals around bankers make good news. Actually, good banking is very boring. Nobody talks about good banking. Even when you see the annual results of a company, the PE firms get a lot of recognition for their timely support. The promoters get huge amount of kudos for their entrepreneurial spirit and vision. Management gets great mention for their competence. But banks just appear on a list in alphabetical order in their annual report. So, they're taken for granted. So just good banking in itself is extremely boring. And not without fault, because the purpose of banking originally, when banking was set about, was to be a boring business. You were supposed to accept deposits, and those deposits were to, firstly, the banks had to garner sufficient trust among people who had surplus money to place the deposit with them, because they were parting with their own wealth. And secondly, they expected a return for the money that was made available to the bank. And the banks in turn then found other more paying avenues, good avenues, to invest that surplus money that they received as deposits in through loans. And so that was really the sum total of the game of banking. But as we all very well know, that banking over the years, in the last 100 years, has become a hugely sophisticated industry. And we shouldn't at all be surprised about that, because over these last 100 years, banking has been able to attract the best talent around the world. And that is why the industry has become so sophisticated. I mean, whichever way we look at the industry today, it is hugely grown in every way. We look at risk management, we can look at data analysis, we can look at product customization, we can look at treasury management, we can look at delivery channels. All of them are way beyond what they were meant to be when they started. And I think that is fine, because that's a natural progress, that's evolution of any industry. We would, in fact, in most industries, we argue that it hasn't progressed sufficiently in good time. But in this case, that is not a complaint. What is a challenge, which is together with the sophistication, is the complexity of banking has completely defied the original simple purpose it was built for. And that is, again, a problem of the talent that has come into banking. These are people who are very well paid. They are paid on incentives to do out of the box thinking. They are paid to be able to create something new, which the competition doesn't have. And that has led to the complexity. And if I look at complexity, there are many places for it, but I would just sort of broadly categorize them into three chambers. One is the whole advisory business that has started. When banks started, there was no advisory business. You took deposit and you gave a loan. Yeah. Now, investment banking on its own, the advisory side of it, is a huge, humongous business. In fact, there are many global banks that have a larger part of their business in advisory than they have in commercial transactions. There are boutique advisory banks who only do advisory and actually don't do banking as we know it, from the basics. The second big category is distribution. So it's not only money distribution. Now we distribute gold, we distribute insurance, all kinds of distribution, third-party distribution is now available through banks. And that has actually, again, become a very big part of the banking business. It's a very big part, particularly in the retail side. Its distribution is a very large activity. And then the third large category, which is the one that has probably caused most pain in the recent 2008-2009 financial crisis, and many times before that, and I'm sure will continue to be a pain point in the future, is proprietary trading. Banks were never meant to be principals. They were meant to be agents. They were meant to be a conduit. But for many decades now, banks have become proprietary traders. They are proprietary traders in foreign exchange. They are proprietary traders in commodity. They are proprietary traders in equity, in debt, in real estate, and so on and so forth. And within that proprietary trading, there are derivatives, which are built in to make it more complex, to give it more leverage, etc. It's all with the aim of maximizing, under the very noble guise of maximizing shareholder return. But it is obviously clubbed with individual vested interests in growing this. Again, all good, no bad in that, but it has added hugely to the complexity and has resulted in some accidents, as we have seen in the past. So broadly, I want to sort of start with that preface that banking has moved a long distance. A lot of it is for the right reasons. In fact, all of it is for the right reasons. All of it is thanks to the humongous, abundant pool of talent that has been made available to the banking industry. And obviously, in some areas, we have seen a fine line between greed and prudence tangle with each other or tango with each other to result in some accidents. And we've seen some of that. Let's move on the other side to the Indian banking scene. And we can go as far back as we want. Banking in India is a pretty ancient industry now. It was there 200 years ago. It's even longer. And but let's just talk about the more recent 70, 75 years of independence in that phase. As you all very well know, banking was a very private industry till 1966. In fact, it was 100% private. And only in 1966, when the banks got nationalized, or many banks, private banks, all the large ones at that point, got nationalized, that banking became almost 100% state. There were a few old private banks left out, but a very large part of the banking scene was brought into state enterprise. And if we fast forward to today, we are today about 60% state, and the balance is some combination of old private banks, new private banks, and foreign banks. But broadly, the state sector is large. And to me, the state sector, because such a large part of the Indian banking scene, is a very interesting category of banks, the PSU banks. And I'd like to spend the next 5-7 minutes on it. I feel that there are 3-4 things that are very important for us to understand about PSU banks. There is given their performance, given their service levels in the past, I don't think so we can complain too much about their service levels today. But again, relative to private banks, clearly they haven't moved as efficiently, maybe in some cases, but largely plagued by their past, plagued by their government ownership tag, etc. We tend to think of PSUs in somewhat of a less than great fashion. The first admission I would like to make, and I've had this all the 30-40 years I've been in, 30 plus years I've been in banking, is that the talent in PSU banks is as good, if not superior, to that in private and foreign banks. And the answer is very simple. I can explain it to you. It is like we say that the doctors in India are much better in some cases than some doctors in foreign countries, because they get a lot more to do. They get a lot more to see, because we just have such large population. We have such a problem health situation that, you know, a diabetics doctor in India sees a lot more than a diabetics doctor sees in some other countries. You know, people talk about Singapore and all that with high regard, but, you know, the number of operations that a doctor does here, whether it's heart, whether it's diabetic, whether it is such common related lifestyle diseases, is much better. It's exactly the same advantage that PSU banks have. They get to see a much wider canvas of the Indian industry, of the Indian enterprise, of the Indian business across size, across geography. You know, I mean, foreign banks deal with 300 customers in India at most. So whatever is their experience, it is as good as what they see in 300 patients. Whereas the PSU banks see millions. So I would like to put that up front. Having said that, we also have to clearly admit that PSU banks don't enjoy a level playing field. They do not have the advantage of compensation that others have, or stock options. They don't have the advantage of being able to hire as freely or as aggressively as other people in their sector. They clearly have the benefit of a job security, which the private sector doesn't have. But that benefit comes with its own challenges of the overhang of vigilance and CBI, etc. So I think there is sufficient ground to believe that PSU banks don't enjoy the same level playing field. And I don't think so we have to go into the merits and demerits now. It's anyway too late. It's only academic in '66 why they got nationalized in the first place. You know, there was clearly a political belief that that was the right way to go. And it probably, from the history that I have read and understood, it was probably the right thing to do. But it was not something that was supposedly for keeps. It was to solve a problem or to create an environment then. Things have changed since then, but we haven't changed the PSU bank the way they are managed. So in that, there are 2-3 things. I mean, the first real question is that, you know, whenever there is a problem, the government can turn to its state-owned banks to solve for that. So when we saw the demon happen, who were asked to do the Jan-Dhan accounts? It was largely the PSU banks. Today, we are seeing a COVID challenge, and who is being asked to provide most of the TLTRO or liquidity support to the smaller players? It is again the PSU banks. So they are called again and again to deliver on areas where, commercial judgment would not allow to happen. The issue is that we are not able to correlate that benefit they bring in terms of grave need with the cost that they absorb. Because nobody has actually done the exercise of costing the social objectives that they serve. Actually, my opinion is that all of the social, whether it is, coming out in terms of natural calamities or in terms of bailing out a particular sector or an industry, etc., whatever they do, that should be valued and quantified. And they should be given subsidy for that. And the rest of it, they should be made as accountable as any other bank is or as a commercial enterprise should be. Because otherwise it's very difficult to justify why they continue to rake up their NPA numbers and they continue to be hungry for capital infusion all the time. And their profitability still doesn't sort of sound impressive. So I think there is room for us to redefine a subsidy cost for any social objective. And that subsidy should also be available to the private sector banks. If they choose to do something which is unprofitable, they should also be given that. I think we can make that more level playing field. The second issue is that, is the government missing a trick on PSU banks by not encashing value and privatizing, rather than what is actually happening in reality is that there is privatization by default. The banking industry was 90% state-owned, is now 60%. So 30% of the market share, of a much larger market share than we had 20 years ago, is now with the hands of the private sector. Why wouldn't the government have encashed this value rather than just having given it away by leakage? The government took the first step of giving the private sector new licenses. But with that, they were given in competition to the PSU banks. So clearly, would it have been better to transfer licenses and get value rather than do it this way, or have done a PPP kind of partnership and got it that way? So that's another big question. And I think that question is still alive because there is, even today, I think there is room to see how we can take privatization further from where we are. I don't think so. The government should be in the business of bailing out banks on capital. And our capital needs are quite high for the banking sector. And once we go up the ladder of Basel requirements, that requirement will only get bigger and more challenging. The third subject that is topical for the PSU banks is really the consolidation. And I think that is already, the trigger has been pulled. I think we are going to see 3 or 4 big consolidated Indian banks. And yes, there will be a distraction in the very near term. But I think it's a very positive, progressive step in the long run. We need to have banks of size. We need to have banks of scale. And they have both domestic and global benefits to have that consolidated size and scale. And if the PSU banks are to come out of their challenge both for capital and for profitability, I think scale has to be the answer. Of course, with that, we have to see all the other hygiene factors of risk management, etc., employee motivation, etc. But in the macro picture, we need to have scale. I find it very surprising when we go to syndicate a loan for Tata Steel, that we have State Bank of India and Dina Bank both bidding as aggressively as each other. And it just doesn't make sense. It's like saying, I'll take it upon myself. It's like saying Centrum trying to compete with Bajaj Finance on, a retail product. I mean, it just doesn't make sense for Centrum. Similarly, I don't think so it makes sense for Dina to be doing that. But I think that is where we are. And I think the lack of scale makes it very difficult for the PSU banks. And I think that will, so either they should be moving by category, or they should move by scale. Let's just, I think what is relevant going forward, because all of this, whether it's the private sector we talk about or the state-owned banks we talk about, they are all relevant only if we have a good understanding of the marketplace. And on the marketplace, I can say with huge amount of confidence that the potential for credit, and credit not only as it stands today, but credit growth over time to come, is so large that there is no challenge of market share. So anybody who conducts their business well today and has sufficient liquidity and capital cannot go wrong. So you have only yourself to blame, because there are very few markets in the world of our size, India size, that have this amount of demand. And I say that with huge amount of data to substantiate it. If you look at the borrowers today, a very large proportion of borrowers are either unserved still or underserved by the formal institutions. So I think the easiest one to take, the segment to take, is MSME. So of the registered MSMEs, I'm only talking about the registered. These are the MSMEs who are in the formal sector. Only 16%, 16% have access to formal institutional credit. All the others have either no access, or they have to go to expensive money lenders or family, friends, etc. From rough estimates that have been done by leading agencies, if you add the formal and informal sources that are available, even then there is a gap as we speak today of 25 trillion rupees that is not at all met. This is after the money lenders and everybody. So there is a very large, so forget about economic growth rate. We have to find ways of reaching these people, finding a way of doing banking, lending to the bottom of the pyramid in small ticket items and make it profitable. And that is by itself a huge challenge. So I'm not belittling that problem, but it is not for lack of demand. We have sufficient demand. So I just want to establish that. If we look at the subject of this session that you all are having about moving from a 2 trillion to a 5 trillion economy, the math suggests that at some stage, whenever we trigger off growth again, post-COVID, we will need to grow in the high single digit kind of range for a number of years to get to that number. And looks like we are all aligned, the government is aligned, the industry is aligned, we all want to get there. And hopefully over time we will. The thumb rule is that the banking credit market grows at 2 to 3 times the country's national GDP rate. So the credit side of banking should grow at least at good double-digit teens kind of rate or higher. So I'm saying there is a huge underserved market today, and there is potential for continuing growth. So the cake is getting bigger, and a very large part of the cake is still available for dessert. So I think, we can have the cake and enjoy it too, kind of thing. So that is one. The other big issue we have in India, and I'm relating this to the rest of the what I've seen elsewhere in the world, is that India is the only market in the world of such size where the debt market is smaller than the equity market. in every other country, starting from Singapore, Hong Kong on this side, Korea, to Europe, to the US, to UK, the debt market is of several multiples the equity market. So we are not even at several multiples. We are not at par. We are actually at a fraction of the equity market. That needs to be corrected. And you would say, okay, but why is that relevant to banking? That is relevant to banking because a lot of the banking capacity is being crowded by highly rated borrowers who actually don't need to come to the bank. They should be dealt with in the debt markets. The banking capacity to be able to survive and grow and meet the needs of the future have to be reserved for investments you cannot just make on a chart. You know, they should be companies that you have to, I mean, why do we need a banker to do 20 pages of write-up and hundreds of hours of research to lend to a Hindustan Lever? I mean, the debt market should make that investment. It's highly rated, highly covered, very well written about extensively. It's a well-known, there's a track record, there is a, there is a depth and size to the resources of that group and the company. So, but today, we make no distinction. So it's all clubbed into the banks. And that is why the bankers are happier also from a commercial point that, we play safe and we also give to the rated companies. And that's why there is a huge flight to quality every time there is a small unnerving in the market for whatever reason. And we get the same big corporates borrowing at even lower and lower and lower rates. So it's not so much about the micro, it's really about the macro view. That unless we make more capacity, banking capacity available, you can keep issuing as many licenses as you want, because the need of the big guys is only going to keep growing. It can absorb all the extra capacity that we create. So unless we find ways of releasing capacity, together with creating more resources, we have to also release capacity. Otherwise, what number we are saying today, 16%, might improve to 20%, but it's not going anywhere close to 50, 70, 80%, because there will never be a capacity. It's not a question of somebody looking at a credit and saying, no, there is no room to look at that credit. There is only that much capacity. So I think that to me is. And finally, I would say that there's going to be a lot of continued excitement in banking. So for all of you who feel that you'd advise your children that banking is now not the right place to be or the right place to be thinking about, I think you should think again, because I think banking is going to be a very exciting career prospect for young people. I think even more exciting in the future than it has been so far now. And I say that because there's going to be a lot happening. I mean, I think artificial intelligence, one of the areas where that is going to have a huge application is going to be in banking. I think blockchain is going to be a massive transformation for banking. I think we don't know if we will, how quickly we will see it in India, but there are many markets in the world that are going to legalize, have already started, and many more will legalize cryptocurrency. And that'll be a new phenomenon. Hundreds of years ago, we moved from barter to currency. And now we are moving from currency. We're not moving, but we are complementing currency with crypto. I think there are a few very progressive markets which offer today Sharia banking. And Sharia banking, just for anyone here who's got any sentiments, let me tell you, is not religious banking. It is just a principle of no interest banking. That's how we can all look at it, who don't have the religious fervor. But clearly, it's a very big activity, particularly in the countries where we have a lot of people from the Muslim community, as we have in India. So I think that is one. IBC process, I think, will, it takes its time. And I think we've seen the teething problems. We've seen the litigation around it. We've seen now some challenges during the COVID period around it. But over time, that will settle, and that will dictate how banks have more teeth and more confidence in lending in the future. So I'd like to sum up here by saying that, some banks may come and go. They have, many banks that existed when I started my banking career don't exist today. But many more have come into existence and prominence. And that may continue to happen. Banks will come and go. But banking is here forever. Banking is not going anywhere. And I think it will come with its own twists and turns. But banking is here to stay. Let me stop with that so that maybe I can take a few questions if there are.
I think, Jaspal, this was an extremely educative. For me, I think most of us have a pessimistic perspective when we talk about public sector banking, and I think you gave a huge vote of confidence. I wish Sunil Mehta was here. He would be listening to your perspective. And I think one of the issues that I wanted to talk about is really this whole phenomenon where NBFCs now, some of the NBFCs are as big as a bank, and maybe sometimes bigger than some of the smaller banks as well. But what do you feel in terms of the regulation on three baskets? I think we have PSU banks who have DFS and RBI. So you have twin people regulating it. And then you have private sector banks, which are RBI regulated. And then you have NBFC, which kind of is not, RBI monitors it, but it's somewhere we may be over-regulating the PSU banks, and we may not be giving NBFCs, which are probably as big as some of the banks, that backstop lender of the last resort facility that banks have with RBI. So, do you want to make a comment on that?
So I think, Sunit, these are trade-offs. So we have trade-offs where NBFCs have a lighter supervisory touch to them, but then they don't enjoy the backstop facility, or they don't enjoy the trust of the market in the same way. And for that reason, there are not many NBFCs today that are allowed to accept deposits because the RBI doesn't allow that in any new licenses, but even the old ones, as over time, are moving away. So I think these are trade-offs, and I think one has to choose where one wants to play. Just like an investor can choose whether he wants to be invested in a fast-growing NBFC or he wants to be invested in a stable bank. I think it is also for entrepreneurs to play that role. But I don't think so there's a right or wrong here. Clearly, what we have seen in the recent past, the accidents that have occurred in the macro sector have impacted the NBFCs more in an immediate way. And so I think that is an issue by itself.
Yeah.
But other than that, I think one will have to live with the rules. We always have a wish list in every sector.
I think you alluded to one more issue, which was privatizing banks and the government probably not getting the upside of that option. In your own sense of sort of meeting a lot of overseas bankers and overseas investors, do you think there would be interest in strategic FDI in banks if the government was to go through a process? What's your own assessment?
So I can tell you that in '94, when ICICI and HDFC were given licenses, there was a very huge interest in the Indian banking system. I think in 2004, when the next two licenses were given, again, there was a huge demand for banking license. And more recently, clearly after 2008, that appetite may be different. But those two times, clearly, there was a lot of demand. But even today, I think to have a banking license, I mean, we saw what Watsa, the keenness that Watsa showed in CSB. So I think if you can customize a transaction to the investor's sort of preference, clearly there will be a lot of demand. My point on that subject is was actually not so much about whether it goes to a foreign or a domestic investor. We should get value. Actually, one of the smartest deals that get very little mention in the media at all was the Bank of Punjab deal, Centurion Bank of Punjab deal that got sold to HDFC by Rana Talwar. I mean, he made a killing in 2008. He bought broken banks. Centurion merged it with Bank of Punjab and then sold it to HDFC. And that was, that was at that time, the price that was paid for it was actually more premium than HDFC was enjoying. Bank was enjoying. So I think there are deals to be done. And why are the state-owned banks not getting that benefit is my concern.
I think,
yes, I'm getting a lot of appreciation for your talk, Mr. Bindra. I must say this because one of our EC members, Ms. Madhulika Gupta, ex-banker, she wrote, Mr. Jaspal Bindra's talk is very interesting and happy to note that he has expressed his views on PSU banks versus private sector banks. Quite frankly, Mr. Bindra, thank you. That's what she has replied when put on the chat.
Thank you, Ms. Gupta.
And Mr. Vaishnav Madan Bajrang Lal, once again, he said really a lot of courage required to talk on such issues. Very lucid and to the point. Very informative session. Thanks, sir. And as far as I'm concerned, I have something to say. I think we lived in a simpler life where we knew coffee means just like one thing, tea means one thing. Now coffee means like 100 varieties. Same with the tea. Now banks have become like boutique banks. Now how? We are so confused. Where to go? Where to go? Because every bank is doing different things. What they have come for. Now they're doing that lending, but they're doing different things. So it is very, very confusing for Aam Janta. It is like a boutique banking of a different, it's a lot of learning in this. We need to really get educated. I'm saying it because, you know what I'm talking about. It's no more a simple stuff. It's a lot of complexities, but you have explained it very beautifully, how it has evolved and it is still evolving. So let's watch our picture baki hai.
Right.
Sumit, you can.
Yeah, I think there are. I don't see many questions, but if there are any audience questions that you are coming across, there are lots of points that Jaspal has talked about, and probably one area which we may talk about is, by and large, most central banks have not liked the concept of cryptocurrency, and so. Do you think it's something that it's more being an ostrich? You can't avoid it for too long, or what's your view in terms of risks that as you see?
Yeah. So today, clearly, it's not something that you can touch and feel. That in itself is a problem because our sort of mental concept of a currency is something that you can touch and feel. Yeah. And even in the old days, whether it was gold or silver or nickel or whatever, you could touch and feel it. And now, of course, we've had currency and we've got plastic and all of that stuff which we can touch and feel. But more importantly, I think from a central bank's point of view, the logic is very simple and clear. If there is no backstop, how do you deal with something that there's no known backstop? Every currency is backed by a central government, by a central Federal Reserve or whoever is the regulated authority in each country. So I think that is a gap. That what happens, where is the go-to point It can't be a website. You know? So I think the central banks will struggle with this again. But my view is that this may be a weak beginning. It may be a prolonged lagged lead time before it happens. But things will change. I can tell you one small story of not that long ago. I used to then work for UBS. I think this was 95 or something, 94, 95. And we went to one of the leading banks in India and told them we then had the mandate for Swiss PTT telephone bidding license in India. They were bidding for a mobile telephony, and we had the mandate to sort of get them financing for it. And we went to the leading bank, one of the leading banks in India, and they told us, but we can't do this because you have no inventory. What do we finance against? There is no collateral, there's no inventory. I mean, we need something on the ground. And we said, sir, the best is there is a projection of minutes of usage into the rate per minute. And that is, we'll be conservative in that estimation. And they said no. And, this was only 95. And, we know in the next 10 years, telephony was one of the biggest recipients of bank financing, whether it was Airtel or whoever, all the companies, Voda, Idea, Tata Tele, all of them got huge amounts from the same banks that we approached in 95. So, in very large numbers. So I think, things have this uncanny way of suddenly becoming very acceptable and doable. And then more and more people do it. And then it's all great. I think it's important to have these green shoots in view because they could become big. Like who would have said even 10 years ago that the biggest entertainment sector is not going to be movies or theater or music. It's going to be gaming. Gaming today already is the largest entertainment revenue earner in the world. And it's likely to continue to exceed the multiple it's ahead of today by several times in the next 5 years. And we all sort of wonder, how did we miss this? Why did gaming not appear on our scene? And today, when you reflect backwards, you see, I mean, it has no language barrier, unlike music or movies. It has no cultural barrier. It's available anytime, anywhere, whenever you want. So, so it's got all the benefits of what OTT brings to the other entertainment scene, but it's also got some, benefits of no barriers across a larger population. So I think, things like this will keep happening.
So coming on the same point, do you think Basel should get active on this cryptocurrency regulation and probably bring some confluence of thinking across the global banks? Would that be?
I think, Sunit, that's putting the cart before the horse. I think we have to have a lot more acceptance around the world. And I think that will take time because of the first two reasons we talked about. It's not tangible. And secondly, it is not backed. So maybe we have to get to a level where those happen. I mean, the tangibility in today's world may be not that relevant, but clearly some level of backing has to come. And I think as the volumes will continue to grow, etc. And for all we know, I'm not, I can't predict the future. So for all we know, it might just fail. We could have accident because what is happening now is there is not one single currency. There are hundreds of cryptocurrencies now in circulation. And, some of them is fair play. Some of them may or may not turn out to be fair play. So I don't know. But I think, these kind of things we should, there should be some R&D sort of time for it. But this may be a long one in the making.
Yeah, I think, my personal view is that those are the people in the global bodies who look at IMF and maybe Basel and others, who look at financial markets at a larger perspective. probably should apply their mind to this subject, because trading has already started to happen, and in some areas, some people are already doing all of that. They're investing in it. So before this balloon becomes too big in terms of retail investors actually getting in directly, I think we need to have some sense of how it sort of shapes up. So I think that's an interesting perspective. You did mention about this, and I have been talking about this thing also about the debt markets, and I think maybe if you want to amplify the fact that debt markets are smaller than equity markets it's a huge issue, and the fact that if we want access of capital available to a lot of players, probably we need to figure that out. Closer home on a topic that I am very interested in is infrastructure financing, and I realize that the lack of debt markets actually creates a huge problem of such kind of, and the fact that maybe pension funds and insurance funds cannot enter in via that route into infrastructure financing has been one of the key concerns, or why we still have a huge issue when we think in terms of infrastructure financing availability. And also the fact that when we think of InvITs and REITs today, where probably there is a lot of local currency available for investment, but they are not looking at these avenues as much as overseas investors are looking at. And there's nothing wrong with that, but I'm saying that, I don't see the insurance and the pension funds and the government pension funds as well participating in this market as actively as they can, and profitably so. So I think definitely that's one area which probably needs some focus on. You would like to make?
Yeah, sure, Sunit. I think, first of all, it's an anomaly that a market of our size doesn't have depth in its debt market. That's just a simple thing. We should have a larger debt market than we have. And it's a chicken and egg story, because actually the banks have not let the debt market also prosper. Banks, whatever they like, they just want to hold to maturity, and they don't want to sort of put it out in the market. And the headaches of dealing with market discipline and market processes and market mechanism is just too much work for the treasury guys. And they would just say, we'll take it on our books. But really, a bigger cause is being lost, because if we had a lot of the borrowing go straight to the debt market, and secondly, the debt that the banks put on their books, if they had a way of laying that off as and when they required, then I think that combination would give the banks so much more leverage than they have today. Today, the banks are very happy that they have 9-10 times leverage on their capital. But actually, if the debt markets were available, they would have 25 to 50 times leverage. And, even if they made a small percentage, whatever percentage you make on 9-10 times leverage on the same spread, even half that spread, if you have a 25% leverage without additional risk, then, you can make the maths yourself. You'll be twice as profitable. So both from a profitability point of the banks, as well as from the capacity creation. I think for the PSU banks, I think it is more a capacity creation problem. I think the foreign banks are already doing this churn very well. That's why it is possible for foreign banks with few branches only and only dealing with small clients to make $1 billion in profits annually in India. And more than one bank does that. Whereas for PSU banks, most of them are nowhere close to that number. So I think because they are not churning their capacity sufficiently. And it's a little bit being lazy, little bit being, but also the enabler is not there. I think if we have the debt market enabler, so I think the benefits are, I think people are looking at very selfishly, but actually the benefit is there for all to share. And only a few smart bank treasuries are benefiting from it today.
Just before I wind up, there's one last audience question, and I might like to put that over to you. What's your view on the sort of post-COVID situation and stressed asset, IBC? I mean, this whole big web of issues that are there around it. Is there any comment that you have, considering that COVID is going to actually maybe accelerate some of these issues in the banking system?
Yeah, so I think the best way of looking at the post-COVID era is to not think of it as all bad. I think there'll be some good that will come out of it as well. But there will be some challenges we have to deal with post-COVID as well. So the main, I think we've already seen a very dramatic shift to digitization between pre-COVID and current time. You know, I see now people being very comfortable making their daily household activities through online platform, something they probably could have done as easily before, but just chose not to do because there was no reason to. They had enough people at beck and call, and even if they had to get to a digital instrument, it was to make a phone call to get their provisions or whatever. Now they are able to do that without having to speak to anyone. And so I think we will see a lot more of that happen. But the issue, I think, which we will face challenges with, and there's been a learning, across all crises. Clearly, compliance was a big outcome of the financial crisis of 2008, 2009. Prior to that, compliance was, an also ran function in a company or in a bank. Compliance suddenly became the domino function post 2008, 2009. I think like that, some level of technological process sort of enhancement, improvement will be a key factor, I think, post-COVID. I think there is going to have to be almost a foolproof way of being able to access and deliver to your customer, irrespective of which industry you are in a digital way, in an online way. I think everybody will need to find a way. It will be different in different places, but I think everybody will need to find a way of how it could be done, either through, for people who can do it directly, create the apps, etc. They will do it directly on the instrument itself. But there'll be others who'll have to find via medias of partners or collaborations, which will make it happen for them, depending on the business or the nature of the business they are in. The second, I think, issue that is going to be very relevant is, I think, liquidity will become at a premium. I think there will be a premium for liquidity. There was a time, I remember, in the 90s when, overnight banking call rates were at 100%. Those were bad days. But at that time, people were willing to pay for a line of commitment as much as 0.5% and 1%, just to have a line of commitment made available to you. Of course, for many years after that, now commitment lines are available for free. But I think there will become a premium on liquidity. So I think liquidity lines will be at a premium. Banks will not only, trade agencies will not only value what you have on your balance sheet, but they will give appropriate premium to what lines of credit you may be able to access, either as equity or as debt. So I think there will be that focus on liquidity. And the last thing I think will be that clearly how people manage their own setups. There's a lot of talk about working from home. There's a lot of talk of that becoming a permanent method of working, etc. And I think people will learn around that because I think different things will work for different people. And over time also things will work differently. But clearly for the near term, I think there will be some adjustments that people will make about how they can work efficiently in terms of day-to-day activity. So it'll be a little bit of a cultural setup change.
Yeah. So I think with these things, we've had a very interesting session, and I personally, I think we should catch up sometime. This is a session I wouldn't have liked it to end, but I think it was very nice to hear your freewheeling perspectives on a lot of things with respect to banking. My son has become a little old, but maybe I would have told him that he should have taken banking sometime for this. But it was great having you, and I think Rajalakshmi ji, you would like to. We have a tree that we plant for all our visitors, grow trees, and so that's a small token from our side in our effort to green green the country in your name, and that's what the chamber is doing. Here is uh, the certificate which will be sent to you on mail. I hope so. Many thanks. Rajalakshmi ji, would you like to add a comment?
Nothing. Mr. Bindra, you spoke so well. You really walk tall. I don't know how tall you are, but you walk tall. Thank you very much.
Thank you so much, and thank you for the tree, and I'll cherish that. Thank you.
I think I'll just point out, because of what you talked about digitalization, we have a session on retail banking today afternoon at about 3, which is focusing on impact of digitalization. We have another one tomorrow where, interestingly, Arundhati is attending, which is on fintech. She's joined Salesforce as a CEO, and so we have a couple of people from Google and Salesforce talking about it. So yeah, I think it's the current rage right now.
Sure.
Thank you.
Bye. Bye.
Bye.
Thank you very much.
Welcome. Bye-bye.
Caroline. So our next session is on a subject that is actually being derived from what we discussed in the morning, stressed assets.
What is the
stressed assets for a long time. And I think, so we would like to invite, and many thanks, Caroline, to present something on bad bank. I had discussed with with World Bank, and they very kindly arranged for Caroline to present a global perspective of several bad banks, and what are the messages that might be there. I mean, we have to derive them, but she's made certain comparisons. She's done some interesting reports also on this, but for this presentation, she's looked at what might be useful for us to consider as the debate in India on bad banks is happening. Mr. Pankaj Jain was supposed to join in, but I have a feeling that he might not be, because Parliament session has started and Government of India civil servants are required to be also attending to those matters. But I have with me also in this session, I had requested him to come in as a moderator, but I have Supratim Sarkar, who his day and maybe the night job is also managing stress in different corporates, and he works with State Bank of India in the SBI caps, but corporate stress is something that he is kind of completely alive to, particularly the large ones that we are talking about. So without much this thing about delay about it, and I think a lot of us would like to hear from Caroline, who's done a lot of work in this subject and is eager to present to us a few slides for benefit of all the viewers. I've had an opportunity to brief Caroline about the issues in India, somewhat in a quick way in the last 3 or 4 weeks, and hopefully she's come up with some points which we should discuss. Maybe since Pankaj Jain is not there, I would then request Supratim to come in and react from whatever he knows about the bad bank that is being talked about in India, and also, take cues from what Caroline is talking about. Over to you, Caroline.
Great, thank you so much. And good afternoon, ladies and gentlemen. I'm going to share my screen, so if you can give me a thumbs up if you see the presentation coming in, that would be great. Give me a moment. Share screen, hop, from beginning.
Yes.
Okay. So can you see it? Wait a moment. Yes, can you see it well? Is that okay?
Yeah.
Okay, super. All right. So the purpose today of my presentation is to give you an overview of international experience regarding public AMCs and the lesson that we have learned from those. The main message are that a public AMC is not a silver bullet to deal with high NPLs. The case studies will show you a mixed track record. They are costly to establish and run, and therefore it's important to meet certain preconditions. Nonetheless, they can be a very useful tool as part of a comprehensive strategy to address NPL. So first, what is an AMC? Asset management company. It can be a public, private, or joint public-private entity which manages non-performing assets removed from the financial system with the goal of maximizing the recovery value of this asset. So there is an assumption that this asset has lost value because there is a banking crisis, and therefore the MC is here to take the time to recover and to limit the cost for the taxpayer. So AMCs, public MC, were created to support bank resolution. And they have been created as two entities in history. The bank resolution entity is the oldest model. And it is simply a tool, it's a kind of a receiver. So in this case, banks are closed and all the assets are taken over by this AMC, this receiver, and the receiver manage. They don't purchase the asset, and this is typically the case of the RTC in the US in the late 80s. The other model, the asset purchasing AMC, is the one on which we're going to focus today. And in this one, banks remain open. They sell their assets to the AMC, usually against bond in consideration for bonds. And in that case, the transfer price is a key issue. Government inject equity for working capital and for paying the bonds at inception. And if you look at this model in Europe, after the global financial crisis, these AMCs were structured as public-private, because the government wanted the banks to have some skin in the game, but they also wanted to avoid consolidation with public assets. As you know, there were huge fiscal issues at the time. So a public AMC can have a lot of benefits. The first one is that it forces the banks to recognize the losses. So take the case of Ireland with NAMA in 2009. This was the old IAS 39 of recognizing the losses, and the recognition was really, really slow. So nobody really knew what the value of the asset were in the bank's balance sheet, and there was a lack of confidence in the bank's balance sheet. So NAMA was created to really put an end to this drip effect and really recognize the losses once for all. At the same time, the banks were recapitalized, and the issue was to have a clean slate. The AMC will also improve asset quality, liquidity, and income for the banks, because the banks are transferring a non-performing asset against a bond, which pays a coupon, so they get income. Generally, the AMC bonds have been used as collateral for the central bank for the purpose of getting emergency liquidity. So generally, they improve the liquidity. And very important feature of public AMC also has been the economy of scale and bargaining power. So in several of the economies, debtor, borrower very often have different banking relationships. So they have multiple loans. And when the AMC consolidates all this loan into one single box, one single AMC, even the performing loan, this is what NAMA did, then the MC has much more bargaining power towards the borrower than a bank would have. And this also allows the MC to package the asset in batches and attract international buyers. And a bank would not be able to do that at an individual level. And finally, a public MC can help banks to focus on financial intermediation and restart credit rather than focusing on recovery. However, if they are not designed properly, international experience shows that AMCs can do more harm than good. And below are a few examples of the pitfalls. One is undue political interference. And this happens when some borrowers are treated differently. And one of the solutions is to protect the AMC in its law against political interference. So for instance, in the NAMA law, it is a crime to try to influence NAMA. Another pitfall is a failure to dispose of assets in a timely manner. So there's an inherent trade-off in a public AMC because on one hand, the MC needs to go after cash very quickly, but going after cash can result into fire sale. So they need to wait, but at the same time, they cannot sit on the asset for too long because they will not recover anything. So there's this inherent trade-off, and one good practice has been to provide a sunset clause in the law because this forces the IMC to have a strategy for each of the assets in terms of time disposition. Another pitfall is the mission creep when the mandate of the AMC changes over time. So in the AMCON, Nigeria law, the asset management company can purchase a performing loan, very strategic, and this is what they did. And it's not really clear how this improves financial stability. Another pitfall is a weakened credit discipline, and this happens when the AMC will have subsequent asset purchase at inflated price, because in that case, what the banks will do, they will simply wait until they can get a better deal from the AMCs. You also have another issue which happened in Asia in the late 1990s, the issue of strategic defaulters, whereby companies that can repay on their debt will willingly default because they expect to repurchase their loan from the IFC at a lower price. So to avoid this problem, the determination of the transfer price is key, but also a one-time purchase from the AMC once for all. So because of these issues, we have come up with some preconditions for public AMCs when they involve taxpayer money. The first one is a systemic crisis and public fund at risk. And it's because having high NPL is not a condition sufficient in itself to justify a public AMC. If banks have high NPL, but they are well capitalized, they should simply take the hit, provision, get external expertise if they need it, but they need to work it out and have specific workout unit. The taxpayer money should not be involved. But if the problem is systemic, this is when a public AMC may be needed. The second precondition is a solid diagnostic of the assets to be managed, a critical mass and homogeneity. Because if you have a system where all the NPL are SMEs loan, so you have millions of loan with very different borrower and very small, an AMC may not be the best answer. Public AMCs have worked best when they had a small number of very large and complex NPL to manage. And therefore, the homogeneity of this asset is key. So you need to know whether these assets you're talking about can lend themselves to recovery. In other words, if you have a lot of insecure loan in the system, an AMC cannot do anything. The third point is a tradition of institutional independence and public accountability, and this is really, really key. The distressed asset business is prone to corruption because it's very hard to determine what the price should be. And therefore, strong governance is key. However, it's important to bear in mind that AMC can improve practices, but they cannot completely change the system in which they are set up. So that's very important in terms of expectations. And finally, the other precondition is a robust legal framework for bank resolution, debt recovery, and creditor rights. In a lot of the case studies, these were not there, but a concurrent reform were implemented together with the AMC. So what we've seen from example is that successful AMCs have a strong commercial focus. They have professional distress asset management staff. They have a strong board with private sector presence or international experts. They have a key performance indicator, and one issue to be mindful of is the compensation of the staff. Basically, the staff has to work themselves out, because it's when they are out and they have finished the job, it's a key feature of the AMC success. So you will see in the successful AMCs that they have very regular review from their external auditor, but also from Parliament. So accountability, annual report, transparency is really key. The other operational aspect is to have plans to dispose the asset, to sort them out in different category with different timing to offload them. And finally, adequate and timely funding, because at the beginning of its life, the AMC will probably not go after the cash or will not have an opportunity to get cash. So they need funding to pay the coupon on their bond for their working capital, but with the expectation that from year 3, the cash they collect would pay for their operational cost. So in a public AMC, the transfer price is a key issue, because if it is too high, the AMC will not break even. But if it is too low, the banks have a big hole. So it's really where you put the losses. And the principle is that this transfer price should be transparent to the market. And in Europe, for instance, there was a market-based process with external third-party appraiser to determine what the transfer price should be. This graph is showing you that transfer price is more an art than a science. And in Europe, the choice was made to apply an uplift on top of the market price because it was considered at the time that the market was generally depressed, and therefore it was important to apply this uplift. So if you look at this graph, it just gives you a perspective of what the transfer price was at the time, between 22 cents and 35 cents on the dollar. So it's important to realize in terms of expectation of what a fair transfer price could be. So AMCs work better when they are part of a comprehensive framework to address NPLs. And this requires actions on the part of the banks. So, for instance, a very strong bank regulation and supervision to give an incentive to the bank to provision. Because if they don't provision on their loan, they have no incentive to transfer to the AMC at a very low transfer price. They will not. So the strength of the supervision to give this incentive to the bank is very important. Also, a very strong framework for bank resolution, because if banks know that, well, if they don't perform, they can exit and they can be resolved. This is also a big incentive, right? They have an incentive to perform in this context. So you also need to complement the bank supervision and resolution framework with actions on the part of the borrower to facilitate corporate restructuring. So these are the informal out-of-court framework, formal personal corporate insolvency law. And then something also to bear in mind is whether the tax laws provide an incentive for corporate restructuring. So to take an example, if a borrower is going to be taxed when the loan is returned on the portion of the loan that is returned on, and if the lender cannot take that into its loss, profit and loss, it's not a big incentive to restructure. So tax laws have to be conducive. So this little graph will illustrate the different process between the informal restructuring framework towards the formal ones. And the key message here are, on one hand, an AMC, a public AMC, will never take all the NPL out of a system. They will only take a portion, but there are a lot of bad loan that remains in the banks. So the banks need to be the tool to manage them. In Asia, in the late 90s, AMCs were given special powers. And in particular, they had the capacity to appoint a special administrator in company to facilitate the restructuring, and without going through court. And this was a special power because the banks could not do it, but the AMC could. And what happened in that case is that the bank did not want to participate in informal workout because they felt that the special power of the AMC would put them at a disadvantage. So it is better to modify the general corporate insolvency framework rather than providing special power to the AMC. And the other message here is that it's really good to have the whole hierarchy of informal framework out of court towards formal, because in order to work, the informal workouts need an incentive. They need the stick, which is the insolvency and bankruptcy. Now, let's go into some practical case. The RTC in the US and Securum in Sweden are the older generation. And the common feature is that they didn't purchase assets. So transfer price was not an issue. They were extremely successful because at the end of their life, they had only 2-3% of the assets in value left on their books. However, they both benefited from a very strong economic recovery after they were created. So that was a key feature. In addition, the RTC was really successful because they only had 20% of NPL in their books. Most of their assets were performing because they were given all the assets of companies that failed due to liquidity concern. In Sweden, Sweden benefited from a very strong bankruptcy law, and 70% of the companies that had loan transferred to Securum were forced into bankruptcy. So that was a key issue. Regarding the Asian crisis and aftermath in the late 1990s, I will simply take two examples here between Ibra in Indonesia and Dana Harta in Malaysia. These AMC were created exactly at the same time, but they had a vastly different outcome. If you take Ibra, Ibra was plagued with governance issue all its life, and its law was silent on the governance. So it was very difficult to think about it. The law didn't protect Ibra. In addition, the law gave Ibra a big mandate. They have to resolve the bank, they have to administer deposit guarantee, they had to recover misuse, liquidity support, and then at the end, they had to manage bad assets. So in practice, they only went to the management of bad assets in the last 2 years of their life, where they recovered 87% of their assets. So this very much contrasts with Dana Harta, because Dana Harta had an extremely focused mandate. It was manage, sell assets. They had a homogeneous NPL base, so they carved out only 3,000 loan. It's not much. 3,000 industrial and complex loan. And this represented 70% of the total NPL of the financial system. So they in a way, they were lucky with the asset they got. Now on to the current ones. So NAMA in Ireland is considered as extremely successful because 10 years after being created, NAMA has repaid all their bonds, all of them. So that's a key success factor. Their life has been extended because they receive real estate assets that were unfinished. One of the key success factors of NAMA is that they had a lot of assets in London and in the UK. And at the time they started, the UK market were doing quite well. So they were able to sell rapidly. And in an AMC business, cash is king. They need to go after the cash. So they were able to create a lot of cash by selling UK assets while they're waiting on their Irish assets. You can compare this with the experience of Sareb in Spain. Sareb took more time because Sareb was purchased 200,000 assets, so it's much more important. The recovery has been slower. Both of them, very important feature, were given or purchased real estate assets. So they had something to recover. So key consideration for India. Below are a set of questions you may want to ask yourself if you want to set up a public AMCs. The first one is really which assets would a public AMC manage? Are you talking about legacy NPL in state-owned banks? Because in that case, you may want to look at the vintage. Often, the older the NPL, the more difficult it is to recover a good amount. But you may also have an issue of transfer price, because how can you determine a fair transfer price when you have public banks selling to a public AMC? So this may be tricky. Are you talking about new NPL due to COVID, which would be more SME or individual borrower? Because a public AMC may not be the best answer. And more importantly, what kind of collateral do these assets have? I've heard in the previous session that you had a lot of infrastructure NPL on the books. And on this one, there are a few considerations. Because if these assets are unfinished, there will be a need for fresh money and a lot of fresh money to finish them. The investment would be typically recouped over the long term, because this is typical of infrastructure. And that means that expectation should be realistic. When I gave you the example of Nama and Sareb, the idea was that they had real estate and they were going after the real estate. They enforced the collateral, they sold the property. So the idea was going after the cash very rapidly. If you have infrastructure asset from corporate entity, the recovery may take longer. So another question is, why are banks unable to deal with NPL? At the end of the day, it's their job to manage distressed asset. It's part of their life. So if there is an incentive problem and the bank don't have an incentive, then you may want to look at governance issue or that supervision issue. So that's a different problem. And that's a problem that the AMC cannot solve. More importantly, what is being done to stem the flow of new NPL? And that's the critical issue, because you may want to transfer the NPL to an AMC, but if the flow does not stop, the underwriting practices are not vastly improved, then you defeat the purpose. The AMC can be useful, but will not really solve the problem. Another question is, why are the ARCs not able to step into the challenge? So if, for instance, there is an issue of transfer price, the AMC may have the same issue. And then the last point is, where would the funding for the AMC come from? Because at the end of the day, if the AMC is not able to enforce the collateral and go after the cash quickly, the AMC will need a lot of funding for its working capital. So where is it going to come from? Finally, some alternative considerations. So many countries with high NPL have not set up a public AMCs. I will give you a few examples. Greece, typically 45% NPL ratio in 2016, so huge. However, most of those loans were SME borrowers, so non-homogeneous loan with a protection for the borrower on the mortgage when they had mortgage. So the framework was not conducive, and therefore an AMC would not have made a difference. So in this case, what was done is to strengthen supervision, to give the bank some supervisory targets instead of some supervisory target to force them to sell. And when the transfer price started to go really, really low, like 10 cents on the dollar for insecure portfolio, you saw a private market over the last 2-3 years. You have seen a lot of private distressed asset firm coming to this market, but it means the transfer price has gone really, really low. Two other examples in the Baltics, NPL reached 20%. NPL rate, but all of these were individual borrower with mortgage, often in foreign currencies, and the banks were large Scandinavian banks with a lot of capital. So they could just take the hit, recapitalize, help their subsidiary to deal with specialized workout units. Another example is Turkey. Turkey, the NPL have increased. However, there is an issue of recognition of those NPL. They are private AMCs that are able to deal with small exposure, and they are governance issue with the large exposure. So an AMC was not deemed suitable either. What has been done in those other countries are focus on the insolvency and bankruptcy reform. So I've heard in the other session that you really had a state-of-the-art IBC, but the issue was really ramping up implementation capacity because it takes time to get the staff needed at the court. This framework could be enhanced with the pre-pack for SME, and maybe we complement it by personal insolvency if there is an issue of dealing with the COVID borrowers, a small MSME or really personal. When we mean personal insolvency, it's not just a framework. If you take the case of Ireland, they had a lot of mortgage borrower in distress, and what was done is put a system, change the law, but put an insolvency service, track all these cases, and also professionalize the industry. The other point to consider is the type of London approach. So I understand India had that with the CDR. But what we've seen in Europe after the global crisis is that this London approach was refined to also fit the case of individual borrower. And in that case, it was very much about having a consensual framework for debtor, then also making sure the individual borrower would understand their obligations. Because when you have an informal workout, both sides need to keep their contractual agreement. Another alternative consideration is the reform of the state-owned banks, if the main problem is with NPL in state-owned banks. And then a last aspect is corporate release scheme, which we are seeing right now in times of COVID, because in that case, it's not so much an accumulation of NPL that is a problem, but it's the fact that the corporate sector simply cannot repay because they are in distress. And in that case, it is more effective to try to keep viable company, which are viable just for a short amount of time to keep operating. Thank you so much. Let me stop there and pass on the floor to the next speaker. Thank you.
Thanks, Caroline. I think we have, I'll probably request Supratim to present an Indian perspective. We do have an ARC, we do have IBC. There has been some amount of success in these areas. The ARCs that we have in India who have been working very well, I think are typically overwhelmed with the size of the problem that we have today. And probably that's the reason why this public AMC, super ARC, whatever you call it, is being contemplated to handle the problem once in a large way. Let me hand over the baton to Supratim on this score, because he has actually grappled with the subject in the current thing in terms of some of the Indian thinking that is going around, and would have some interesting perspectives to tell us, and maybe even have some perspectives where he may want understanding from your side about some of the issues that you talked about in your presentation, Caroline. Supratim, can I request you to come in?
Yeah, thanks, Caroline. It was an excellent presentation. In fact, we knew about Sareb, we knew about Nama, but the ones which were done after the Southeast Asian crisis, you brought it out clearly, Dana Harta and that Indonesian stuff. Okay, and the one in '89 is, I think, before even I joined my financial services career. So it was, we have only read in the textbooks. Anyway, to give a perspective, we have 29 ARCs in India having asset under management of 1,10,000 crores, which is, you can say, maybe something around $12 billion or $13 billion. Okay. And top 5 ARCs have 80% of this AUM. Basically, the issue was the first ARC was set up by all the banks, be it private sector and public sector put together, and they were the ownership of Asset Reconstruction Company of India Limited, RCIL. Okay, and then we have found quite a number of them have come up in the private sector, mostly, and some of them have grown beyond RCIL and all. Now, the basic problem, what we find was, is the capital, one. The second thing, if you give them capital also, the rules of the game here is different, because what I was hearing in your presentation, that how do you transfer? When you transfer, there are two parts to the transfer. One, the transfer price. The other is the mechanism of transfer. In the mechanism of transfer, here, unfortunately, each bank will go ahead and sell his part of the loan, and the ARCs have to bid for that. Instead of the entire, if there are 7 banks in a consortium or a multiple banking arrangement for a borrower, in such case, all the 7 should go ahead and sell the loan together. But in our system, in India, it is, each one selling its own loans. Okay. And more importantly, what time does the lender sell the loan? It has to be fully, he knows very clearly nothing I can get out of it. Or he feels that, okay, I am only 5%, why should I keep it on my books? Better, whatever I get it and be done with it. So it's a very dynamic scenario. We might not sell this loan today, as we say, maybe 7 quarters down the line, I'll be willing to sell. Okay, but think of the buyer. Buyer is not clear that will I get at least 70% of the loans or 75% of the loans, or will I get only 26% or 30% of the loans and I'm still saddled with it. So that is why the price at which it is sold is not the perfect price. Okay, that is one part. Second part is, and the aggregation itself can take you beyond 12 months. Forget the resolution thereafter. Okay, and since this aggregation takes time, therefore the resolution thereafter, the plan could have already not been functioning, as you rightly pointed out, that if it is unfinished, it has almost got deteriorated. If the plant was functioning, it would have stopped functioning. And in that case, after 6 months, it is no more a going concern, it is a gone concern. Okay. And historically, if I look at how much did I recover, you gave some numbers. I saw there are 57%. I think in one case was 80%. That was because of that bounce back of economy, which has happened. But otherwise, for us, the recoveries, if you look at whatever was sold in 2016, 17, 18, the recovery was in the region of 9%, 6%, and 6%. That is the recovery. Okay. So therefore, things were not very good. Second thing, you brought out the subject of tax. Now in India, suppose I have to sell, I have a $100 loan. I'm carrying provision of say $20. Now I have the highest buyer who is saying I'll pay you only 40 cents to a dollar, $40. So I have to take a knock of $40, correct? So I take the knock as a banker, and if it is waived and it is sold in that tomorrow in the resolution, then the corporate debtor, which is the borrower, he has to write back that and pay taxes for that, which is a cash flow issue. Okay, so we are having a notional gain concept, and unfortunately, it has been even in ITAT, the Appellate Tribunal of Income Tax, it has been held. Okay, so that's another thing which is there. Then you are talking about, I'm just going by the key considerations for India, whatever you just mentioned. Okay. Legacy NPLs, yes, why we were looking at setting up a ARC of this kind was basically two reasons. One, when this was talked about in 2016-17, that time the banks had were carrying provisions between 15 and 25%. But now when we are speaking about in 2021, we are carrying provisions almost 100%. So therefore, selling that loan has incentive for me. At least if it does nothing, it at least my bandwidth is freed from this legacy assets. I can use that for some productive assets creation. So that is one part of it. Second thing, what we also envisaged was we will sell it at a nominal price of $100 because anyway it may be we might have the total loan book could be say $1 billion, but I have since 100% provided for, and we the banks will have carrying anyway 85% of the security assets and 15% from Government of India. So anyway, if tomorrow I can sell through an auction and I get instead of that $100, say $10,000, that will be shared among the people. Okay, so that is also at a notional price. In aggregated manner, we sell to this ARC. So there is no price discovery. Okay, this is 100% provision cases. We are putting at a notional level. Second thing, there are cases wherein I have provided say 70%, all the bankers, or 60%. So I have 40% which is left over there. So that 40%, whatever is left over there, that 40 cents I have sold to the ARC. And in case there is a tomorrow I get 50 cents, that 10 cents get distributed among the people. If I get 40 cents, no distribution further, I recover that SRs are redeemed. If I get 30 cents, I take further losses. Okay, so that was the another thing. And suppose some banks have done a prudent provisioning of accelerated provisioning. All the banks have done say 40 cents to $1 provisioning. Some banks have done 100% provisioning. So they, while selling, are getting some money out of this from the ARC. But that money is kept as a buffer capital and not utilized as a capital for the capital adequacy ratio purposes. Because tomorrow, if I get some losses coming in, so I will use that for this buffer capital. Okay. So legacy NPL, if you ask me, we had shortlisted, I think, 50 plus accounts, where the overall number was close to $80 billion. Okay, and there we anticipated the transfer value, basically regulated if net of regulatory provisions, the number was coming to something around, if I'm correct, 70,000, maybe $10 billion. So for which we required $1.5 billion as equity, which we had requested the government to give, and the balance, $8.5 billion, will be subscribed as security receipts by the banks, all to put together. So that is how it was being looked at. New NPS due to COVID-19 was not anticipated to be going there because, as you have seen in the papers also now, that we are not expecting more than 25 or 30 accounts coming into that. And those can be still tackled because some of them we have seen some rebound happening, excepting the the HoReCa, hotel, restaurant, and the civil aviation part of it, wherein it will take some time. Okay. Then comes the real estate corporate restructuring and SME loans. Okay, SME loans we didn't envisage this ARC, national ARC to manage, nor was the real estate assets. Real estate anyway, separate ARCs and separate mechanisms are being done for this. This is specifically for corporates. Okay. Why the banks are unable to deal with NPLs? The problem is we have two mechanisms to deal with. Either I go through the IBC route, which unfortunately initially we had a lot of we were pretty enthusiastic, thinking that now this was a panacea. But when we actually went into the and started went into the main gig model, and we found it takes quite a good amount of time. And yes, the recoveries are good, I agree, but it is a protracted litigation which was happening, and the time value of money now, when if you calculate, then we find that whatever we get also is diminishing every year, okay, because of no resolution happening or delayed resolution happening. And we also felt that currently post-COVID, even globally, we may not find that many attractive strategics to come in and bid for assets in India, because they would have also got affected in their sectors, in their geographies. So banks therefore also went through the out of IBC route. So we don't go for the banking insolvency route, we go for outside insolvency. But there was a problem of the level playing field, because in IBC there are certain guidelines which are followed. Outside IBC, certain guidelines were not being followed, and the regulatory arbitrage actually came as a big impediment in getting deals done outside insolvency route. And especially if it is a listed company or companies which had got listed debentures, it was becoming extremely, extremely difficult to deal with such things. What is being done to stem the flow of new NPLs? Basically, if you ask me, if I look at broadly the NPLs, there were tendency, any emerging market where it is capital starved, the general tendency is to evergreen. Because evergreen temporarily gives thin usage of capital, but in the long run, drains your capital. So if you look at in whatever was evergreen in 2013 to 2016, 17, actually drained in 2018 to 20, and as we speak. Okay. Now, that is one thing which has been stemmed, and courtesy the governors of RBI who had been quite critical of that, and I think they were pretty, first time in India the asset quality review had come in, which ensured that people recognize. And there was also, I think, whatever Dr. Rajan had started, I think it continued. And we have seen RBI reports on a divergence in the asset recognition, which is being published, which is also a kind of a name and shame for the banks. So the banks therefore are doubly careful to become prudent and actually acknowledge and recognize that there is a stress. Okay. Beyond that, there is also a strengthening of the the due diligence, the appraisal systems and all. And also what has happened is, I think the monitoring, which was slightly, I would say, relaxed, has become more stringent now, because there is a concurrent, we had the independent engineers, we had the independent insurance advisors and all, but they used to give reports, but we used to, depending on whether I want to use it or not, at times people used to, especially the insurance advisors report are kept in close cover. Yes, I have received it, but I have not done anything beyond that. Okay, so such things were there. Whereas in now we have started putting in more monitoring mechanisms, including the auditors, concurrent auditors, then additional, monitoring agencies have been put in place. That's being done. But being again, if the infrastructure is the main areas where the people are lending, the ecosystem and the sector laws are still evolving. We are yet to find a solution for that. That's still going on. ARC is not able to step in, I have mentioned very clearly, because it is a disaggregation and also the capital. Both are scarce for them. Where would be the funding for the AMC come from? As we had envisaged in this particular structure, it was a national ARC and a AMC. So the ARC will be funded basically 10,500 odd crores or 11,000, say $1.5 billion worth of equity we requested from the government, and that will be the ARC, and the AMC will be funded by the banks, contributing to the equity of the AMC, which is basically maybe $30 million or $40 million, something like that, all put together. And that will be used basically for maintaining the assets. Then you have to have a team which will do the auctions, who will actually see what best can be done, the strategies and all. Basically the resolution team, what I'm talking of. Okay, and this is completely private, what was being proposed at the AMC part of it. Although the shareholders are the lenders, which are both private and public, but the basic characteristics will be private. ARC will be sovereign owned. That was being looked at. Improvement in the IBC, I think pre-packed bankruptcy, we have been hearing it. I think the report also has come in, the pre-packed bankruptcy. We are waiting for the legislations to happen. As of now, as we speak, I think we have suspended the IBC till 30th September, and I think there is a provision that we may suspend till 31st March, given the pandemic which has happened. Personal insolvency has just started because we have started, calling on personal guarantees, which people have given us. In case we have a shortfall in recoveries, we are going ahead and invoking those personal guarantees. Type of London approach was a big failure because in India, what happened was, we all postured that as if we are doing a restructuring, but in the restructuring, you also need to give some money to run the, the revolver or some completion monies and all. So those were not given. In fact, what was so, yes, they have sanctioned it. But when the next repayment date comes, they disburse and take their repayment. So better they never got the money. Okay, so that was a completely a failure. Reforms is a continuing task which is happening on the state-owned banks. Corporate relief schemes, yes, something are happening as we speak, because we have seen because of the pandemic. I think the MSMEs, there was a scheme of close to 300,000 crores, which was lent out by the banks based on the central government guarantees and all, which has moved forward. So MSMEs is something which, some of them got benefited, but most of them are yet to get the benefit fully, because the demand is yet to be crawl up to the at least 70% or 80% of the levels, so that they can break even. So they are still doing. So broadly, if you look at, this was the background on which we actually formulated a paper, and we brainstormed among the Indian banks, and then we pushed it on to the central government for their consideration, which is still in the works. It has neither been decided against nor been accepted till then. This is where I stand. Sunit, that's all from my side.
No, I think one of the issues that I thought, Supratim, you might like to touch upon. I mean, RCEL, when it was first set up, way back after the post-Rajacharya reforms, 96, 97, there were a lot of stressed assets in India. And RCEL, when it came up, it was an idea very similar to the bad bank concept that is being talked about today. We might just want to spend 1 or 2 minutes on what do you think went wrong there, because it didn't seem to flourish as well, though it's still surviving now. Banks are, we have GIC and others stepping into it, and they have access to capital and things like that. But surely that window could have done more, is my perception. I may be wrong. What do you want to say?
See, RCEL, the main problem was, it was formed from mostly those days. If you look at ICICI, SBI, IDBI, and I don't think IFCI had, and one more bank, PNB or someone had. So basically, if you look at what was happening is, we as bankers wanted to say, okay, RCL is there. So since I have the equity, I'll tell RCL, you please pick it up at this price. What she said very clearly, that, whether you want to take the hit of capitalization or you want to take the hit of passing the buck to someone else. Okay, that fine line, I think, got misplaced. And to be honest, that fine line was missing till 2005, 2006. Post 2005, 2006, slowly we started to understand, okay, this is not the way, there's something else is the way. Okay, and prior to that, the legacy assets which had come were wrong, were obviously the such assets which nothing you could get out of it. Secondly, I think the original 595 structure of the capital and the security receipts itself was wrong. But I would not say wrong, because at that point of time, we didn't have that much of capital, to be honest. But what we did at 1585, when Dr. Rajan came out and said you should be making it 1585, I think 2014 or 2013, somewhere, or 15, he mentioned that it made more skin in the game to 1585. Okay, so there the arbitrage of getting the management fee and making your 15, making up for the 15 was no more there. So there actually the serious players came in and there RC lost, and actually people like Edelweiss and some of the other private sector ARCs came, because they actually focused on resolution and not only just take the management fee and taking the buck, because my shareholders are passing me the buck.
Yeah, so I think
here what happens is it's the government. Here it was the government which was pumping the money. So there is and we have the list of identified accounts which are passing it over there. Obviously, none of them are fraud or red flagged accounts, so that cannot be passed regularly. So that those were not there.
Yeah, I think there's a cost of learning at the expense of some failure, and I think RCL became the starship enterprise, in the economy, and I think we have all learned in the economy from that. But one of the, besides the fact that there was transfer pricing was one of the issues one could get into, it was probably thought of a preferential pricing for shareholders, is how much shareholding should there be of the participating banks? I think that came into a discussion, and RBI has now come up with some rule regarding that, so that participating banks don't kind of crowd out independent decision making. I think that has come in. The other issue I thought was, initially they didn't have their own staff; it was all secondment. And so when a person is there on secondment, he has to go back to the bank. And so I think his
more loyal to the bank.
Yeah, we didn't build capacity in terms of on the learnings. And then if he has to go back to the bank or his parent bank, he has to be that much more careful on how he can, shall we say, displease them in the transfer pricing. So I think those were the two major learnings. Part of it is probably all through. But yeah, I thought RCL was one of the first experiments that happened here. We have a lot more ARCs coming in, but capital is still something that they need to ramp up to handle the current hump of the problem. And I think one of the reasons why the bad bank is being thought about is that, okay, there is a lot of provisioning that has happened, maybe 70, 80, 100% provisioning has happened. So some of these assets are good, they can be, some value can be created. You probably need to divide them into 3 baskets, some which can be turned around with some money maybe to clean up, some which are incomplete because the sponsor kind of ran away, half complete assets. And there's a third basket which are probably of no use. You want to just look at the assets and probably sell them by piecemeal. So we probably need to do there's a cancer there and there's a surgery needed. it doesn't mean that we will solve the problem for all time to come. We need to guard on some of the concerns and build on the learnings out of ourselves. But I think I personally am a great advocate of the fact that when you have a hump of a problem and you take it out of the banking system conveniently, number one, the banks probably will be able to spend more time on credit delivery and therefore revive the economy. And hopefully somebody who's got that expertise will focus on getting some value out of those assets which can be turned around. At least maybe 50, 60% of the assets, something can be done. Better value can be realized. And if you have an average 180% write-off or even more, I can say that many infrastructure projects might become viable because the provisioning is there. So it might not be a bad idea, but it needs expertise. It just doesn't need only money, or it's not just financial engineering. So I think that was with this, if I may just say, Caroline, Supratim, we are coming to the end of this part of our session, and I think it has been very interesting and learning from our point of view. Caroline, though in a E mode on a weekday, maybe the number of logins may, there are lots of requests for your presentation and this discussion. So hopefully we will take an excerpt out and send it to people, because Supratim is also a walking encyclopedia on this sector and on the stress in the Indian situation part of it. He has numbers on his fingertips, so it's useful to have him. So thanks both of you, and I think we have we are giving grow trees as a gift to all our speakers. So we try to make some part of India green in your name, and there is a certificate which will reach you, and you can say that, yeah, that's coming on to display in your name. Somewhere a tree will be planted in India, and I hope on that green initiative and greening of the earth, we can make progress. Caroline, I hope you get more and more, you get some work out of India, whether with the bank or with all of this system. I think many of your perspectives and your report, the detailed report that I read, are very useful. I will try and forward that to Supratim, who's an evangelist in this area, and benefit from this. With this, Rajalakshmi ji, would you like to?
Yes. Thank you very much, Caroline and Supratim Sarkar. It was a wonderful session. You've given a lot of ideas, and I'm just waiting, Caroline, that a good governance needs to come in, because that is what you were saying, that political parties should not interfere in all these things. It's very important so that we stop corruption at that stage. But just now India is revisiting all these issues. So I think we are very progressive in the current government to rectify a lot of these loose ends. And all your ideas are very good, and I hope we can follow it up in future. Thank you very much, Mr. Sarkar, for giving us a actual view what is actually happening. And we're extremely thankful to you for sparing time for us. Please, in your name, those trees will grow, and we'll be greener in India. Thank you very much once again.
Thank you so much. Thanks a lot. It was a pleasure. Thank you. Bye-bye. Thanks.
Right. Dhruv and Bijit. We are down on one speaker, but I think both of you can keep the audience enthralled. Bijit is a long-standing ICICI banker. Karthik has also come in from ICRA. Okay. So Bijit is a long-standing ICICI banker. And one of the reasons when we discussed with Dhruv, who we might want to talk to, I think it was universally agreed that ICICI, somebody should come. Simply because, of course, not because I was in ICICI many years back, but mainly because in the onset of retail reform in terms of using technology, ICICI initiated a lot of things many years back. I know we thought of doing a lot of things on technology even as I was way back in 2000 when I just left. And, the rollout of ATMs, the ICICI Direct, the platform and the linkage. Kamath had a 90-day timeline. So he would think of an idea like it and says, 90 days, it has to be rolled out. So that's the story behind ICICI. And Bijit has been a witness to some of that. And but coming home to situation now, there is, of course, as we call it, before Christ and after Christ. So we have a before COVID and after COVID situation. And, COVID, we were all going in for huge amount of digital imports, movement, but COVID probably accelerated the whole process in Indian banking. And Bijit would have probably witnessed that at the ground level in the last 1.5 years, or even maybe more in the last 6-7 months. And we'd like to hear what has been witnessed and what impact it might have on retail banking going forward. But before you go even to that, Bijit, there is one other concern that is there. And since you are still a traditional retail banker, a lot of people are also wanting to know, or there is a view, I may be wrong, it may be wrong, saying that COVID probably will create more stressed assets in retail. Maybe wrong, maybe right, but I think we would love to have your ground level view on this. But before you begin, I think, there is a person who is going to show us the mirror, and that is Karthik, who is going to present some perspective, some numbers out of the retail banking for us to kind of set the tone and debate. Dhruv, of course, is long-standing Pricewaterhouse and now a partner, and he looks at all the digital impacts and particularly frauds, forensics, all the problems that come out of all of this. So he's an expert of that, and I'm sure we would love to see the conversation between Dhruv and Bijit on this. But before we begin, Dhruv, with your permission, can I request Karthik to start with his opening slides?
Sure, I will. Good evening, everyone. Is the slide visible?
Maybe you want to make it.
Yeah.
Visible, but maybe you could put it in slideshow.
Yeah.
Sagar, can you help?
I'm not able to move it in the slide format. If this is okay, then we can.
Yes, I have requested the Indo-American technical person to see if he can help.
Sagar, can you look at it?
Sagar, can you make it a little bit bigger?
The control visiting. Can you just stop the slideshow and try again?
Let me try that again.
Yeah, you can sort of represent it.
Mr. Karthik, I suppose that once you share your screen, then your PPT has to be on F5 mode.
Yeah. It should be already in F5 mode, or
and then in view last screen.
okay. Let me try again.
Otherwise, Sagar, you can present it from there. Karthik, I think let's go ahead.
Yeah,
with what
let's
we
go
can,
ahead with
what we can do.
So can you share that file with me immediately?
Now let it be. Let's go.
Yeah.
Let's make progress. The file is already there with.
Yeah, it's
yeah,
visible
now it's come.
Now it's come.
Go
Yeah,
ahead.
okay, fine. Sure. So yeah, good evening again, and thank you for the opportunity. So this is a brief presentation on the retail credit trends that we see in the country. So I'll start with the first slide. Essentially, the retail credit involves home loans, consumer loans, business loans, which are offered essentially by the financial institutions, banks, NBFCs, housing finance companies. That's our subset here. Growth in this segment has been steadily moderating, as especially in the last 2 years, as the two key drivers, essentially the NBFCs and the housing finance companies, growth started moderating. This was essentially post FY19, the second half of FY19. The banking sector, however, was steadily growing at a 13% CAGR over the last 5-6 year period. This was largely on account of two reasons. One, banks focused on the retail segment by design because corporate segment was not growing. They also purchased assets from NBFCs from a portfolio buyout point of view, as NBFCs were faced with headwinds from a liquidity perspective. Apart from this, banks also benefited from the granularity that the retail segment brings in and the lower credit risk and the capital benefit that it offers. I mean, the key noting point here is we have kept the agri part out, which is again about 11 odd trillion. If one were to include the agri part, then we are looking at a 75 odd trillion of overall retail assets, and which is about 37% of the overall GDP. Banks continue to be the major contributor in the retail asset space. The share of NBFCs and housing finance companies have gone up because of the faster growth that they saw during this period. The ratio has actually stagnated after March 18 for the reasons known, liquidity. We would expect banks to focus on the primer customers going forward and increase competitive pressures for the normal NBFCs and HFCs. NBFCs would have a play because of their understanding, field presence, foot on street kind of understanding. But that will significantly depend upon their ability to get timely funding and a good quality funding. Now, if one were to look at the key asset segments, housing and personal are the two major asset segments, accounting for about 1/3 of the total credit, and both have grown at a very handsome pace. The other two segments are vehicle and the business loans part. When I say business loans, it includes the SME, LAP, and the smaller SME loans, which is under the PSL category as far as the banks are concerned. These segments essentially are the most sustainable avenue as far as a lender is concerned when they are looking at a proposition here. Because these are the segments which could actually gather critical mass and actually contribute to stimulating demand, which is what we need at this point in time as we are battling with a significant demand slowdown. While there are various government initiatives, I think improved credit bureau coverage, especially in the last decade or so, and the focused government schemes have contributed to the retail credit growth by and large. So a very macro perspective, I mean, whichever way look at it, either if we look at the Indian banking sector exposure as a percentage of GDP, only the personal loan part, which is about 12.6%, or the overall retail, which we defined some time back, we are still far behind many of the larger economies, the top 20 at least, indicating there's significant option to increase penetration and grow. What can drive growth in retail? That's where the digital part essentially would come into play. The digital, payments would support digitalization of the credit. Currently, there are various studies which is talking about 50 to 70% of our total transactions in the country being in the cash form. But the increasing mobile density, the mobile internet usage, there are various platforms which have leveraged this aspect and are offering products which could reach the retail segment. And this is driven both by banks and NBFCs. While digital electronic payments are there, I mean, which includes something like a NASH, IMPS, UPI, ECS, NACH, which have grown at multi-phase. I mean, the growth has been substantially higher. What we see in this chart is only the NPCI component, because the bank's component, which is essentially the NAF, RTGS and NEFT, are quite large by their own size. So what we have tried to put is the newer age payment mechanisms, which is essentially growing at 100% CAGR. This apart, if you look at it on a monthly basis, we are looking at almost 100 lakh crore of transactions by value, which happens in RTGS plus NEFT put together. Also from a value of digital transactions, we are somewhere close to about 900% of GDP, which is quite good, and it's comparable to some of the other internationally large entities or countries for that matter. What we see is the fact that RBI is trying to push digital as a platform. They are going with a motto of while cash is king, digital is going to be the divine experience, and that's the divine experience that they want to give. And I think this is where RBI is looking at multiple options to increase digital payout. Also, there are various government initiatives which are supporting digital offerings, which would be the key driver for the retail segment going forward. So whether COVID is going to be a deal breaker, I think we are seeing increasing digitalization. The only aspect is the sustainability of it post all this pandemic aspect regularizes. That would be the key aspect going forward. I think that's the end of my presentation. Thank you.
Thank you. Thank you, Karthik.
Dhruv, take it over.
Thanks, Sunit. Well, good afternoon, everyone, and thank you for logging in post-lunch. I know whether it's in person or through sort of the electronic media, these are the toughest sessions. But we've kept an interesting topic, hopefully. I think Sunit mentioned briefly what we want to discuss. It's basically the future of retail banking in India, and how do we see it panning out. And next point, the last point, whether the pandemic is actually going to have an effect or not. Let's have a fruitful discussion around that. Uh, we were supposed to have another panelist, but unfortunately, due to conflict, she wasn't able to attend. But I think between me, Sunit, and Bijit, we should be able to keep you engrossed. And just housekeeping, you have questions, please put them on the chat, and we'll try to address them as we go along. So Bijit, I think Sunit is already introduced. He heads nationally the digital initiative within ICICI, and has been with ICICI for a long time. So I mean, I think to set the context, we are seeing sort of the growth in the retail segment, maybe not at the same pace as it was about 3-4 years ago. But from your perspective, Bijit, having been in the industry, what is your view in general about sort of the retail banking in India? Both from a product, services, um, how do you see it panning out in the next 3 to 5 years?
Yeah, thank you. Thank you for having me on the panel. So I think, these are interesting times because I think the entire retail banking, if you look at it, I think earlier there used to be liabilities and there used to be assets. And life used to be very simple as far as retail banking was concerned, right? But I think there is a whole new, chapter which has opened ever since UPI came into the picture. And you suddenly realize that payments is the third facet of this entire retail banking. Because until and unless actually you complete the payment transaction, many of these products cannot be delivered. And what was considered to be a very simple debit credit which used to happen in a bank ledger, I think suddenly has become very uber cool because of the fact that different platforms that you have. So actually, if you see in the last like for example, maybe there was an inflection point in 2001 or 2002 when you suddenly realized that the entire retail game has been turned from branches to delivering, products and services at doorsteps. And I think that continued for quite some time. I think till the time the Lehman crisis probably hit the global scenario. And that actually, while many people thought might be actually a hindrance, I think it turned out to be a way for people to adjust, to understand as to what the new normal then was. And you actually found that the retail business continued to grow, be it the liability side or be it the asset side. And similarly, I think in the last 4-5 years, ever since this payment inflection has come, I think, everybody is looking at this entire offering of retail banking very, very differently. When I say differently, it means that, obviously there is this whole endeavor to digitize the entire offering that is there, to try and see as to how you can make the entire banking experience more seamless. How can you ensure that, payments are as seamless as possible? How can you ride on payments for different use cases that you can build? And I think that was the phase that was happening. Wallets came into the picture. There were new competitors. There were new form factors. And I think, the entire retail banking was adjusting to that whole so-called new normal. And also, I think what happened in the meanwhile is this entire jam trinity, I think also was slowly and steadily beginning to take shape in the ecosystem. So be it the Jandan accounts, be it the fact that you have a great mobile connectivity. I think we've got one of the cheapest mobile services in the world. And then, of course, you had the entire brilliant, other infrastructure that was laid out. So when you combined, this entire jam trinity plus the payment ecosystem, you suddenly realize that, retail banking is changing. I think there's a pivotal change that is happening on how entire retail banking is visualized. Because today suddenly you have ability to KYC on the fly. You have a minimal KYC. You have a full KYC. You can give small loans. You can give large loans. It doesn't matter today whether you want to give a 10,000 rupee line or you want to give a 50 lakh line, because suddenly the entire thing is called democratized, right? Because your ability to give that loan whole process of underwriting, the process of trying to do KYC, etc., was expensive. But today, when you have the entire process available on the digital platform, you actually realize that it is not so difficult actually to look at various segments. So what this has done is that then suddenly it has actually opened up many new use cases. It has opened up many new segments of customers, and your ability to actually underwrite and give credit to a new to credit customer with smaller lines, bring them into the fold, see how they're performing, understand their credit history, and then actually start giving them larger lines becomes possible. And that means that it is, what has happened therefore in the last few years is that suddenly the market has expanded. Because earlier, if you would, typically you would say that, okay, if I don't have an X amount of salary, I probably won't give a personal loan or I wouldn't give a credit card. But today, you're basically saying that, all right, you do not have an X amount of salary, that's fine. I'll give you, I can still give you a smaller line. I can give you a smaller card, maybe even virtually delivered, and come onto the bandwagon of credit, and then we'll see as to how we can take you forward. So I think there's a whole lot of interesting things that are happening on the retail space. There are newer products coming, and I think the ecosystem itself is is changing very, very rapidly. For example, I don't know how many of you have heard. Very soon we will have something called an account aggregator, which is coming into the picture, which suddenly says that you can have your bank account with any bank. You can take assets from any other bank. It doesn't matter, because at the end of the day, it's on a single seamless platform. Then you have something called Beam for Lending, which is coming, which is for the small and medium enterprises. I saw the business loans. Small business loans are growing. Suddenly you will find that your ability to lend to that small business becomes very different, because you have a platform where you have bank statements and also you have an integration with GST. And both of these put together, it becomes a very potent weapon actually to see as to how you can underwrite. And we all know that SMEs are very, very underpenetrated as far as credit is concerned. And therefore, can you give small credits? What that then helps you do is actually to try and create use case credits, right? Rather than generally saying that I will give an unsecured line and then you don't know what happens. But here you can say that, actually you can give lines for specific purposes. It could be for certain types of payments. It could be for bill payments. It could be any type of a use case. So I think the way retail credit as well as retail banking is going to unfold in the next couple of years is going to be very, very different than what probably we've seen all this while. And therefore they are obviously exciting times. And whoever adopts and adapts faster, I guess will clearly have the edge. So I can't, Dhruv, you're not audible. I'm not sure if you're on mute. I think you're on mute. No, you've gone back on mute. Yeah, that's
no, I think now. So no, I agree with you. I mean, exciting times. But exciting time brings in a lot more challenges, right? So we've been hearing a lot about the quasi neobanks, fintechs trying to become sort of traditional banks, but obviously due to regulatory requirements, they can't be a traditional bank. But how does a big bank, an established bank, sort of address this internally from a strategy perspective? And then I'm not saying prevent, because the whole pie is expanding, so there's enough for everybody. At least that's the outside in view. But as a traditional bank, where there is a perception that you tend to move a little slower, but how do you maintain your market, and how do you address these challenges?
Yeah. So see, there are a few things which are a given now, right? Your competitor need not be a bank. That is I think first thing that we already need to realize. The second thing I think that we need to realize is we don't know who the next competitor will be, right? For a minute we never thought that it will be one of the large tech players. We don't know from where somebody else will turn out to be a competitor, right? You probably would have never thought that a large petrochemical company can suddenly turn around and say that I will suddenly become a large payment player. So I think the point is that therefore there's no point in shying away from the fact that the competition will not be strong. There is no point in shying away from the fact that we are better than the other banks, and therefore you can be complacent. There is no point in shying away from this fact that it is a connected ecosystem. And if you don't understand that, and if you don't recognize the fact that there is an ecosystem play that's happening, you will be found wanting. So I think these are all a given. So I don't think today, at least, I don't think any of the Indian banks would even be considering by the the fact that some of these things will go away. I think everybody understands that it's here to stay, and you will find that competition comes in different forms and shapes. What I And at the same time, let me also tell you that I think it was not that all the Indian banks were found wanting on many of the things. It was just that probably it took a little bit more time to recognize the fact that okay, there are a few changes that there are changes happening in the ecosystem, and therefore the banks need to adapt. And I think ever since that has happened, you can very clearly see that the most of the banks have been making rapid progress as far as these things are concerned. Let me give you a small example, right? UPI could not have become UPI if the banks did not adapt, if the banks did not put the infrastructure that was required to do the type of transactions that are being done. Right? I don't think the banks ever discussed TPS in any of its meetings, because it was not considered to be such a big thing, because you did only that many number of transactions, and if you did 5 or 10 TPS per second, it was supposed to be brilliant. Now suddenly came a situation where you said that even 250 or 300 TPS was not good enough. Right. So therefore, I think, and if the banks hadn't adapted to that very quickly, probably some of these UPI rails would never have worked. So I think to that extent, the banks are adapting. Also the reality is that I know Sunit was mentioning that we started our digital journey in ICICI Bank at least way back 20 years ago. So I think, and most of the other banks, I think we're there on a digital journey. It could have been better. It could have been, with more products and services. But the reality was that you did have platforms, and you did have a digital infrastructure that is available to the banks. Now, the question was that how quickly do you build it and bring it up the curve so that you are able to compete with the type of challenges that you have, right? If you need to really compete with a tech player, you really need to be good as far as the UI UX is concerned. You need to be good as far as the tech architecture is concerned. And that is something which I think the banks are continuously investing, and I think the banks are working on it. And I think that, and I would certainly say with a lot of confidence that we're not bad. So we are, can we be better? Of course, we can be better. But I think we're up there. Because if we keep benchmarking ourselves against some of these tech players and some of these tech payment apps, the NPS scores are not way different. Well, somebody might turn around and say that they're a little bit more considerate when they look at a bank app. So be it. We don't mind. But the reality is that so long as they're happy, the transactions are going through. So I think from that perspective, I think all the bank boards understand that this is a change here to stay, and I think all banks are cognizant of it, and I think those changes are being done. I mean, without taking names, you can see some of the changes which even PSU banks are doing, or some of the products that they're putting out there from a sheer from a digital perspective. The speed at which probably some of the products that are getting launched on digital properties is the time to market is become much shorter than probably what it was some years ago. So I think the banks are adapting, and some will be faster, some will be slower, but I guess all of them will quickly catch up to that change.
Okay. Well, just staying on that theme, one sort of frivolous question, I guess. Is there an end in sight, if you have a crystal ball? Will sort of branch banking, the traditional brick and mortar, 10 years, 15 years from now, do we still foresee that? And I kind of know the answer, but I want to hear it from you. Will that still exist?
Okay, so let me put it this honestly, but I'll have to do crystal gazing to say what's going to happen in 15 years from now. But the reality is this: let's look at the most so-called developed and digital economy, which if we assume for a minute it is the US. Well, the bank branches I don't think have disappeared. Korea has got a very high ratio of digital payments. I don't think bank branches have disappeared. Now, coming to the Indian context, I think fundamentally, that branch does two things. I think the biggest benefit that the presence of a branch gives to an Indian consumer is comfort. It gives the fact that, okay, if I need something, there is somebody right next door. I can walk in there. I can get certain things done. I think, and that's a big factor, right? If not, there was no reason for some of the larger banks to have enough network, but obviously we're giving better, better products and better rates. If that was the if branch network was not such a significant factor. So I think there is an emotional and a rational connect that the branch brings, and I think that is here to stay. And I think as Indians, we are very, there is this comfort factor that comes, when you see the brand out there, by stating that, okay, it's available, it's within my reach. It's not that I'm speaking to some unknown entity. I think, and therefore I don't think an Indian will, our DNA will change so fast in the next 15 years. What might happen a century from now, I don't know. But I guess for the next 15 years, I don't think it will disappear. But yeah, the reality also is that would we expand the branch network the way we expanded? I don't think that will happen. Maybe there will be certain geographies where we will expand, where we are not present, or when we need to render something where a branch presence is required, which could be in the tier 3, tier 4 markets and things like that. So those might still happen, but it may not be the rapid pace at which we saw the branch network grow between, let's say, in the 2000s. I don't think that will certainly be there. But I don't think, my guess is that the branches won't disappear certainly.
Yeah, at least in our experience also, and we've been working with a lot of financial institutions. I think when you talk about India, you need to sort of segregate your customer base, right? So when you talk about tier 3, tier 4, we still have so many unbanked individuals who are now sort of getting into the banking ecosystem. But I think in the cities, the way you decide, or the metropolises, how you want the branch network to be, whether that's a criteria of one branch per 10,000, or however the traditional ways, those probably will change. But at least in my mind, also for the next 15-20 years, you will still have a tradition. You'll have a bank branch. It might look very different. You might have a bunch of robots interacting with people, or whatever that might be. Let's switch gears a little bit. We've talked about the opportunities. We've talked about what we're doing, but from an financial institution perspective, managing risk, right, is always one of the important factors on how you decide to either issue a product or a service, or interact or service your customer. So how has that changed with the rapid sort of, if I may say, customer base increasing, the types of products increasing? You mentioned the time frame where the decisions are being made for extending credit, for example, or onboarding customers have shortened. But then how do you then balance the risk and the regulatory obligations that you have? What has been your experience in that?
No, I don't think we have a choice of balancing. I think two things are paramount. The fact that we have to comply with regulation is a given. The fact that what we are offering should be safe is a given, right? I don't think we compromise when any product or services are put out there. I don't think we compromise on that. What we try to do is that we try and make it as seamless as possible for the customer, so that we don't inconvenience the customer. And we try and put as many algorithms as possible at the back end to check as to whether we can actually catch to see whether it is a regular type of transaction, whether there are patterns that we see because of which we identify fraudulent transactions. We see transaction velocity. So there's a huge amount of, I think, investment that is going on to figure out as to what is a genuine transaction and what is a fraudulent transaction. And our attempt is to say that all fraudulent transactions should be challenged and all the genuine transactions should go through as seamlessly as possible. But as you all know, I mean, world over, it's always a catch-up game, because people will always try and find more and more innovative ways to, challenge the system. So I think that's the continuing process. But the good thing is that I think it is it's coming under control. It's not that that it is it's a runaway pain. I think one big challenge which we have as a country is the fact that if consumers are going to adopt digital more and more, I think digital literacy is very important for our customers and for the public at large, right? Because many times people are gullible. They actually don't understand, what privacy means, what security means, and therefore they get, they fall into the trap of some of these fraudsters. And that's when the problem arises. So I think a big role that the banks have got, and which we continuously try and do, not just the banks, but also the regulators are doing a great job in this, is to keep communicating the customers by stating that, your data is your data needs to be safe. You should not be sharing details, because if you share details, obviously, mule accounts can get created, loans can get booked, etc. So I think that's the continuing process. From a product delivery perspective, therefore, I think these two things are non-compromise. We don't compromise. And what we try and do is to see that, as far as possible, we build as many algorithms as possible at the back so that, the products are delivered as seamlessly as possible. And I can tell you one thing is that the way we are looking at it is that the least the friction on any product delivery that you have, the higher is the adoption. I mean, while it may obviously sound as a no-brainer, but the reality is that it's probably not so easy to deliver it. But once delivered, obviously we find that the adoption is very, very good, and that's what we've seen. So when we launched the Insta loan, probably around 18 months back, we basically said that we went in with this whole philosophy by stating that we want to disburse a loan in 3 steps and 3 seconds. And today, close to 40 to 50% of our loans that we disburse are all Insta loans happening through any of our digital channels. And we have been able to do that without any, compromise on security or any of those frauds, etc., that are hitting us from that perspective. So we don't have any of those challenges. I think no compromise on regulatory issues or on fraud, but we try and simplify the customer journey as far as possible to ensure that it's a seamless experience for the customer. I think that's been our broad philosophy.
Okay.
But yes, we have to continuously educate the customers, because I think, people really don't understand the significance of data privacy and significance of, what digital platforms are, what happens on a digital platform. I think that's something which we need to continuously educate our customers.
Yeah, I mean, just from my experience working with a lot of banks and some of the wallets of the neo banks, the sheer volumes that we are seeing on especially the payments and the way the volume velocity of these transactions. But I have to say, the systems are there. I mean, people are aware of how to manage those risks. I know NPCI has come up with its own sort of fraud. They're in the process of developing that and it's in milliseconds actually. It's not even in seconds where they are making these decisions. So, but I think the challenge is still there, like you said. One of the things which, and I've had the experience of working both outside of India and now in India. The volumes are high, but the values are low, right? So some complacency might come in that when you're only seeing, say, a 1,000 rupee transaction as opposed to $100 transaction, right? Give us some insights into how do you then risk mitigate or risk plan around those. So I understand regulatory, you don't have any, there's no compromise, right? You need to comply. But internally, each institution will have its own sort of risk appetite. Give us some insights into how do you go about.
Okay, so let me let's take UPI as a classic example, because it was a high throughput payment mechanism, and it came from normally an NEFT or an RTGS will only start from a bank, right? So whereas this came from a third party app as well. So in the initial days, because obviously customers didn't understand what a VPA meant or what's the UPI handle and things like that, what's the collect request. There were a lot of frauds which kept hitting, because people actually didn't realize that somebody can send a request, and if we put the pin, actually the money goes away. He was always thinking that the money comes to him. So from that perspective, in the initial days, therefore we had certain restrictions on the amount of money that our customers can transact, right? While a UPI could allow a 1 lakh transaction to go through, but we had put certain restrictions on different channels. If it had been a bank channel, we said that you can do a full transaction. If it had been on certain other third-party apps, we said that there are restrictions of 20,000, 25,000 rupees, whatever may be those restrictions. Plus, I think at a systemic level, NPCI also took certain decisions by stating that collect requests cannot be beyond a particular threshold value and things like that, so that we could protect the entire ecosystem. But what we did is, as we went by, we realized and we understood, probably a year down, we understood as to what are the type of transactions that are coming, where is it coming from, what is the transaction pattern. And then we started relaxing some of these norms. A 10,000 rupees or a 10,000 rupees or 25,000 rupees, and we increased it. So today we have opened it up for most of our partners to do up to ₹1,00,000 because because we realized and we learned as to what are the controls that we need to do, what are the transaction velocity checks that we should put, and things like that. So I think our approach has been a little calibrated. We did not generally open it up on day one. We try to check as what are the type of patterns that we're seeing, what are the type of frauds that can happen, what is the type of education that we need to give to our customers, how do we enable the ecosystem to adapt to this payment method, and then we kept opening up those limits. The other thing that we also did is that we actually also looked at to try and see as to from which sources what type of transaction emanates, and what is the sort of pattern that you're seeing, what is the sort of controls that you have on both the initiating side as well as on the delivery side, and based on that then we put certain checks. I think these are the things that as a bank we had to learn, because these were things which were not a problem, because normally in banking it would have gone from A bank to a B bank, and both being KYC'd accounts and regulated accounts, you didn't have this worry. But then now today, when payment can start from any of the apps, sometimes you need to put some of these checks so that you're sure as to whether it's a genuine transaction or it is a fraudulent transaction. I think these are the way in which we have approached some of these high value transactions. And as you rightly said, because of the fact that you have to deliver a 250, 300 TPS, and within that you have to do some of these checks, including the velocity checks, I think that makes the whole mechanism much more difficult. The investment into technology, the investment into hardware, to actually manage all this type of high velocity transactions. I think those are the challenges which the banks face, and then to try and ensure that you get your return on all of these activities that are happening.
Okay, let me switch gears a little bit, and maybe let's talk from a customer's perspective.
Been wanting to say something.
Hi, Sunil.
Hi.
Yeah, you want to come in?
So I think in the process of this discussion, I thought, you are all, we have heard Bijit's view, but you are also interacting with a whole lot of other players. And maybe to the extent you can give a perspective of some other kind of things that some of the other players might be looking at or doing. I think that is one of the things. The other issue which has been already alluded to is really the whole issue of frauds and things like that. Whether that would scare some people, if an incident happens, that scare people back to go back from digital thing. I think the Bijit may have a perspective, but anyway, that was my.
Yeah, I'll do that. So quite honestly, I think it's exciting times, right? Whenever being from a consulting background, whenever there is change, whenever there is new things, innovation coming in, it's always exciting. But like I asked Bijit, that there are challenges, and because I focus a lot on risk and compliance, specifically fraud or money laundering risks and everything, it's new challenges. The non-traditional players are finding it a little more difficult because, quite honestly, the regulatory requirements for the guidance are. I would say in India they are very progressive and very open and sort of inclusive, but they're still not as clear, or the expectations are not as clear for the non-traditional or FIs, and they are the ones who are facing a lot of challenges. So, for example, if you're a wallet, suddenly day one you've got 10 lakh transactions to review from a fraud perspective, from a money laundering perspective. It's a catch-up game. But at the same time, as Mr. Karthik had mentioned in his last slide, if you look at those payments are growing at 100%, right? So it's a little difficult for them to catch up to be like a traditional bank where you have all these systems. Because the other thing is a lot of the neo banks, or especially the payment wallets, they're not holding that money, right? They're actually being, they're sort of the middlemen facilitating a transaction. And so the obligation for them to be as responsible, that's where, initially, I would say about 4 years ago or 3 years ago, that was the challenge. Now, I think the biggest challenge around fraud is like Vijay was mentioning. The volumes are low, so it's very difficult. The values are lower, right? And when I said balancing, the balancing between technology, balancing between your obligations, that's where we do a lot of work. But I think if I compare it, say to, quote unquote, the mature financial economies, so, you take US, UK, you take Hong Kong, Singapore on the east side. I think from a digitization perspective, we actually might be slightly ahead from the sheer volume and the coverage that we have done in the last 5 to 7 years. I think from a risk and compliance perspective, we still have some catching up to do. And there is a FATF review which was supposed to happen, but it's been postponed for early next year, and that is one of telltale sign of where you are from that perspective. But I actually feel proud that the sheer scale of the financial economy that we have, we still don't have as many, major incidents of fraud committed on a customer, right? So if somebody is, as a customer, is committing fraud on the banks, and that is where a lot of the large NPAs and all that have happened, right? But fraud on the customer or of the bank or the institution, those are still limited. And most of them are changing to the technology platforms, whether it's phishing, cyber attacks. So, it's shifting, but I think most of the Indian institutions are there from a ability to understand and having the right infrastructure to tackle it. I mean, I know we've got only 10 minutes left. So, Bijit, one thing we wanted to maybe cover, and I know at every forum, every discussion, this comes up. Quite honestly, has the pandemic actually, what is the impact that you felt, right, from a retail business perspective and the digitization journey that, the plan you had or the vision you had or the strategy that you were implementing? What's been the real impact, and how's that journey changed, maybe?
Yeah, so I think two things. I think what the pandemic did is that it helped the bank become truly digital in whatever journeys it had. Right, I'll give you a small example, and this must be true for most of the banks, right? So a debit card, it was always assumed that you don't need to give a debit card on the fly, because the debit card will go on a courier, or you hand it over across the counter because you have a kit that you can hand over, etc. And it was assumed that along with an account, the customer would get, and then he can do whatever he has to be done, right? Now suddenly we realized that this whole thing doesn't work, because during the first close to 45 days there was no courier, there was nothing happening. So, a few things, like for example, offering a virtual debit card probably was there in our roadmap, but it was not a high priority stuff, because we said that probably the impact may not be great. But suddenly you realize that it became quite significant, because customers were not able to transact. There were new accounts getting opened without debit cards. There were debit cards which had expired, which therefore they couldn't do transactions and things like that. So I think we preponed some of those journey roadmaps. So that we can actually get our existing customers can seamlessly transact without any challenges. The second thing I think that happened is, therefore, from that perspective, I think some of these products which are on the roadmap, which we thought are okay, we can live with it. I think we preponed. The second thing is that there were these niggling, issues here and there on some of these services that we had said, by saying that you can come to a digital channel, you can put your requests and you can put your requirements there, and then we might process it over the, from a backend perspective over the next 24 hours, and we'll turn it around. We suddenly realized that also could not work, because our back operations could not, were not present. So those things had to therefore get had to be corrected, and those digital journeys had to be built. So I think one key thing that happened is that, today whatever journeys that we were able to offer to our customers have become truly digital, in the sense that you don't need back-end staff, and to that extent, one is customer satisfaction goes up. The other thing that I think actually happened is also that we started thinking from the perspective that what if COVID were to be here forever? Therefore start thinking from this perspective that there is never a manual leg that can happen. And therefore, how do we try and build all the journeys in such a way that it is fully digital and digital native, right? So therefore we said that, okay, let's see how quickly we can put a video KYC out into the market, so that you can actually, the entire KYC leg can go away. So we looked at specific areas in all the journeys, whether it is retail assets, it is retail liabilities, whether it is in payments, to see as to what are the things where there was manual intervention that was happening today, and can we therefore build solutions and journeys which can completely digitize it. So therefore, then that became our roadmap to see as to how do we quickly do that. So, we put out video KYC out there, and suddenly we realized that the entire account opening became fully digital, right? Whatever credit cards we were issuing, we started issuing it fully digital, because we were already issuing a virtual credit card. So then we started looking at as to what are the other products that you could try and do, other asset loans that you could try and do from a digital perspective. So we started ensuring that that you started giving top-up loans, because there were certain customers who actually wanted to take a loan, not because probably they wanted it, but they said that, it's a safety measure, it's a safety check. And we realized that their credit worthiness is good. So we said that, okay, why don't we give you certain top-ups in case if you're servicing loan, you're not in moratorium and things like that. So therefore, we try to build those products, during this particular period of time. So actually, during this entire pandemic, it is not that, the business had come down to a standstill. In fact, our liability business was doing very well. Within the first 1 month, we actually were back to the pre-COVID times as far as that was concerned. Even asset businesses, we were continuing to do a small amount of disbursement depending on as to what the need is and what is the type of product that was that the customer wanted. So from that perspective, I think what it did is that it rearranged our prioritization, and we started picking projects from that perspective. The other interesting thing that we found is that the customers who became, to answer the Sunit's question, right? The customer who became digital actually did not go away. And I think that's the good thing about an Indian consumer. I think once he adapts to something or he adopts something, he does not leave it. And especially if he finds convenience. And therefore, we found that the number of digital customers that we were able to add in the last, for 4 or 5 months has been significantly higher than what we would have done otherwise. So therefore, the good thing therefore is that today, and what we find is that on our channels, the repeat usage, a customer coming back on our channel is very high. The engagement frequency is very high. So therefore, it's a better tool that we can engage with him now that he's on a digital platform than what it would have been if you were non-digital, and if it was an RM trying to reach out to him, or he walking into a branch, etc. So from that perspective, that is a positive that has happened, and nobody has gone off. Maybe there'll be a small percentage who may have gone off, but it's an extremely negligible percentage. Who's actually moved digital is continuing to be digital. So I think these are the couple of things that COVID has taught us or helped us with.
Okay, we're coming up on time, probably about 5 minutes. So one more point, and I think Sunit had initially mentioned it. So there's always this, there is this view that there was stress in the system. Pre-COVID, economy was going down, and we had a huge sort of an NPA portfolio that all the banks are carrying. But now with this on the retail side, with the economy going down, obviously there's going to be an impact. People are going to lose or have already lost their jobs or not earning at the same level. In your view, what do we see on the sort of the retail portfolio happening? I think fraud will be a small element of it, but generally on the quality of that portfolio.
So see, this is something that is being constantly monitored, and I guess as time progresses, we will have better clarity on as to how some of these things will pan out. But I think, at least from our perspective, largely the loans that we gave, especially the unsecured one, I think the secured one is still relatively cushioned, but the unsecured ones largely we gave to our own customers. So we obviously understood them better when we were doing the underwriting, and we therefore we had a better grip on those customers when we actually gave those loans. So very high, a very high percentage of our customers who took an unsecured loan were our own customers. The other thing that also, that if you see our portfolio has been that largely they're all salaried customers, and from the better tiered corporates. So from that perspective, I think so that's another plus, and therefore we haven't seen too many either reduction of salaries or pay cuts or retrenchment or any of those things actually in those set of clients. So from that perspective, what will probably affect will be those areas which were affected during this time, which could be travel, it could be hospitality, and it could be these things. And these are sectors that we are very closely monitoring, because obviously they will take a longer time to come out of this pandemic, because it directly affects the business. Whereas if you ask me, most of the other businesses I think have adapted. They've already started work from home. I think businesses slowly limping back to normalcy. If you see a transaction throughput, it's back to the pre-COVID type level. So I think from that perspective, I don't think we will see too much of challenges. There are specific areas which could be, like a commercial vehicle or builders. So these are specific small segments which we are very closely monitoring, and we will see as to how those will pan out. But they're extremely small for us, so maybe it may not be very relevant. And we are very closely monitoring. As of now, I think the situation is comfortable, but we'll have to wait and watch how some of these things will unfold.
Okay.
And luckily, on the non-retail, which is basically the agri side, etc., as of now, we are not seeing too much of issues. So okay. I think because of the fact that we did not have that long tail, and we were very careful in the type of portfolio that we were building on the retail assets, I think we should be.
There is one question, Vijit, from one of the participants, and I just read it. How often Indian banks use the bank payment obligation instead of the LC for export-import trade deals?
I think that was of the previous session, if I'm not wrong.
Oh, okay.
Yeah, okay. I think we can.
Yeah, because it didn't seem relevant over here on the LC side. Okay. All right. So I know we've come up at 4 o'clock. I think if we had more time, Sunit, we could have continued. I was getting worried that with one panelist it might be a little difficult, but it's been really engaging. Vijit, thank you for your insights. I hope the participants found this a little useful and have a little better understanding of what the outlook is for the retail industry. And how, not the retail industry, sorry, the retail business, and some of the things which are happening in India, both from a growth and an excitement perspective, but also some of the challenges that we discussed.
Thank you very much. Thank you for having me here. It's been a pleasure. Thank you very much.
Yeah.
Thanks, Vijay. Thanks, Dhruv, for taking us through a very interesting session. Vijay, we haven't interacted with when I was at ICICI, but I think you took the whole story up reasonably well, and I think made a lot of sense. We have a small little token of appreciation. We give out a grow trees, so plant a tree in your name as a part of the endeavor by Indo-American Chamber to green India. So, that will be mailed to you, but maybe something is coming up on the screen. You can have a look at it. So
next time I'm in Mumbai, I'll come and actually look at the tree.
I don't know where. I mean, we'll have to see where these
in the rural areas, not
yeah.
here.
Okay. All right.
Rural areas. If we do come to know, we can tell you.
Yeah, no, this is a great initiative.
We are honored with your presence with us, and Mr.
Thank you very much.
Vijit Bhaskar, Mr.
Thank
Karthik.
Yes, Karthik, you too.
Yes. Thank you very much for having shared all your views and enlightening us. Thank you very much for your time. And Mr. Dhruv Chawla.
Thank you.
Thank you very much, Dhruvji. for sparing your time and giving all your inputs. Very kind of you. Indo-American Chamber of Commerce, our members and other participants are extremely delighted and thankful to you for all the insights and making us understand the subject.
Okay.
Once again, thanks a lot.
My pleasure. Thank you.
We have a session now with Shekhar. Maybe somebody needs to keep
Video is on.
Mr. Rajnish Kumar is also with us.
Ma'am,
Shall we start?
Rajnish ji has come.
Can we start with
Yeah.
Rajnish? And then
Yes, yes.
Yeah, if you can keep Shekhar informed and on standby, then we'll not keep Rajnish ji waiting.
Yes, a lot of difficulty we got him in this time.
Yeah, I know. He's got a dynamic day. He wouldn't know what is happening. So, yeah.
Thank you.
I'm Rajlakshmi Rao. I'm the National President of Indo-American Chamber of Commerce. Although I have not said it all day, I have to let you know it's a 52-year-old organization. It's a Indo-US bilateral organization, strictly in the niche area. And I can also proudly let you know I'm the first woman president of this organization in 52 years. Although I'm saying it myself, I thought I should at least let you know that women are coming to different levels today. And we have had many sessions since morning. And you know very well that for us, it's very important for our members to understand, because today financial input is the most important thing for coming out of COVID issues and also scaling up. And as far as the Indo-American Chamber of Commerce, I just wanted to let you know that we have a lot of members across the country, about 10 branches in Mumbai, Chennai, Delhi, Kolkata, Bangalore, Pune, Ahmedabad, Cochin, and Hyderabad. So we have a lot of these members, and most of them are in MSMEs also. So they need that kind of help from banks especially. And we not only connect all of them to various fields of business, but we feel they need to also understand what is today's focus in banking and also insurance sector. And we have many speakers. In fact, tomorrow, Arundhati Bhattacharya is speaking in another sector. We have insurance sector coming up, and Mr. Anurag Thakur is the minister is opening it. And we have Girish Radhakrishnan, who's chairman of UIC, and Nilesh Garg from MD Tata AIG, and Vipin Anand from LIC Insurance MD, and Mr. Prabhu Thakkar, Global Insurance Chairman, and Jaideep Roy, who's moderating it tomorrow. It's a very big session even tomorrow, with all the others coming from other banks, Kotak Bank and different banks. And that is the background for tomorrow's session. As I said, we have 2-day sessions in banking and insurance. I thought I'll just let you know about that. We had very good sessions so far, but we've been waiting to hear you. And before we start you to speak, I'll just welcome you and all the other participants who are all watching us. Let me just introduce Mr. Rajnish Kumar. He's the chairman of India's largest lender, State Bank of India, since 7th October 2017. Previously, Rajnish Kumar was the managing director, National Banking Group, looking after retail banking and initiatives in payments and digital banking since November 2015. Prior to becoming MD in SBI, Mr. Rajnish Kumar was heading SBI Capital Markets Limited, the merchant banking arm of State Bank of India, as MD and CEO. And after that, he has been with SBI for over 3 decades, having joined the bank as a probationary officer in 1980. Since then, he has held various assignments across various verticals, including 2 overseas assignments in Canada and the UK. He has vast experience in handling large credit project finance, forex, and retail banking. Mr. Kumar has also held important positions in SBI, such as Chief General Manager, Northeast Circle, Chief General Manager, Project Finance, Managing Director and CEO of SBI Capital Markets Limited, MD, National Banking Group. Mr. Kumar has also served as VP Credit and SBI, Toronto, Canada, and Regional Head SBI, UK, London. Mr. Rajnish Kumar is a chairman of SBI subsidiaries, important ones being SBI Life Insurance Company Limited, SBI Foundation, SBI Capital Markets Limited, and SBI Cards Payment and Services Limited. He also serves as director on the boards of various organizations, Export-Import Bank of India, Institute of Banking Personnel Selection, National Institute of Bank Management, Pune, Indian Banks Association, Khadi and Village Industries Commission, Indian Institute of Banking and Finance, among others. Mr. Kumar is also a member of the Honorable CM's Advisory Council of on FinTech of the Government of India, Government of Maharashtra. I don't want to mention when you are born, but of course he has done MSc in Physics from Meerut University, and is also a Certified Associate of Indian Institute of Bankers, CAIIB. He's an avid traveler and has visited several countries, but passionate about sports, and his favorite sport is badminton. And Mr. Rajnish Kumar, our members would like to know how the banking system is going to help them, and especially this post-COVID, they need a lot of help. And I know for the first time, Government of India under Prime Minister Modi's vision, lot of changes have happened, which were never there earlier. And they're trying to help MSMEs in different ways. And I know at the top level, all of you have a good intention of reviving our sector, whether it's financial sector into manufacturing and various things where they need funds, finance, most critical. And in the morning, we were told a lot of money has already been sent to all the people at the MSME level directly to their accounts. A lot of these things are not coming down, filtering down. Somewhere there's a communication gap. We don't come to really know what is happening. So we do see a bit of negative discussions and talks. And but you have to now tell us how to turn this all into positive and communicate across from all the banks that what good they're doing, so that we feel positive about it. With these remarks, I request you to.
Thank you, Rajya Lakshmi ji. And first of all, sorry that my secretariat has sent a very long introduction. I will ask them to make it more brief.
We need to know. 3 decades of work, we have to talk about it, sir.
Yeah. And of course, I'm very delighted to be here. And first of all, my greetings to all of you, all the participants, the organizations of this event, the office bearers of Indo-American Chamber of Commerce. This is your annual convention. But what you have right now told and what the topic was given was prospects of Indo-American cooperation in business and economy, challenges and opportunities. So one is that I can read out from there. Other is that if your members are interested that all what is happening to the Indian economy, what are banks doing, what the government is doing, what are the issues and challenges for MSME. So I can do that also. So you tell me what is to be done.
So, because we have a mixed bag. We have many people who are in the top industrialists also, but who need helping hand is always the next bracket. So you can touch on both. I mean, what is it that you can't talk about? You can take an overall view to say to each sector of these members.
So then it will be a slight deviation from the topic, right?
Okay.
So that is all right.
That's okay.
Right. Okay, because I thought that it is Indo-America Corporation, then I had prepared it accordingly.
No, sir. It is Indo-American. Ours is a bilateral chamber. And so we are doing a lot with the US government and what the investments are coming from there and how we are investing there and how both countries are benefiting. So you need that kind of a support from US government and our government. And luckily, our embassy, US embassy, is also always connected. In the morning, also we had Eileen Nandi from the US embassy. So they're always discussing about how to help anybody who wants to do business with, any manufacturers or whatever from US. So I mean, you can partly touch on that, and you can go into MSMEs. Both are okay.
Right. Okay. So thank you very much. And then because from the audience perspective or the people who are participating, you want to, because touch me on issues which are currently being faced by the country. And just before addressing this session, I was addressing another session at banking colloquium. So I'm just coming fresh from there.
I see.
So I can just, many of things I can repeat here. But currently, let us then first make an assessment of the situation we are in as far as COVID-19 is concerned. And it's important to understand that ultimately we have to find a quick solution to the problem which we are facing. And here, the frantic research for the vaccine, which is happening globally, my wish and everybody else wishes that we are able to have a vaccine as soon as it is possible. All of us know that it is a certain time and the process of clinical trials, there's a process, it has to be tested. But one thing which is agitating everyone's mind is about the COVID-19, and it is bringing a change in the behavior, what we call the consumer behavior, that is very visible. And these are some of the early patterns, and not necessarily these patterns will remain forever, but a few patterns are that we are finding from the behavior of our customers is one, even if people have money, they are not spending it. Either people are preserving cash or bringing down their liabilities. No one is increasing the liability today. It is not in a mood to increase the liability. People are rather bringing down their liabilities. That is one major thing. Second is, of course, because people are spending only on such things which are absolutely essential. What we call the discretionary spend. I don't think that discretionary spend will return to the normal till such time people are confident that they will not be impacted by the COVID-19, and that can happen only when we have a vaccine. And till such time, if the spread is there, and we have seen in many countries where it was controlled and then resurfaced. So that way the disappearance of virus is not happening very soon. One redeeming feature in the whole thing is that in the last 6 months, the protocols for treatment, they have been established. And the recovery rate is, or can be termed as satisfactory in the sense that mortality rate is not high. And this has happened over a period of time. This has happened because of the now our health professionals, doctors, hospitals, they all are now much more learned than what they were 6 months ago, when it was just an unknown threat and nobody knew how to handle the situation. So that is one positive thing. And that is, we are finding that mostly people are able to recover. And unfortunately, wherever there is a death in the family, of course, it leaves deep scar on the family, but the mortality rate is very, very manageable as of now. Now, in such a scenario, what does a country do? Or as in India, what we have been doing? How do we meet this challenge? And how do we look forward? And what is the role of the financial system, not only banking system, the entire financial system. Definitely, April, May, we can say they were some sort of a washout months. So not much of economic activity happened, and we have seen that in the first quarter, the decline in GDP was 23.1%, and but June onwards, most of the sectors, they have started coming back. Some of the sectors, as I said, are more deeply impacted, and it will take time before they come back. Some of these sectors are aviation, hospitality, shopping malls. So these are the sectors where the impact is deeper and it will take more time. And of course, the luxury goods, as I said, the items of discretionary spend. And otherwise, the economic activity, all the indicators from June onwards is that we are returning to the pre-COVID-19 level. And the partial lockdowns are still impacting the supply chains. And that is where, as more and more state governments open up the economy and the partial lockdowns are also lifted, so at least we will be ensuring that the supply chains are fully restored. And about the demand side, as I said, that once people get more confidence and what is called the consumer confidence, then the demand would be revived. The way to increase our growth on a sustainable basis, definitely a lot of investment is required in the infrastructure. And that is where national infrastructure pipeline of 110 lakh crore or 110 trillion rupees, Indian rupees, over a 5-year, it can be a big booster. But coming more to the MSMEs who have been impacted by the COVID-19, and they are almost 40% or 45% of the manufacturing sector, an important part of the overall supply chains, whichever supply chain we take. MSMEs play a very critical role. They are the largest, one of the largest employer in the country. So this is very important that the MSMEs, they are supported, and the Government of India and the Reserve Bank of India and the banks, they have taken many steps to support the MSMEs. For example, when the COVID happened and lockdowns were announced, banks led by State Bank of India, we came up with the COVID emergency credit lines, where immediate help to the extent of 10% of their limits, they were made available. Subsequently, Government of India came out with the guaranteed emergency credit line, where whatever was the outstanding as on 1st March, 20% of that was made available, and this 20% amount is fully guaranteed by the government, and more than 1,60,000 crore has been sanctioned by the banks, and the participation was from everyone, private sector banks, public sector banks, and the banks have done a good job. Then there is like help from Reserve Bank of India in terms of providing a resolution framework for the MSME sector, where the loan amount is up to 25 crore. There was already a dispensation available, and which covered the MSMEs as on 31st January 2020. And there was a plan, there was a scheme, and Reserve Bank has decided that that help is available up to 31st March 2021. So apart from guaranteed emergency credit line, another facility which has been given by the government is that in case of restructuring, there is a requirement that the promoter of the unit, they also bring in some contribution, say 15%. And many times you have find, particularly the smaller, you can say, small enterprises. So promoters are even unable to bring that kind of money. So that also government has set aside 20,000 crore, and that can be availed by a promoter by way again of a guaranteed loan by the government, and that they can bring in as their contribution. Third, of course, is the fund of funds of 50,000 crore, which has been announced by MSMEs. And the major reform was about the definition of the MSMEs, which has been changed from 1st July. So the scope of the priority sector lending, that has been enhanced. Then recently, Reserve Bank of India, they have come out with the revised priority sector guidelines, where they have made a couple of changes as far as the flow of credit is concerned to the MSMEs. So in a way, institutional help is available. And but still this what you mentioned about that, the issue that at the ground level, lack of knowledge or the responsiveness, that keeps on coming. And in fact, even for that, the MSME ministry, they have this champions portal, where if MSME is having any difficulty, they can lodge their complaint on MSME champions portal, and which is then sent to the bank, and banks have to respond. So that institutional mechanism for addressing the grievances is also available. So in such a scenario, if there are like any specific issues, the MSMEs, the borrowers, they can definitely reach out. The even availability of the fresh loans. So what is happening is that a very big shift is happening towards digital lending. Then PSB 59 minutes loan, where this is an automatic machine learning based underwriting, where the platform is using the GST data, income tax return data, and the credit bureau score data to determine how much money is or can be availed by a borrower. Banks themselves, and I give an example of a State Bank of India, we have many pre-approved loans, like pre-approved business loans, where like again, based on the data analytics and using certain data available with the bank and the conduct of current accounts or payment record in respect of merchants, if you are a merchant. So that digital lending is available. For very micro enterprises, e-mudra loans are available. Again, it is end-to-end digital without any manual interventions. So it is not that banking system has not responded to the situation or are not trying to facilitate the lending to MSME. But the fact is that the MSME sector remains vulnerable. It was always vulnerable. It's not, but COVID-19 has increased its vulnerability. And that is where banks do realize that the sector needs to be supported. That is what government is doing. That is what RBI is doing. And specifically about the the prospects for cooperation between India and America. One is that we are seeing that as a result of many progressive steps taken by the government to open up certain sectors, say in mining, defense. Today, FDI is permitted almost in every sector. I don't think there is any issue where there is a demand that you open up with this sector. It is a closed sector, excepting very sensitive sectors or in the negative list. So there about which nobody can have any complaint. Every country does that. But otherwise, India is a very open country which is welcoming the foreign direct investment. The policies of Reserve Bank of India also, they have taken many steps to open up the markets. The opportunity to invest in the Indian bond market, that has been opened up. In fact, what I find is that many companies, and particularly from Canada, they have seized this opportunity. And the investment of Canada by likes of Brookfield or Canadian Pension Fund, we are seeing a lot of activity, investment activity. So there are opportunities in renewable energy, there is opportunities in waste management, there are opportunities in road sector, there are opportunities in railways. So India, because we are still at the early stages of development, and the opening of the economy has happened in a big way. So in such a scenario, I don't think that there are many policy level issues. The only thing is, of course, that in India, there are issues around land and labor. And many times, many approvals, they also are dependent upon the local governments. And that is where sometimes bottlenecks come. And again, I think this is something which is on the radar of the government, and efforts are being taken even to address these issues. So in such a scenario, I think India is still a country full of opportunities. And India and America, they are natural allies. And I would not look it from the prism of what is happening with China or the larger political issues. So that we should keep aside. That is a different thing which will be dealt with in a different manner. But otherwise, what I find is that there is a certain affinity at people to people level. In India, people have always preferred US as a destination for education, for settling even, for cooperation in IT. Whatever we have achieved in IT, it first started from Silicon Valley. And the role of Indians in development of Silicon Valley is phenomenal. Today, large IT companies in US are being added by people from India. So that way, that I can say, if I can say that we are natural allies in my view. Despite, I'm not talking anything to do with the geopolitical. It's pure people to people economic cooperation. And opportunities are infinite. And the approach of the government also has been to facilitate the flow of international capital, so that because India in any case need capital, and domestic capital is not sufficient to meet the development needs of the country. And that is where the cooperation between India and US comes in. And that is where I believe that Indo-American Chamber of Commerce, they play a very critical role in bringing the businesses together, looking for opportunities together, and looking for identifying those areas where there is a scope for cooperations. And this annual convention itself, this is an annual convention, and it enables the businesses from both sides to interact, dwell on the issues, and definitely the issues raised or the issues which require attention of the government, they can be formulated, put to the government. But the government, I find, is very, very open to all the ideas, and there is a willingness to remove if there are any impediments or roadblocks. So that I can definitely give an assurance to all the potential investors who are looking at India, that there is a certain amount of openness. And State Bank of India being present in both the countries and being the largest lender, we are ready to play that role wherever we as a banker are required to play that role. So thank you very much for giving this opportunity. I don't know whether I have overshot the scheduled time.
Not at all, sir. Because we want to see the dream of $5 trillion economy. Yes. That is our dream. And that's where we want to be the part of the link, to see that both sides benefit. It should be a win-win situation. It's not
Absolutely.
like we only want their funds, but we are also a huge market, consumer market, and we have young, dynamic people here, who have a lot of skills. So, and India is a perfect partner for US to
Yes.
business with. So we want to quickly get into this $5 trillion economy between us, and I think SBI plays the biggest role in this country, because you have been the first bank associated in US. So you are the right person to tell us how the funds are coming into the country and what is the positive indications on the other larger capital market.
Right. So thank you very much. And if if there is any question or anything you want to ask, I am open.
Let me just look at the questions.
Yeah, something I can see on the screen about the IBC process.
That was, earlier about stressed assets. We had different programs today. Mr. Maheshwari has been coordinating it today and tomorrow for all these things.
Okay.
Arundhati Bhattacharya she's coming tomorrow also to speak on different subjects, because we've taken a panorama of all the issues connected to banking. And but we were very keen that you speak, because your strength is different level in our country. You're the backbone for banking. So we were very keen that you come, and we are also trying our best, with tying up with the consul generals in in United States. And in fact, we are supporting the Indian Consul General in Houston with India, Arkansas partnership in food processing, logistics, and manufacturing. We have a MOU with Arkansas State. So like that, Chicago Consul General, Indian Consul General, and San Francisco, Atlanta, Houston, everywhere, they're connecting so that any hitches are there or glitches are there, we can immediately, correct it through the CG of that particular state. So we're trying to connect all the states, in case, they have any issues about really manufacturing issues. So we're very keen that a lot of manufacturing comes into our country. That is the way we can really grow. And but any other advice you give to us, sir, please give us, because we would like to, hear from you.
Yeah. So no, that's fine, unless there is a specific question, and I've shared my thoughts. And as like you said that India, we have certain advantages, and definitely demography is one of that. The technology prowess which India today has, that is another. We have a large startup universe. We have done a lot of innovation in the financial services. So that way, there are many, many positives for India. COVID-19 was a very unfortunate development for the world as a whole, and so is the case for India. Otherwise, the prospects for the growth of the India, they remain very, very bright, and a lot of reforms are taking place. They have been announced or are in the process of being announced, and that gives us a lot of confidence that we will be able to deal with the COVID-19 situation well.
So do you see a lot of funds coming into the country? Is there a lot of initiative from the investors from US?
No, there should be. And sometimes I'm surprised that why it is all that so much investment is coming from other countries and not from US. So I think there's more scope for the American companies to invest in India.
We have a session, sir, on 28th about investments coming into India. And Invest India, Mr. Deepak Bagla is speaking there. And we have Reliance CFO speaking, because they've got the maximum funds for Geo platform, and different people from US also. They're coming in and speaking about investing in India. So we're encouraging that. At the same time, we also have investments in US, and that's also led on 29th. And that's the day US ambassador is speaking to our members. So as part of our thing, and And also we were looking at Indo-US, any legal disputes. We're having Justice Arjun Sikri, a former Supreme Court judge, is leading that, so that we know how to resolve these disputes through arbitration or whatever route. And we have pharma sector. We're doing a big way with US FDA and giving a technical knowledge. And we're having Dr. Ella from biotech from Hyderabad. He's going to speak about vaccine. And so we have lined up many series of events, and we wanted you to start it. That's how we insisted that you come in on this banking.
No, thank you very much. Thank you for giving me this opportunity, and it is really indeed a pleasure to address all the participants. And I wish you good luck.
Thank you so much,
in
sir.
all your efforts.
We have a very small gift, very, very small gift, just a meaningful gift of giving you a planted tree in your name. It will be put in some rural area in your name. And that's a humble gift to you. To make.
Thank you so much. Thank you.
Thank
so
you
today
very much.
everything is virtual. So please, I hope this tree will be real.
We will send the certificate to you, and we'll make sure the tree is planted. It will grow well.
Okay. Thank you very much, Rajesh.
Thank you. Thank you so much.
Bye.
We have Sekharji, and then we have a small thing on wholesale banking. Anil Gupta is to make a presentation. Then we get into 5 o'clock, Jaspal Bindra's session.
Dr. Shekhar is coming on.
He's there, I think.
He's there. He's already here. Yeah.
He's already logged in.
Please switch on your video and your.
Anil, there is one session just now. After that, I'm going to call in.
Sure.
Murthy.
Dr. Shekhar, you are on mute and your video is also not on. Please.
Dr. Shekhar, will you come in, please?
Oh, he's left already.
No,
he's there. Okay. He's there. He's back. He's back.
Yeah, he unmuted. Dr. Shekhar, we can't see you. Can you open up your video?
Yeah.
There.
Okay,
Yeah.
Dr. Shekhar, welcome to you.
Yeah, thank you. I could see, but I could not see myself. So I thought there's something.
Sorry, we had to delay your.
No, something very good is going on. I'm part of you. There is no need of sorry between us. Something going on good for us.
So let me just introduce Dr. Shekhar to our attendees. Dr. Shekhar is the chairman of Global Smart Cities Panel. He has been promoting the doctrine of secured governance for a self-sustained economy. He has written 80+ books on secure techno-economic national growth. These books cover Indian states, what they have and what they need, and different growth-oriented sectors such as highways, railways, industry, tourism, sports, agriculture, education, power, healthcare. Dr. Shekhar has presented his papers in many international forums. Dr. Shekhar has done research leading to PhD from Mumbai University for work done in nuclear physics in BRC and solid state electronics in TIFR with international publications. I'm pleased to introduce Dr. Shekhar's book on unleashing Indo-US economic growth through smart, secure governance. Now, I would like to just request Dr. Shekhar to say something about this book. And the forward note is to the coffee table book is already put it on the in front of you. You can look at it. If you want, I can read some of it.
No, we'll read that.
You can read that?
Because you are all short of time. So let me put that.
I'll at least read some of it. The author has taken great pains to go over to each sector and has defined the strengths of each country and how to enrich the growth. Banks and financial institutions would also greatly benefit from the book, which dwells on smart and secured governance for strategically achieving the results. I hope the business enterprises, with the support of the government and the financial institutions, would fully take advantage of the researched facts and figures presented with ways to achieve techno-economic growth. ISSC would like to place on record our sincere appreciation to the author, Dr. P. Shekhar, for the effort to bring out this book. I didn't tell the beginning part of it because you said you rushed me. I only said read half of it, but of course it is there. And we're very happy to have this book as part of our system and that you're releasing it today. And can you say a few words, please?
Yeah, thank you. Thank you. Since there are a few words, I would only say that this is not virtual, this is real. This is and this book is almost 200 pages, and it has got all details which are required for the growth between India and USA. Now, coming to the gist of the concept behind this is, when we use the word secured, smart, all this governance and all. See, today the economy can grow only when there is a real money, technology, manpower, and the necessary skills. So for all these things, secured governance, where does it come in picture? The word which is used, smart and secured governance, is that there has to be self-sustained economy. The economy which is perpetually dependent on the taxpayers' money for development can never succeed in long run. So here in this particular system, it is a value which is created by the technology, which will give valuation and which gives a fund for development. So with that small one-line description, this itself is a vast topic. Many people are doing their own research and PhD. So it's a very simple way to understand what is secured and smart governance. So even when you say smart cities are required, what does a smart city do? It brings synergy. The same thing where 1 acre of land was costing 10,000 rupees becomes 120 crores. Why? Because there is synergy, there are people, there are enough strength built into the system. Same way is something which is called blue economy. India is a country with 7,500 kilometers of seashore. That itself is $1 trillion economy. So when we use the word that India wants to be $5 trillion economy, and this book is concentrating on Indo-USA coming to $500 billion trade, which is today hardly little more than 100 billion is what is today's strength. So it calls for a huge amount of efforts. India and USA, if we don't combine together, we are gone. Okay. And if we combine together, we are both democratic country, we are both well-meaning countries, we are both whatever be the political system at that particular time, nothing is perpetual. Whereas we'll be eaten by, I need not tell the names of the country, we will be eaten by things which are not good for the world. So we need to combine. Second aspect is, which is not covered in the book, of course, is India has a very good relation with Africa. So Africa can be whatever India was when long back, when India became a subcontract facility. India has got Africa to generate items at the cost with which the other countries are able to give world the market. So India becomes a good leader in its own capacity, so that it gives the world what it wants. This $500 billion is not anybody's imagination. It is not any number. It is just a growth figure. It is just a growth figure. It has to go far beyond, because India has by itself to feed 1.4 billion people. And India and USA together, USA is 1/4 of India's population size. So in US, of course, the value of money is different in USA. So USA also has to grow, because we don't depend on each other for putting the hand on each other's pocket. It is the money which is by the valuation. That's where the smart and secure governance comes in picture. So with that particular thing, I would like to thank Mrs. Rao, thank Ora, thank Sunit ji. Sunit ji is the is the king of is the Bhishma Pitama of the India's infrastructure and finance industry. And since there is a paucity of time, at any time I'm always available. And these type of books, these type of things are absolutely required for people to understand. Other people think it is all only in this show this come. This book actually defines each sector, how we go, what we do, where India will come in picture, where USA will come in picture, and where both of us join together and make the world a better place to live in. Thank you so much.
Thank you very much, Dr. Shekhar. Thank you very much, Mrs. Sunit. Do we are we doing the next event?
Yes, that's a very short one on because Anil, can you unmute yourself?
Yeah,
Yeah.
yeah. Hi, Sunita.
Anil, I think since we have another session at 5, can I just suggest that you take us rapidly through your wholesale banking? So now wholesale banking actually was a full scale session, and I think we had to accommodate. We wanted to hear Chairman SBI, so we restructured it around, but there was a useful presentation that Anil has made, and the important factor that has happened in the last maybe more recent 3-4 years is that there has been a presumption there has been a greater focus on retail banking. We probably not focused so much on wholesale banking. If this was a full session, I would have had a lot more set of questions, which is on project financing and things like that, which is not fashionable anymore. But coming back, I think let's hear Anil, and then we move on to the next session.
Yeah, thanks, Sunit. I think the topic is quite apt, especially in the backdrop of the trends which we have seen in the wholesale credit. So if you look at the charts which we have shared, the share of the bank credit in the to large industries, we have seen a consistent declining trend for last maybe 5 odd years. And on maybe a YOY growth basis, if you see the credit actually turned negative in financial year 17, the demon year, but subsequently there has been some revival, but it remains much low and very low single digits. So overall, what is happening is because of a relatively lower growth in the wholesale piece, plus a higher growth in the retail piece, the share of the large industries in the bank credit has been declining from, let's say, a peak level of around 38 odd percent in financial year 13 to around 26% in March 20. So the situation continues to be like of a risk aversion, whereby we saw because we had high level of NPAs, we saw in earlier session that large industries were major contributors to NPAs. So a lot of risk aversion crept in into the bankers, and the lending to the corporate sector or the large industries that substantially declined over last couple of years. On the contrary, the wholesale within the wholesale segment, we had NBFCs where we saw a significant rise in the YOY growth in the credit flow to the NBFCs, and the share of bank credit to the NBFCs rose from around 5% levels to currently at around 9% level. If we have to include the housing finance companies also, which will be accounting for around 2 to 2.5 lakh crore of bank credit, the total credit to the non-banks plus housing finance will be upwards of the liquidity issues faced by the non-banks, which resulted in their increased reliance on bank funding to meet their repayments and liquidity requirements. So overall, the credit to the core sector, which are the manufacturing entities that declined and services to NBFCs that went up. If you have to look at the certain segments within the core industries like power and steel. So again, as in the morning session, Mr. Sunil Mehta talked about the issues in the power sector. So we had significant NPAs in this sector, and the lending to this sector was curtailed only to the fresh funding in the renewable space. And we saw a significant decline from around 30-40% levels, which we saw in March 11 to March 14. It is coming down to like a negative degrowth in terms of bank credit flow to the power sector. Overall, the share of the credit went down from upwards of 9% to 6%. And similarly, if you look at the steel sector, because that was another sector where we had high level of NPAs when the asset quality problem started. There also the credit flow, incremental credit flow has gone down, and the share of bank lending to this sector also has declined. So basically, if you look at, these are the core sectors: the power, the metals, whether it is iron or steel or non-ferrous metal, the credit flow from the banks has declined year on year to these sectors. Even if we look at the some of the other core sectors like cement and roads, we saw the decline of the credit flow because of the issues again which we witnessed in the road sector, where we had significant cost overruns and time overruns in the road projects, because of which the viability of these projects got challenged, and the NPA levels on the banking system went up in this sector. Cement, though, has been performing well, but because of the decline in the infrastructure spending, our demand for the cement has been not to the expected levels. The demand has not been growing. So that way, the fresh capacity addition was limited in the last couple of years, as against like 20 to 30% growth in credit, which we saw during till financial year 15. So to sum up, these few slides highlight that how our core sector investments are suffering because of the NPA issues which we saw in the last cycle. Within the other infrastructure sectors like power, steel, we have discussed, cement, we have discussed, road, we have discussed. There has been some uptick in the telecom sector credit, but that telecom sector credit was more driven by the distress, which we can say, which the telecom companies saw during last couple of years, whereby their funding requirement went up because their own internal cash flows got impacted. Plus, there were few new capacity addition because of the geo, which also led to the increase in some credit demand from the banking sector. Overall, in terms of other infrastructure, also the share of the other infrastructure also languishes, and the year-on-year growth in this segment also remains weak. So, to sum up, in terms of the wholesale piece, the core sectors continue to suffer in terms of our credit supply. The share of the bank credit flow to the real economy has got impacted, and the wholesale piece is largely driven by the NBFC sector. If we have to revive or achieve the objective of $5 trillion economy, we have to keep investing in our core sectors, core assets, to create the physical infrastructure and meet the demand for the growing economy. And for that, we need to resolve the stressed assets fast and minimize the losses to the banks so that they can regain the confidence to this lending to this sector. So with that, I'll conclude my remarks. If we can take up any questions if there are.
I don't think there are too many questions at the moment on it, except that I probably just make a comment, and maybe some other time and at some other forum, we need to really debate this whole issue about if Atmanirbhar Bharat has to happen, who's going to do project financing and infra financing? And I think that's a question. Today, there isn't enough appetite, but not for today. Some other day, I must thank you for a very useful presentation that has been made. I'm sure people can take it. I wish we could have had some time to discuss this more, but not for today. Thanks once more. And Anil, as usual, a certificate of another tree that is being planted. So you are responsible for 2 trees, if I may say so. We'll reach you. Many thanks for patient hearing and waiting. Thank you.
Thank you very much, Anilji. Thank you very much.
So coming back, I think Satya, you need to just see whether other participants, Mr. Rangan and Mr. Jaspal, have logged in. Anant, I can see, has already logged in. Yeah. Satya, will you please see whether they are on it? I'm not so sure.
I think, Sunit, there is one question on the chat.
Yeah. Where is it? So you asked this question, Anand. What is it?
If there is a time, so there's a, yeah, the question is their role of ratings for mid-sized corporates for getting liquidity. So what I'll say is, as a rating agency, our role is to basically act as a facilitator or provide the great view, independent great view on the corporates, we have some limitations, like we have to assign the ratings on a 20-point rating scale for all the corporates, though there are separate rating scales for MSMEs, where we can assign the ratings for the small corporates on a different MSME scale. So what happens is, like with the independent view on the credit, the information asymmetry or the information an independent view gets established, and possibly that can help the borrowers maybe pitch in, if you have a good credit profile, a good credit report from an independent agency, that can help you in getting the credit at a favorable terms and a pricing. So that's the only thing which I will like to add.
Yeah, I think that's good to hear. Maybe through various chambers, you should reach out to the industry and inform them. But Anant, I think Jaspal has come in, and I'm just looking at it whether our friend Rangan has come in. But
message him as well.
Yeah. So, but I will just start with a brief set of intros for the audience, which is there. Anant is a long-standing banker, hardcore banker, who has taken to evangelism and teaching and and things like that. So yes, we share a lot of common interests with respect to this sector, particularly on the liability side and on the debt markets and the NBFC sector that we keep debating, and stressed assets. All some of the issues that we have probably had a discussion today. But without much ado, I would also let him get into the session. Jaspal Bindra, most of you heard in the afternoon over luncheon speech, where he gave a fairly freewheeling perspective of his view of the banking sector, and lots of issues we gathered from that. This is probably a more specific thing. He himself has become an entrepreneur in an NBFC, and I think we would like to understand his perspective on the NBFC sector, particularly since several people in the market are a little bearish about the moment they hear this bad four-letter word. And, we would also, I have requested Mr. Rangan to come in, and I'm sure he'll join in. But Mr. Rangan is a hardcore, coming from HDFC, and if there is one successful NBFC that you talk about in India, that's really HDFC.
Yes, come in.
Yeah, there he's coming. Hello, Mr.
Right on cue.
So I think, I thought when people are wanting to discuss NBFC, what better than have Anant discuss this topic, and with a person who has come entrepreneurially and chosen to be entrepreneurial with an NBFC, that is Jaspal, and with somebody who has seen HDFC over the years actually gain from strength to strength. And I think one of the key points that I have seen with respect to HDFC, not only is there careful asset growth or asset planning, an interesting thing, but their ALM and liability strategies is something to learn from. And I think I will leave it to Anant, you to go through with this session, and can we hear from them. Now, there is supposed to be somebody else. Karthik, are you there? Karthik?
He's there. Karthik, you want to switch on your video?
Yeah, I think he had a small presentation, so that sets the stage if he is online. Otherwise,
so what I suggested, Suneet, is that we go through Q&A rather than going through presentations. Since
all right,
3 people,
okay.
we just do this.
Do that, no problem.
Yeah, and that will hopefully.
I leave it to you.
Yeah. Karthik, yeah, thank you. Thank you for putting on your video, Karthik. Great to see you as well. First of all, thank you to IACC, real pleasure, and Suneet, to you specifically for arranging the whole day and especially the session, and giving me a lovely job, which is to ask all the tough questions from these three gentlemen out here. Easiest job on in the world, and I hope to make them squirm. What we'll do is we will have an open discussion. Anybody can button. This is like Arnab's show, so you can all button whenever you want. Agree and disagree with each other. That's absolutely fine as well.
No shouting.
Don't worry. We've got three thorough gentlemen out here, so
Yeah, of
no
course.
fear of that happening out here. No, but we'd like to cover a lot of ground. We'll start with the customary and inevitable macros, which is a completely useless topic, but we'll get rid of it quickly. And then we'll go on to the more important things like asset quality and what's the quality of liabilities and the future for NBFCs and asks from stakeholders, etc. But I'm going to start with my former boss, actually my former boss's boss, which is Jaspal. Jaspal, what do you make of the world right now, and particularly for us in India? Minus 23.9% first quarter growth. Goldman Sachs now saying minus 14.8% for the whole year. Looks like a washout year. Wish 2020 could be fast forwarded. Is the worst behind us? Do you see things growing better from here? Do you see your clients stabilizing and starting to operate again? How do you see what does the crystal ball tell you right now?
Firstly, hi Anant. Good to see you on screen. I think percentages really don't matter. I think we know directionally it's a bad year. And for some, that 20% or 15 or 12% will sound like everything is gone wrong. And for some, it will be a small blip. And for some, it's actually great time because they are actually being able to, take this opportunity to capitalize positively. Yeah. But I think if we look at it from where we are in the journey of whether it's behind us or ahead of us kind of thing, it seems like the equity markets have more or less reconciled. Global equity markets have reconciled to believing three things, I think. One is that the stimulus that has been announced will be delivered and there'll be abundant liquidity in the system. The second, maybe related to the first, is that interest rates will probably stay near zero for some period of time. And the third is that a vaccine is somewhere near. Now, near is difficult to define, but it's not something that won't happen or is unknown for a long time. So I think the equity markets, for all the madness that we attribute to the equity markets, I think they have made the call based largely on this kind of understanding. I think personally, I feel that whenever the markets have taken refuge from cheap and abundantly available money, they remain fragile. Right. So anything from the left field could come and burst this equity bloom that we are seeing. It could be geopolitical, it could be something else. So I would remain a little bit reserved on, I would hope this continues. That would be the wish. But I would remain cautious that there could be some very left side thing. Having said that, the one thing that, there's a lot of commentary about is that people are going to change forever and they're never going to do things they did before. And they will do everything very differently post-COVID. All the historical data points against that. And I can share personal experience from SARS. I saw that very closely in Hong Kong, Singapore, where it was quite serious when it happened. And the impact was very severe in real estate, in many sectors, people's lifestyles, etc. But it took less than 30-60 days for everything to resume to normal. And so I wouldn't put it past us again that we people will have the urge to come back and behave not very much differently from before. So I think that is, when we look at on the ground from our perspective, and of course, clearly Rangan will have a much broader perspective than I can have, given the size and scale of his business. It is a big city problem. Right. We don't have any problem in Bilaspur or in Raipur or in Trivandrum or, many places. It is really the 7 big cities that are creating the problem. I mean, or whatever, some 70, 80, 90% of the problem is there. So I think to that extent, a lot will depend on how vulnerable you are to those franchises or your franchises in those places. What do they make? I do believe that the GST numbers are quite encouraging,
right.
In spite of lockdown. But to me, that is how I would place it. I think it's difficult to tell exactly, but I think we shouldn't get too swayed by the very good things that are happening. But I don't think so we should worry so much as well that things will never come back for a very long time.
That's very well put, Jaspal. In fact, you made me change one of my favorite dialogues nowadays, which is that everything is going to change post-COVID. So I'll have to read. But Rangan, I'm going to come to you next. Jaspal talked about global liquidity and stock markets being high. By the way, Bank Nifty is still down 30% for the year, which seems to indicate there are other issues going on in our financial services ecosystem. But how do you see the crystal ball from here? What does it tell you? Are things getting better on the ground, you think? Will the economy stagger back to shape? Are your clients looking okay now after 6 months of COVID?
So I can probably talk for the real estate actually, and more particularly the commercial and residential part.
Right.
Actually, if you really ask me, when the whole thing lockdown happened in March, if you had asked me the question at that time, when do you think it is going to come back, I would have probably said for the next 6 months, completely write off. Nothing is going to happen, and probably we'll start seeing it after 6 months. So this year is written off, something like that.
Sure.
But interestingly, what happened? So March we closed at towards the middle of March, the lockdown happened. So the March numbers didn't materially showed a shortfall or anything because you had a 15 days which was still working. April was a total watershed. So there was absolutely, if you were to look at something like our number, we used to do something like close to about 9 to 10,000 crores of retail disbursements every month.
Right.
April, we must have done some 200 crores. So it was a watershed. But actually, as people started adapting to this whole issue, I think what happened was May was slightly better than April. But as we got into June, he released the numbers also. June, we actually came to almost like 80% of June 19.
Right.
So what we did in June 19, we came to almost 80% in June 20. And of course, the current July, August have also been showing a similar encouraging pattern. And a couple of things have happened, whether the government has also now opened up the, the stamp duties. And now the stamp duty is very, very attractive in Mumbai. So you pay 2% and 3%, 2%, and it is time bound. So I'm sure that this is actually pushing a lot of sales and pushing a lot of guys who had already done some agreements to go and register it because they actually now lock in the stamp duty at a lower level. And that's one part which is, I think, showing up good signs. Having said that, there was a concern on the commercial side. Well, there was a concern was there about people negotiating rent and trying to sort of vacate the premises because they won't require now everything. As you said, the life is going to change from here on and all that stuff. So that was the feeling, and it's actually mixed there. Actually, people have renegotiated rent in certain buildings and all that, but some of the large occupiers, particularly those who have gone into something like a REIT and these types of large properties, based on discussion with them, it appears that there has not been any significant renegotiations or anything. But whether they will get into a increase which is due in the next 1 year, 2 years, we don't know. But certainly, I don't think significant renegotiations have happened. People have asked for waiver for 1 month or 2 months during this period and all that, but nothing very significant on that at this point in time. But whether there will be a reduced space for most of the commercial demand, whether it will go down or whether people will require lesser space and all that, that I think, as you said, whether the life is going to change, and Jaspal said the life may not change significantly. I think somewhere it is in between, I suppose so. And people are now readjusting to come back. And at some stage, what happened, there is a lot of fatigue also. Sitting at home and doing was very encouraging in the initial period. It's very good, all that stuff. But as you are doing it now, you feel that it's much better go to the office, work for 6-7 hours, come back, and then you have different life. Here the life actually starts at 10 and it never ends. You really don't know whether you are ending at 10 o'clock or 8 o'clock or 9 o'clock. So I think it's a good thing, but I can say for real estate, yes, the problems which you had heard prior to March in terms of projects stuck or whether the sales being slow, that still continues in some areas. But the green shoot is that with certain these concessions and all, people have started looking at it more positively. And also in a real estate, residential housing, what has happened is as an asset class, as we have seen as the lockdown happened, people have actually looked at various asset classes. People have gone into capital market, people have gone into gold, and real estate is also one of the things people are saying was the price is now very low. And if work from home is going to be the new order, I will need a little larger space. So people are actually, the number of cases which logged in with us during this period, the sanctions, normally we lock in about 14-15% of our sanctions for a month, or properties which are not yet identified, which really means people are making up their mind to buy and all that. So that proportion actually went up to almost 20-22% during this lockdown period, which means that people, maybe they don't have much work at home, so they are now thinking of what to do next. And I don't know, you could ascribe many reasons, but the legacy issues, I don't think they have come to an end. The legacy issues are still there.
Sorry to interrupt, but can I ask you very quickly, when you talked about June was 80% of disbursements, for the industry as a whole, where do you think we are now vis-a-vis last year? Let's say for August to September compared to last year?
August to September, I think we should touch about 95, 100 definitely. I think.
So you're back to almost 100%, you think?
Of the previous this thing. Yeah.
Okay, that's
the way it is right now.
That's great to hear.
In fact, if you ask some of the developers, you are not getting time in the sub-register offices for executing documents. Everybody is actually rushing to sign and lock in, because up to December you have 2%, and from I think January to March is 3%. And in Bombay, the property values are high, and it makes a lot of difference actually. 1%, 2%, it makes a lot of difference. Yeah.
Great. So that's a good segue to you, Karthik. Two questions for you. One is, of course, on this macro. Jaspal made the point that it's a 7-city problem, that maybe rural India and semi-urban India is not that badly impacted. So are there winners and losers? What sectors are doing well, not well? So that's a macro question first. The second question, segueing from there, is asset quality. I saw your presentation, which unfortunately I'm not letting you present. But do give us a glimpse about how you see the asset quality for the financial sector, particularly for NBFCs panning out from here on a sectoral basis. So all yours, Karthik.
Sure. So what we are seeing is, sectors where the borrowers are prime. Somebody like a home loan borrower, the performance is much better, and the collection efficiencies have come back to almost 80-90%. The others, the smaller ticket loans like two-wheelers, gold loans, etc., where the performance has been much better and improved than what it was in the past. It still has not reached a level where it was pre-COVID, but there. The third is essentially the rural part, tractor, etc., where the collections have improved substantially. So these are the 3-4 large sectors within the NBFC space where the performance has been better.
So when you say collections have improved, are they back to pre-COVID levels?
No, never. I mean, they've reached close to about 80-85% of the pre-COVID levels across most of the sectors that I mentioned now. The worry would be for us on the commercial vehicle piece, which is a sizable component within the non-banking space. The loan against property or the mortgage loans, where the collections are still in that 65-70% levels, and that's a prolonged 60-75% kind of levels for the last 2-3 months, which is somewhat a worry. One has to see how that September numbers pan out, because what we understand is the borrowers are taking the full benefit of the moratorium, and the benefit of that or the actual performance or the risk will be visible in September. So commercial vehicle, related construction equipment, and largely, the real estate part. One has to understand that the non-bank real estate book is a relatively newer phenomena. The buildup has happened essentially in the last, 4-5 years. And what we see is sizable amount of the portfolio is still under moratorium, the fate of which is, yet to be decided. One has to see how the performance actually pans out. So in that context, I think the concern, if I have to bracket it into three large segments, would be CV, mortgage, essentially a borrowing which is backed by a mortgage, loan against property, or MSME or SME loans. And the third would be the real estate part, where the early numbers, if I have to put it, let's say the housing finance companies, which do have a sizable share of the overall NBFC real estate exposure. Almost, I think, about 20% of the housing finance exposure is to the real estate part.
Right.
The March, that component numbers were close to about 5% NPAs, which used to be in the sub 2% 2 years back. So we still have a sizable book which is under moratorium, and we really don't know how that would pan out. So monitorable would be these segments for us.
Okay, thanks a lot, Karthik. I'm going to ask you a tricky question now. What do you think will be the level of stressed assets which comes out of all of this eventually when we emerge out of I don't even know. September quarter, I guess we will still not see full disclosures. Maybe we begin to see something in December and March. Do you have a sense of where we could be heading in terms of stress assets as a whole?
I mean, what I can give you is an intelligent or rather expected kind of a number. I don't know. I don't know what it will pan out, because I think many of the lenders are yet grappling with what do they call as restructured, and what kind of schemes do they come out with. Many of the larger entities have not even come out with the scheme, and September would be a period when they would look into collections and decide upon the scheme to come out with. So a broad number, I'll tell you where I'm coming from. Essentially, we are looking at the percentage of borrowers who have not paid an installment for the last 5-6 months. Because
Right.
that's my immediate worry, and especially the assets which are, I mean, of those borrowers who are sitting in the verge of falling into the NPA bucket. So, that number has come down, to be very frank.
Sure.
Because the 5-month period, at least, if they are sitting in that verge of the NPA slipping, so one or two of them installments have been paid and they move back to the earlier bucket. So the restructuring is essentially available to the guys who, prior to COVID were in the less than 30-day bucket, right? So that number could be somewhere in that 5 to 10% range who would be eligible for restructuring. Whether they opt for restructuring and the lenders, extend restructuring to them is something that one has to understand only after the schemes are announced. So the eligible, I put an eligible number. So that has to be seen in that context.
Last question very quickly. You mentioned commercial vehicle, LAP, loan against property, and real estate loans. Retail loans, what is your sense? You hear these CMI numbers saying 21 million salaried jobs lost. The level of retail moratorium was extremely high as of April. Of course, a lot of it, I'm sure, has got paid thereafter. Do you sense that there is some worries on the retail side at all?
Within the NBFC space, the retail is driven by, I mean, when you define retail, I presume that you're talking about the personal loan, the lifestyle loan kind of aspect. You have only a few large players who do this in a big scale, right? And what we see is that the percentage of moratorium is coming down, essentially on a month-on-month basis. While that being said, the underlying stress for that segment is likely to remain high. I mean, although we are seeing higher percentage of moratorium in a secured asset class, let's say a LAP or a commercial vehicle, and the percentage of moratorium in the personal loan segment is lower, one might really see that both might converge, or possibly the personal loan segment might report a slightly higher ultimate loss than the secured asset classes. Too early to say, but the numbers are quite encouraging, is what I would say.
Thanks a lot. Jaspal sir, coming back to you, a couple of questions for you. One is, I mentioned this to Karthik as well, which is that the level of disclosures aren't perfect at this point in time. Particularly with moratorium, different entities are adopting different standards for disclosures, etc. And as Karthik was saying, we really don't know how much will be going into restructuring, what will the NPAs look like, etc. What is your best sense of how the industry is going through and what it's going through right now? How good or how bad do you think it is? Should we be worried, or is this something that we can get away with? The second part is, there seems to be a bit of a trust deficit around the financial sector as a whole, and particularly around NBFCs. Now, of course, there are brilliant NBFCs, brilliant banks, but I'm saying as a sector as a whole, and you often find valuations going at a fraction of the book value purely because there are these questions about asset quality and what can come out. Do you think the industry ought to come out with better disclosures and try and remove these monsters under the bed kind of phenomenon which you're going through right now once and for all? Do you think, I'm going to get beaten up by you for saying this, but do you think we should actually do an asset quality review of some kind and lay to rest the devil that there are big problems in the asset side?
Yeah, Anant, no reason to get beaten up. I mean, just to tell you, I'm part of a small group of NBFCs who we have represented to the RBI government. All the systematically important NBFCs should go through an AQR. There are other challenges with that, which I can discuss. But on the disclosures, I think clearly there is, actually, if you disclose correctly as per what the RBI has specified now, everybody is going to have a fantastic first quarter because there is no NPA. All collections have to be treated as if they're 100% collected, whether they're collected or not. And your costs have come down significantly because a lot of the operating costs has disappeared. And people are also sort of taking salary cuts, etc. So I think that's just the facade or the optics. But I think there is reason to be worried because I think everybody on this session has said so, that collections clearly have improved over this period. And so one way of looking at it is that once most people have reached an 80% kind of collection, then at least the only thing that is at risk is equity. And so one way of looking at it is we are now no longer working for ourselves. We are working for the banks because we're just doing enough to pay them back. But really, at least you're in that range where what is at risk is your equity. So I think that 80% hurdle is quite important. Anything above 80 at least gives you that comfort. The other issue that we have is that, what is the scope of the restructuring that is permissible? I don't think so by itself. Restructuring or the number of people who take restructuring is going to be the right signal. I would actually support, one of the things that has happened during this phase, Anand, is that your best customers actually became the most vulnerable. And that is because the banks have a cost of funding at 4 or 5%. They are happy to do book transfer. Nobody wants to go and look at new customers. They want to see people who have had 3-4 cycles. So the losers were the NBFCs because they said, they are charging 10-12%. We can charge 6-7-8%. So clearly there was that. Now, that doesn't help, So my customers who were on moratorium, but in the same category, who are very good long track record of good customers, and we know they have the ability to pay, I'm much happier they are on moratorium because at least they are not a risk to being taken away on book transfer. So I think there's quite a lot on the micro side that will play out. But to come back to your question, I think there is reason to be worried because 20% is still a large piece that is to be seen how they play out. I think within the people who are taking moratorium, there are clearly 3 categories. We've reached out to each of our clients again and again, and it's possible for us because we still are of some modest size. There is one that is just very comfortable holding the cash and saying, okay, I'll take the interest burden, but I don't want to be out of cash because the world is too uncertain. How long will this last? I don't want to be out of cash. There is another that feels, which is the other extreme. Maybe Supreme Court will have 1 weak moment and, I will never have to repay this. And so it's a lottery and I'll just, if I don't take it, I have no chance of that lottery. Let me take it and keep the option. And then there are genuine, I think there is genuine. And I think analysis and effort is being in try to figure out how many fit in each bucket of the people who are continuing the moratorium. And I think if we can make a good sense of that, that will actually give us a good play. Honestly, the analysis we have done for ourselves is quite encouraging, but reality will tell us later. The trust deficit, I think, actually I have maintained that NBFCs had their pre-COVID moment in 2018 October when ILFS really, I think that was a big culprit of the trust deficit, because you move from AAA to junk on day one. I mean, it's very difficult. And then it got followed very quickly by 2-3 other institutions that went similar. And I think so that created the trust deficit. So I think that has stayed, NBFCs have become a 4-letter word since then. And that is a reality because, you suffer the situation that gets created by the role models in the business. I do suggest that, so really there are 2-3 things one can look at. One is clearly you can keep shouting at the top of your voice, but most credit institutions don't have room for that sector. So it has nothing to do with you. They just don't have room. Of course, some room has been created under these new schemes that PSU banks are enforcing. But otherwise, in the normal course, they've all capped their NBFC exposure at a certain amount, and they are stuck with that. I do think your idea of AQR, which I've shared with you, we have also proposed, is a damn good idea. We think we should do that. But I think there is capacity even at the RBI, even systematically important. There's quite a large number of, but to be fair to the RBI, what we have noticed is we had one of our inspections during this COVID period. It was a lot more meaningful inspection than we've had in the past. And I was very happy for that. But how much it matters to the lenders is really important. And, I know that we have this program is jointly organized by the rating agency ICRA, but the rating agencies, because they've got a little bit, blamed for being a little bit liberal in the past, have now gone completely away from reality to the other side. I don't blame them individually, but I think the consequences of that are quite severe because we are curtailing credit flow. And really, if you look at a revival or even growth for that purpose in normal times, in the short term, the only thing that can produce growth is credit. So if you don't have credit, in the longer term, productivity adds to the credit and then gives you the full growth. But in the short term, it's only credit. And especially when we are in this, when we've been pulled back, to recover credit is very important. And yes, there may have been a few instances where the rating agencies didn't do justice in the past. But I can tell you now, almost across the board, they are doing injustice by being just too holy about, nothing must go wrong. You must have so much surplus. You must have so much this thing. I mean, that's not real. I mean, it's in the books.
Sure. So I can see Karthik taking notes out here. So hopefully there are some lessons being gone here. Very, very quickly, Jaspal, quick 2 follow-ups. When you talked about AQR as a suggestion, is this a consensus suggestion amongst all the systemically important NBFCs? And is the RBI also smiling on that suggestion? Or is it seen as the wrong time to do something like this?
I think it's, I won't go as far as saying consensus. It was a small group of us who thought about it, and we thought we should suggest it to the RBI to then apply it across everyone. So I don't think so. We had everyone's vote in it. I mean, I'm not saying they are not party to it. They won't be party to it if suggested, but we didn't get through everyone. But I think the RBI was very happy to receive, because we've seen it in the MFI, the MFIN body, which is self-regulated, just has so much more credibility than the NBFC, any NBFC association. And so to that extent, it was well received. But I think there are practical challenges of, resources, etc., to sort of manage this. And I think that's where it is.
And the second follow-up question was, you mentioned 80% collections. Just to understand, are you saying collections have crossed 80% for the industry now? Or are they well beyond 80% now?
So I think, in the businesses we are in, I can speak about, I wouldn't know about every business, but I think Rangan is sort of suggested from real estate. We are not in that business, so I think we'll take his word for that. We are in three businesses. We are in affordable housing, which are low ticket, 10, 12 lakh rupees housing loans. We are in MFI, and we are in the MSME, which is below no ticket size, in excess of 2 crores. So but mostly it's 20, 25 lakh kind of ticket size. In these categories, clearly, and we are only in secured, so we don't do any unsecured loan. So again, I'll qualify to that extent. But in this, clearly, we have seen in April we were down to close to 30% collection across most of these. But now I think we are well in excess, and in this. Most other players in these sectors are similarly placed.
Sorry, I had to switch my Wi-Fi. Apologies for that.
No worries.
Can you hear me?
Yeah.
Yeah, okay. I'm going to switch off my video because I'm on a backup Wi-Fi, which might not work too well. Ranga sir, let me come to you now. Your view on this asset quality question. And I'd love to hear your reaction on AQR, on whether you think we should be doing an AQR at this point in time. And finally, a quick view on the sector. I mentioned to you that, of course, it's not NBFC, but Bank Nifty is down 30% for the year even now, despite everything else coming later. So, so your take on the asset quality, trust deficit, and all these related questions.
So first, I think first taking up that asset quality thing. See, the problem with the NBFC, as Jaspal said, MFI, we know what that business is all about, right? So we know where it's a very homogeneous sort of a business. Whereas when you come to an NBFC, unfortunately, that homogeneity is there in some segment, it is not there in all the segments. So you have NBFCs which came in, which were doing a lot of non-retail businesses. There were some which were heavily exposed to real estate. There were others which were doing, different kind of things. So the homogeneity part is not there. And then there are commercial vehicles are there. There are personal loans are there. There is a housing finance is there. Within housing finance, you have got affordable housing. You have also got people who are doing MSMEs, LAP in a big way. So it's a very heterogeneous sort of this thing where you have to actually go into specific institution and decide whether there is any need for a AQR or this thing, depending upon the composition of the assets. That would be my first this thing. And typically these asset quality reviews on a retail side, I think it is fairly, the numbers are broadly also known because a lot of these pools are getting sold periodically, and there is a performance report which goes to the external agencies, and there is a certain amount of how much collateral has been drawn during those periods and all. So that gives you a fair reflection of where those numbers stand actually. Whereas in the case of a wholesale, this thing, which is where this, the whole ticket sizes which are very high, that is where this whole, the AQR type of situation may be somewhat warranted in, if you want to make this sector go forward into a very controlled and regulated sort of an environment. So all that I can say is that the assets which are like he talked about affordable housing, he talked about this thing, they have not actually shown any different sort of responses during this period, rather than what they have been responding fairly in a similar manner. However, a LAP has been a segment which has been impacted, and some of the SMEs have been impacted. But even within that, there are many differences are there between one NBFC and another NBFC. So I'm not getting into that. So my take is that it's not across the board. It will have to be seen and moderated depending on where the pressure is actually currently residing and all that stuff. The second aspect on...
apologies to interrupt.
Yeah.
overall across NBFCs and housing finance corporations, if I remember from the RBI Financial Stability Report, I think the gross NPA was about 6.3% of advances as of March end. Any guesses on where that number could end up, you think, let's say March 2021?
See, again, the point is that if you take us as an example, so we are almost, you can say, we say 24% of the market share is roughly with us, including the banks. If you take HFCs and this thing, it will be far higher on the retail portfolio. As Karthik said, again, it goes into the segment. For example, we normally cater to a prime segment, which is all salaried, whether it is private, public sector, school, colleges, and all these types of this thing, where the job loss or this thing has been, we have not at least seen those things happening. People who have taken moratorium, there is a higher percentage of LAP and other guys who have taken moratorium, but those overall in the aggregate portfolio is not very high. So it doesn't really change the matrix for some of us. On the affordable housing and all, based on, I have not seen the numbers per se, but based on my discussion with the other NBFCs which are doing there, they have not seen a very significant sort of lapse in terms of payment or performance of those this thing. And neither I have seen it in the pools which has been rated by the rating agencies. I have not come across any very serious negative reports around any of the pools. And so I would say that we need to go asset by asset and then decide. The pressure will be largely where the segments are SME, where there is a LAP, where there is a very, very low ticket size loans, maybe 1 lakh rupees, 2 lakh rupees types of housing loans are also there. There are micro housing finance companies are also there. So the performance and this thing will be reflections will be very, very different for all these asset classes. So that's what my take would be. But as of now, it doesn't show up as a major issue on a prime portfolio or where there is a collateralized, assets are there. The other important thing is that you touched upon the fact on the sector as a whole. Now, very simply, I think my take was that the NBFCs actually came in a very, very large number in the last few years. And we saw that happening in various asset classes, largely in real estate and, in some of the retails and other portfolio also. I think there was a little bit of euphoria because it all started with believing that you just put out assets on the NBFC balance sheet and you have a valuation which is standing at 3 times, 4 times your net worth. So your money actually becomes 4 times at the end of 3 years once you have put out an X asset on your balance sheet. The good part is that all these, lot of these NBFCs came with a huge amount of capital. And if you see a lot of them, their leverage ratios are very, very low. 2 times, 1.5 times. Their ROEs are very poor. So obviously the valuations at some stage will have reflected on those parameters because you can't actually deliver decent ROEs on those sort of leverage. And whether you can leverage beyond that number to what extent and all, there is a challenge on the other side. So I would say that the good part is that a lot of NBFCs which came in, they came in with the bags of capital and they did sort of deploy that capital very quickly and hoping that the valuation will catch up soon. And as they start leveraging, the valuations will start catching up and giving them a decent amount of exit values and all that. But that got stuck after the 2018 ILFS thing. Everything actually came into this thing. I think fundamentally, according to me, the NBFC business is, while it is people look at it as an asset side business, I look at it as a liability side, actually, in the sense that your strength is has to be on the liabilities more than on the asset side. Asset side you may have some higher incidence of NPAs today and you may recorrect it and you can change the course of your business. But your liability side has to remain extremely vibrant. So it is very important that you should have something, one, diversification is very important. And there are regulatory challenges about achieving a diversification in some sense, but diversification is at least very, very important. And the other important thing is that parentage. So if there is a very strong parentage, you tend to actually be strong on the liability side because you are able to access certain parts of liabilities which comes to you normally. Whereas if you don't have the parentage, as Jaspal also said, money has to come back from the banks and lenders have their own way of looking at it. And who should I look for if there is a problem, whether if there is no parentage or there is no significant promoter whom we can look at it. And post, of course, some of these private equity funded NBFCs got into issues. Banks have again sort of re-examining whether if it is backed by private equity and he's going to exit after a few years, how should I look at it actually from a funding perspective? So I think these things have emerged in the last 2 years or so in terms of how the lenders are looking at, and whether it is mutual funds or whether it is banks or whether it is the capital markets, everybody is looking at these types of questions, answers for these questions before they actually put out more capital. But by far, I think from a point of view of even raising capital, we have seen the at least the top line of banks in the private sector and some of the other NBFCs which are fairly very large, they could actually get capital. But the key question is that even at the capital level, from what I have discussed with many of the investors, I think they are really concerned about, I won't say they are concerned, but they really don't know where it is going to be, whether the money is going to be used for recapitalizing the balance sheet or it is for growth. So obviously, if it is for growth, they are more inclined. But there is a very fine thin line between growth and saying how much is going to go to set off correcting my balance sheet. So I think that is not very clear, because today, as Jaspal said, you will not see any, or Karthik said, you are not going to see any NPA numbers very significantly. June has been good. September will not reflect anything at all. But the fact of the matter is that out of the whatever moratorium or restructuring, what is going to be the eventual loss percentages? Are we going to see higher loss percentages or not? Which is the question which is asked by most of the investors as to this thing, whether the asset values will go down because of higher loan exposure, or whether the people will lose job, therefore they will not pay. So these are the main questions which are there on the capital side of this thing. But by far, I would say that on a liability side, I think it is very important. And as Jaspal said, that rating agencies ask for a very high cash on the balance sheet. Now, post, I think ILFS thing, NBFCs on their own, they have started building up higher levels of cash. But I think regulations are also changing now. The LCR coming in, there is a decent in terms of formula as to how you have to hold cash. All that I would say is, despite all that, what is required is that you will still require for stability in this whole NBFC segment. My belief is that we should have some something like a bank. Bank has got reserves on their liabilities. There is no reserve on the liabilities of the NBFCs. Even if at the cost of building up a reserve, if we can achieve a reserve and then we can have a window through which liquidity will be available in stress situations, that I think should be a very good thing, because on the asset side, if something goes wrong, you can't do anything. I mean, if there is a solvency issue, you can't solve it through these measures. But if it is a question of liquidity issue or a market turning sort of a little negative at some point in time, or global events, that is at the time when some of these measures could actually stabilize the balance sheets, and people will feel more confident to lend because they know that the money is not at risk. Asset side, obviously, if asset side is bad, you can't control it. Whether it is a bank or a non-bank, it doesn't really matter at the end of the day, unless there is a parentage of a sovereign which writes capital or puts in the capital at that point in time.
So lots of great points, Rangan, and you've moved from asset quality to liabilities, and there's a connect between the two. As you said, raising liabilities also depends upon what people think about your asset quality and all of that. So Karthik, a good segue to you. RBI and the government of India have done a lot to push money and liquidity into the system. They've directed money into SMEs, MSMEs, and to NBFCs as well. Things have improved in terms of market yields, etc., at least for a good number of names, the NBFCs. Do you see the asset liability management of NBFCs having improved significantly over the last couple of years, ever since, as Jaspal said, ILF has happened? Has there been a significant improvement? Or do you still see some vulnerabilities and risks that we need to be worried about here?
Yeah, sure. I mean, the liquidity has certainly improved. Post September 18, entities have themselves started creating more liquidity on their balance sheet and carrying more liquidity, essentially giving comfort to investors, including rating agencies for that matter. I mean, more importantly, post-COVID, when disbursement came down and inflows started trickling in, we could see that liquidity buffers further going up. This was further augmented to an extent from the various government measures, PCG, LTRO, government RBI. That funding has flown into the sector as a whole, especially for the smaller entities. And larger entities didn't have a problem at all. I mean, with entities with big names, big parentage, they were anyways able to get funding from the market. The most structural issue that one has to be more cognizant about is where the funding is essentially coming from. Now and between the last 1 year or so, the dependence on banks have gone up substantially.
Absolutely.
The capital markets for the smaller, mid-sized, or rather the not so large entities, if I have to keep out the large ones and the better ones, the not so large entities as the other category, there is hardly any credit flow from the the capital market space. The CP markets have significantly dried down. I mean, that is by design or by nature, one we do not know. I mean, what we understand is entities have become more cognizant about the short-term nature of CPs and are going slow on CPs. But the capital markets is out. So banks have been a more and more a sole kind of a lender at this point in time for a large segment of the the NBFC space. But that being said, one has to see that even the larger ones account for the bigger chunk of the AUM. I mean, there might be a few in number, but from an AUM point of view, they account for the largest portion. I have to give an example about 60-65% of the AAA rated entities account for the 60% of the AUM. So the AAA rated entities essentially account for 60% of the AUM. So that's the rough number for the NBFC sector as a whole. So there has been no problems overall from a liquidity point of view. The recent measures have ensured money going into the smaller entities. And as I said, bank reliance has gone up. One has to see whether there is a structural way out to ensure that NBFCs get consistent funding on a going forward basis. Most of these schemes are essentially short tenured, so somewhere going up to 18-24 months, while entities are looking for a more longer term fix to ensure that the liquidity is in place. So that is something that would be crucial for the sector as a whole, especially for the mid-sized, small-sized entities going forward. The larger ones, of course, are able to raise money,
right,
from the various sources, of course. Yes.
Great. Thanks, Karthik. Jaspal, 2 or 3 questions to you together. One is, of course, this liability discussion which Rangan initiated. How do you see it? Do you think money is forthcoming for the NBFC ecosystem as a whole to fund itself? And as Karthik mentioned, are you getting adequate, tenors, the right mix of tenors? Is there a concentration risk of too much of bank funding, as Karthik mentioned? That's the first part. The second part, again, something that Rangan alluded to, capital raising. Is that forthcoming? First of all, does the NBFC ecosystem need capital? And given valuations, etc., is it actually forthcoming? And the third part is, again, something that Rangan mentioned, which is, for funding, perhaps we require some kind of a backstop or an SLR, LCR type, arrangement with the RBI. Is the answer that eventually NBFCs, especially the larger ones, should morph into banks? Or do NBFCs have a rationale to exist as a standalone entity with last mile connectivity, etc.? Where do you stand on this, the future for NBFCs? So 3 questions to you together. You're on mute, Jaspal.
On liabilities, clearly, I think we've just heard before as well that I think people have figured out that ALM mismatches can't carry on. So I think people have been more, the banks always knew that as a science, but the NBFCs have learned it the hard way. And I think they have catered to that quite well. So actually come COVID, that is not a problem they're dealing with anymore. I think that is the problem is liquidity and not so much the mismatch. Yes, it is true that the PSU banks only, I would point out, are the only lenders to NBFCs now under the various schemes. The private sector banks have completely withdrawn from the NBFC sector, other than the AAA rated firms. Non-AAA rated, I think, is purely with the NBFC, with the PSU banks. So yes, there could be, you could count that as a concentration issue. I think the capital markets, as we heard, are not as forthcoming right now. And I think by their own design, NBFCs are choosing to stay away from the CP market. So I think it automatically raises the discussion around capital. What do you do if you have limited sources of borrowing? And so I think the need for capital raising is definitely there. The availability is a question of, convergence on value. So I think, these were very difficult discussions in the past. I would assume they'll be less difficult now and in the future. But it's at the end, if you look at if you deconstruct an NBFC, basically you can shrink to survive. If you haven't got a huge amount of bad assets on your book, if your bad assets at worst even are within the 10, 15, 20%, then you should just shrink to survive. There should be no other problem because, they don't have large infrastructures or large other issues to deal with. But I think in terms of reconstructing and growth, etc., I think capital, is something that people should have the intent for. So I think in a way they can survive, they can shrink and survive and wait for better times to come and not do it. But if I was to give an opinion here, I would say that it's better to be diluted, give up some ownership, but better to have capital, because when the time comes and the growth comes, you can be much quicker on the takeoff than the others who are then just sort of saying, okay, now we will get new lines of credit and start to grow back. On capital raising, I'm the firm believer that you need to do capital raising on 2 times, one when there is need and one when it's available. So if either of those are possible, then you should do it. The last one is backstop. Absolutely, it'll be wonderful to have backstop. Really, how do we construct it, I think, is the challenge. And I'm sympathetic to the RBI on that as well, is how do they construct the backstop? Given that we don't create reserves, etc., in the way banks do, that is a problem. But eventually, some sort of certification has to be there to distinguish the good from not so good in the non-AA category rated NBFCs. And the whole effort to get an AQR done was really to get another certification, because then we were hoping the credit agencies will do it. But, for credit rating, anything that is below AAA is not so good, as we just heard just now. So, we are clearly classified in that category. So it will take some time for that to happen. So I don't know if there's an obvious answer to backstop, but some sort of certification. It could be backstop, could be one such answer, but there could be other answers as well of certification on some other account, the quality of boards, the quality of corporate governance. I don't know what it is, but something will have to step in. Otherwise, it'll be too long for the sector, non-AA, non-AAA players to suffer for too long, and exit will be the more viable option. Shrink, take your profits and move on.
Do you think there's going to be a convergence eventually between the large NBFCs and the banking system? Do you think large NBFCs will go towards the banking license eventually to go for this effective backstop in many ways?
Anand, the discipline required and the challenges that come with the banking license. I think the NBFCs are far too spoiled, the large ones, to want to subject themselves to that punishment. I think it made sense for the large NBFCs when they were doing very well 2-3 years ago, pre-ILFS, to have done that. But their view was that, our multiple is higher than the banks and we have no headaches. Why should we do it? Now they may not be as welcome as they would have been then in terms of fit and proper for license. So that will be, but the very big ones actually doesn't make a difference. So, the people we're talking to, like, for Rangan, I mean, it really doesn't matter whether HDFC is, I still am one of those people in the world who believes that one day HDFC and HDFC Bank will be one. And so that will happen naturally. But, it doesn't really matter because the HDFC umbrella is just so reputed and so big that they don't gain too much by being one entity or the other. They'd be indifferent.
No, thanks, Jaspal. By the way, I've always rated you as one of my most candid super bosses. So you've stuck to that tone throughout. But we are running out of time completely. We've got about 2 minutes left. I want to go very quickly around asking for your recommendations on what should be done next, either by regulators or by the government or by other stakeholders. What do you think ought to be done now to give a fillip? I know Suneet is a huge fan of NBFCs. In fact, he's beaten me up some 3 times to say nice things about NBFCs. So what do you think needs to be done so that we get where we need to be as far as NBFCs is concerned? Rangan, why don't I start with you first? And you're on mute.
So as I said, NBFCs, the first part is that as you start scaling up, as you start becoming larger and larger, I think really speaking, the liability side needs a far more focused this thing, and it is a very challenging job also. So to that extent, I think as you grow beyond a size, I don't know what that size is all about, whether it is 50,000 crore or whether it is 70,000 crore, I don't know that size. All that I'm saying is that a roadmap to voluntarily convert it into a bank, if they have a good, otherwise stable liability and other this thing, would be a very good choice for them. But yes, whether there should be concessions in certain things or there is a time frame given to them to achieve certain things, certain requirements over time, those are some of the things which could be. But I think given that today's the government securities rate and all, when Jaspal is talking about those periods when these were there, at that time the negative carry was very high actually between what you borrow and what you invest in GSEC. But I think now those things are not there. In fact, now it will be a reverse in some situation. Actually, you invest in a 10-year, you borrow short, you are actually getting a negative positive spread on that. But I think some of these statutory things which are there, if there is a roadmap to do that, I think that will be a very good this thing to at least move some of the large ones if they believe that they have exhausted the liability accumulation which they can do, and they need to be part of the GDP of the country, because as the GDP grows, you are part of that system to accumulate that liabilities for growth. So that's what I would say from a larger NBFC's perspective. On a smaller NBFC's perspective, obviously, whether we need to have different classifications or what, I don't know, because today you have NBFCs, which all the NBFCs are taken as one, whether you are a wholesale funded NBFC, retail, or this thing, and also whether you need to have some reclassification of some order so that you know that which segment of the NBFCs you are talking or addressing, whether it is vulnerable, not vulnerable, asset quality and things like that will become far more clearer. Today it is actually a little blurred. Every NBFC is actually painted with the same brush. They don't know whether large, small, retail, non-retail, doesn't really matter. NBFC as a word actually is thought out to be a universal name. That's what I would say.
Thanks, Rangan. That's very useful and really appreciate that. Karthik, your suggestions on what do you think is required right now?
Yes, Rangan clearly covered the larger NBFCs. I mean, the concern for them would be liability management. For the smaller ones, which is, I think, of a crucial aspect at this point in time, would be how they are able to get long-term funding and how are they able to innovate their business model. I think the competitive pressures are going to go up overall for the NBFC sector as a whole, coming in from the banking sector or the larger NBFCs. NBFCs do have a special role in the overall economic activity space where they do have an expertise in certain part of the asset class where they have already been servicing in. They can essentially leverage that to augment a separate income or a business line which can be non-balance sheet based. You could get a fee based income. You could get a collection model. You could attach yourself to a larger NBFC or a bank. You can leverage the infrastructure that one has to get an income which is not directly related to your balance sheet. So that's something that can be done. While the easier aspect for the smaller entities to do is to digitalize. Have some amount of IT investments, which could give you the operating leverage to grow and also get an income which could be supplementing your balance sheet income. Because as I said, liquidity would be something near term monitorable, but try and evolve on an alternate route which can supplement your balance sheet income and keep you viable at an overall level. So
got it.
That's it.
Jaspal sir, last word to you. Any asks from Mr. Das, Chairman Tyagi, or the government?
I think there's only one real ask, I think, at least for the NBFC sector, that's liquidity. Because a lot has been promised, but the flow is obviously still very in a trickle. I think a lot of it anyway went away to the top end NBFCs. So I think now they've earmarked some for the non-top end. So I think that flow should flow clearly. But I think there's an equal responsibility on the NBFCs as well to go and lock in the capital that is available, even though it may not be in the ideal terms that one would have dreamt or aspired for. And I think clearly to invest in risk management, because like I said, otherwise you can shrink yourself to survival if you don't have a risk challenge. And finally, I think we heard from Ikra as well, is that margins, I think digitization may be one way, doing fee income may be another, doing other collaborations may be another, but whichever way, I think if the NBFCs work towards raising capital and getting their risk management and margins as key matrices, then I think that is their responsibility as well.
Great. Thanks a lot, Jaspal, Rangan, and Karthik. This was very, very illuminating for me personally. Covered a lot of ground, macros, asset quality, liability raising, future of NBFCs, and of course, asks from various stakeholders. We didn't talk too much about infrastructure NBFCs. Sunit, we have to have a separate session on that separately. That can be a whole day session where we can have some but we've overshot time, so apologies for that, Sunit and Rajlakshmi. So back to you. Thank you all for a fantastic session. Really enjoyed this.
You are too.
Thanks, Anand. Thank you.
We never thought. I thought some big bats will come. A lot of shoutings will be there. You said like us now, Anand, Narayanji, you did it so beautifully, and you moderated it so well, and it just like the whole fabric you opened up, and you could actually hear things that we would have never otherwise heard from different people who are all experts here. And I think it's awesome. You've really moderated it and got the best out of each of the speakers and panelists. And it was really nice because it is Sunitji who has really put it all together. There's no way I could have thought of it so beautifully. He orchestrated the whole thing with so much in-depth knowledge. Before I thank Sunitji himself for what all he has been doing for this particular banking session. It was completely today and tomorrow. He was like really put it all together. I really owe huge thanks to him from Indo-American Chamber of Commerce. But I think all of you were excellent. Mr. Srinivas Rangan, I came and met you in your corporate office few months back before COVID. You remember?
Okay.
I just said I've become the Indo-American Chamber president, and I want all of you to be helpful. But we've heard Jaspal ji and Mr. Karthik earlier also. All of you have been excellent. I'm just saying it from my behalf. Now, Mr. Sunit will tell you exactly what he wants to say. But tomorrow also, you all must at least connect to what we are doing. We are doing on the insurance sector. Anurag Thakur is inaugurating it. And we have Vipin Anand from LIC MD and Nilesh Garg from Tata AAG, and Mr. Girish Radhakrishnan, Chairman of United India Insurance, and Mr. Prabodh Thakkar, Chairman Global Insurance Brokers, and Mr. Jaideep Roy, all of you know, Global Health Insurance Leader, PwC, will be the moderator. And we have a banking section. We have Arundhati Ji Bhattacharya regarding the fintech and its experience in financial services. Sajit Shivanandan and Vivek Belgavi. And thereafter we have Nilesh Shah from Kotak Asset Management and Mr. Nagarjun Narasimhan from CRISIL and Balasubramaniam from Aditya Birla and Navneet Munot from the SBI Mutual Funds, Ashutosh Bishnoi, Mahindra Asset Management, and we have Manish Kotari from Kotak Mahindra Bank and Rajiv Anand from Wholesale Banking Axis Bank and Binayfer Jahani, Business Head of CRISIL. So I just thought I'll mention all these names for other attendants who are participating to know about tomorrow's program. And day after also we have a pharma, USFDA is speaking on technical matters. And in the evening we have, you're all talking about COVID and the vaccine. Most likely you should actually hear Dr. Ella, who is going to speak from Bharat Biotech. They're very anxious to bring it in. And from what we hear, we will come by Jan Feb. So at least all our financial discussions will now stop at that stage, and maybe we'll talk about revival. But keeping in mind with all these things, do send your people who are interested in these subjects, which Indo-American Chamber is actually proposing to do. And we have also Mr. Justice Sikri, Arjun Sikri from Supreme Court. He was judge there. He is going to speak about Indo-US, any bilateral issues, disputes and all that, how to resolve them. And then we have Invest India and others investing in India, and a lot of speakers and outboard also from Tech Mahindra. Gurnani is orchestrating that. And we have a US ambassador speaking to us on the 29th, and 30th is my last day. So we're just having different sessions from pharma to banking to insurance and others. So any of your any of the areas are interested to you or to the attendees, please remember and follow them, and we'll be very happy to welcome all of you. Once again, I'm not saying thank you, Sunit will say, but I have to first say thank you to Sunit for doing all this, and then he will thank all of you in return.
So I think Anant and Jaspal and Rangan and Karthik, thanks a lot. You brought in a lot of issues. I would say, I would say that I remember almost 15 years back when I was being appointed for L&T Infra as the MD CEO. The first hire that I went to Mr. Devasthali was for a liabilities, resources, liabilities, and treasury. And that person was going to cost them more than they were paying me. And he was very upset about this. He says, how are you doing that? I said, I'm there to manage the business, and I know that the best brain I need is for liabilities. And I think both of you have underscored that particular aspect seriously. Of course, there's a lot to talk about this, and this we can go about. And I think the fact that you covered a whole range of subject, which how to bring about. I have lots of ideas. Actually, one of the subjects that I probably some other time we want to do is how to construct that backstop that you were talking about. I have some thoughts there. But more importantly, tomorrow's the sessions are insurance, which is your liabilities side. If you're looking at building liabilities, long-term liabilities and solid liabilities, you can't get better person. And I'll explain to you. People thought I was mad that I went to LIC, and I'm talking about 13 years back, with a 17-year product, and I placed it. It was unheard of at that time. Of course, the fact that you were L&T made a huge difference, but I think it is doable. So for most NBFCs, when they are building long-dated liabilities, I think they should think of some structures and looking at stronger liabilities such as these insurance companies, private insurance companies have become reasonably large now, and I think they can be equally a good source as opposed to only LIC. We then have mutual fund. Again, I'm looking at it from the liability side. They've suddenly gone out from the liability side of NBFCs. But I'm not sure whether they've got out completely. I am on the board of one of the trustees. And I know that they still are willing to look at if there are good potential investments available. And then, of course, you have fintech, and we that's for your reducing operating costs, what Karthik was talking about. I think there's a lot of talk about fintech. We wanted to talk about it in general, and no better. I mean, we got this thing on platter saying, would you like to have Arundhati talk about it now that she's chairman and CEO of Salesforce? And we have Sajid from Google coming in, because Google Pay has become a fairly important backbone for many payment devices that we are protocols that we are following. So yeah, I think, and then the last session, I couldn't accommodate that today here, is on MSME. I mean, there's no question. I mean, even Jaspal mentioned about it in the earlier part of the day. MSME is a growth area, big employer, yet one of the challenges today. And so we thought we would hear from two veterans in the industry. We have Rajiv Anand from Axis, and we have Manish Kothari from Kotak coming in and talking about it. So yeah, I hope you all see it. Some of these clippings would also be available for review later. But I'm thankful that you all came.
And we just
more than anything else twice. So I can't be more thankful to you than that. But I think that was very interesting. And to tap it all, as usual, we have Grow More Trees, and we have those certificates that will be planted in your name somewhere in some part of India.
Yes.
And that's our way of saying thank you.
Our humble thanks to all of you, each of you. Can you put those things on the screen? We will send it to you. Mr. Jaspal Bindra, then Mr. Karthik,
and Mr. Rangan,
and then Mr. Sriniwas Rangan, and Professor Anant Narayan, and Sunit Maheshwari.
Not to me.
In your name, you're going to make it very green and nice.
Nice. Thank you very much.
Thank you.
Thank you all for spending time. On behalf of Indo-American Chamber of Commerce, I'm extremely thankful and have a lot of gratitude for your time that you spared and for the knowledge that you shared. Once again, good evening and goodbye.